that, people like Africa Development Bank, CDC, IFC, but normally the big players. We then have what we call impact investors. These will invest in socially responsible causes, alleviating poverty in some areas, women causes, politically sensitive causes and things like that. And then there is credit as another avenue through which the industry operates. So we have what we call private credit. These guys give you money basically the way you go to a money lender, but of course in a more structured manner. So if you look at that broad spectrum of vehicles, now how the capital eventually comes to you again is through different avenues. We have what we call debt, where we come and give you money. It could be debt under VC, debt under growth, debt under infrastructure. We have what we call mezzanine, the middle flow. So some of it is debt, some is equity. So I'll give you $3 million, probably 500K will give me a stake in your company. The rest is a loan at a rate better than the commercial institutions, slightly above the lending interest rate. And then we have equity, what we call patient capital. I'll come and give you money and it will sit in your operations for the next 10 years. So I will not exit it. You have no pressure to pay me back every month like you do with the banks. And you're comfortable. And then, of course, you have credit. So that is how the industry invests. In terms of what David has talked about, which again I want to elaborate, an average fund in a fairly small capital market like Africa may invest in about 20 to 30 portfolio companies over the duration of the fund. Again, David mentioned it's called the Pareto principle. 20% of the businesses give you 80% of the return. From what I've seen, my experience, and also what I've understood in the industry, if, for example, you have 20 companies invested as part of your portfolio, as part of your fund, 2 of them are going to be a write-off, total write-off. 4 of them will barely get even. They'll probably generate returns slightly above the cost of capital. 2 will be fair, 2-3% internal rate of return, slightly above cost of capital, enough to keep you from being fired by your LPs, but again, nothing to write home about. 4 of them is what we call alpha. The 10x, 20x, 50x. We have seen instances of 600x. Those of you who follow the global markets, people like Uber, Facebook, and those kind of investments. Okay? The bull's eye. So I was telling my colleagues before the meeting, my main work with Ascent Capital is not as an investment, and it's actually as a buyer and an operating executive. So it's my role in the due diligence process to look for those guys who are going to give us the 50x. So we shall sieve through 5,000 companies and eventually invest in 5. And that rigorous process is trying to understand how can I get those companies that will eventually give me 50x. Now, how does 50x happen? To Alan's question. Again, it's not a theory. It is a deliberate intervention coming to life, brilliantly executed, starting with your investment thesis. So when I come into your market, say I come into Uganda and say, I want to invest in the financial inclusion sector or manufacturing sector, I look at what we call the total addressable market. What is the headroom for growth? What are the macroeconomics? Okay? What are the variables, demographics? For example, in Uganda, we can say increasing urbanization, a growing population, strong demand for quality products, a high middle class. So definitely headroom for people who have the capital to invest behind the brands I want to support. Then you look at what would it take for me to fully leverage that kind of investment. What caliber of organization am I looking at? What competencies should be in that place? What capabilities? So the investment thesis is fleshing out the entire ecosystem around success. So success doesn't happen by going on your knees and praying to God. It's a process. You've mapped it out. And then you go to the market and find the best fit for that. What kind of entrepreneur and management team? What smarts? And then what role are you going to play? So again, the advantage with private markets, versus the public markets and our friends in the other sectors I will not mention, is that we don't decree success. We play an active role in getting the success. Okay? So 10X is an outcome of partnership between the private market funder and the company. When we get the right stakeholder, we work with you. So 10X is deliberate engineering of margin. We eliminate leakages in your company. I've been a CEO in a portfolio company run by private equity. And I'll tell you we did about 10X in 3-4 years, including COVID period, by doing these things. We grow gross margins by eliminating leakages. Okay? The beauty about our industry, private markets, is that we are super efficient. Actually, I don't know if there are any government officials around, but get these people on this table. Help us streamline your budgets and you will see margins coming back into the country. Because we don't have room for leakages in our industry. So number one, we study the P&L. Granularity, eliminate leakages. Number two, understand where the growth opportunities are and invest capital behind them. So we're masters at deploying capital where it gives us optimal return. Okay? Number three, we look for new growth areas. If I'm sitting in your business, you're probably a legacy guy. You started this thing 30 years ago. We used to call them bushel generals, so they know how things were. They used to carry boxes in the park 30 years ago. So their minds are a bit locked. Now they're like, boss, 30 years ago, Uganda had one city, Kampala. It will take you 10 hours drive from Kampala to Kabale. Now the whole country is interlinked thanks to the infrastructure development, which the government has really focused on and supported by aid partners. So you can reach any part of the country in 3 hours. How can you leverage that? You set up stock points across the country. So we look at opportunities for you to grow your revenue, but growing it profitably. Okay? One of the things we do is we invest behind technology. Things like ERPs, AI, analytics. So if you get somebody, improve how he thinks. Give him access to technology. Improve how he goes to market. Help him go to new markets like my colleague has rightly mentioned. Because some of the biggest companies, most of their alpha returns are coming from the export market. You can't sit comfortable and say, I'm going to grow a 1 billion business in Uganda. You cannot. Currently, I'm doing some M&A work with a gentleman who is exporting from Uganda to Australia, to America, to Europe, out of Kauku. Something other people who probably will be doing the same thing have not appreciated because nobody has opened their perspective. So a guy thinks his market is Chikubo, Kasese, Mbarara, etc. When your market is Nigeria and Tunisia, okay? Algeria, last time I checked, I think Algeria is buying, 600 metric tons of beef from Europe. If I was a beef stakeholder in Uganda, why not take that market? Now only people like we guys on this table and our colleagues in the industry probably may have the clarity to help you reposition your perspective. So Alan, 10X is actually possible, but it's a deliberate outcome. It's an outcome of a deliberate process, well executed. Now that leads me to some of the enablers, something called ESG. There's been a tendency to kind of reduce ESG to environment. But the biggest part of ESG is actually governance. Okay? Putting in place proper corporate structures, having a board of directors, having processes, okay? Ensuring decisions are taken objectively. People held accountable for commitments on a regular basis. Using data to guide decisions, not authority and titles. So ESG, having super motivated employees, having a culture of valuing people. Okay? The gender balance we talked about. Actually, one of the hallmarks of companies invested in by private equity is that we definitely call out for more ladies at the board level, at EXCO level, EMT level, and in employment. I've seen a lady calling out the panel, but we shall eventually get there. We are working on that. Next panel, we'll have 3 ladies here. We shall have retired by then. So these are all enablers, okay? We'll talk about leverage. There's something I was talking about with my colleagues before this session began. Leverage is how much debt is in a business. Again, back to the exciting bit about Africa, which I think Alan kind of talked about. The narrative around the industry in Africa especially. In the Western world, when you go into a company and invest, many of these companies are heavily indebted. So they are not very attractive for capital. Because you're kind of coming on board, but you're kind of thinking, people like NSSF, insurance companies, UAPTC, family wealth funds have given me their money, and I'm taking it to Alan's company, but Alan is going to use it to pay off the debts. Not very exciting. And that's how we end up with 1x return. But if you're moving into a company which has no debt, or little debt, whatever capital you're putting in is going to grow and generate more capital, which makes Africa very exciting. The problem, we are not selling our story in the global capital markets. I'm a student of the global private equity industry, and I get disturbed by how little of it we're benefiting in Africa. Of course, probably what can help us as well is our local, I would call them limited partners, institutional investors, having more faith in our industry. NSSF should be the one taking the lead, investing in companies in Uganda. Okay? UAP or mutual fund. Okay? The institutional funds. I worked in Uganda breweries very many years ago. I remember we used to have a retirement benefit scheme. That fund should be investing in funds in Uganda. Some of the wealthy individuals in Uganda, you don't need to wait for the Sheikh of Abu Dhabi to come to Uganda to invest money. We don't have guys with money in this country. And then, of course, the other thing that we look at is currently, you're all aware about the currency issues that we're facing in Africa. Incidentally, if you guys think Uganda has been hit, look at countries like Ghana, Nigeria. Their currencies have been totally eroded by the exchange. So if NSSF invested Ugandan shillings in Uganda, their return is excellent. There's no erosion of forex. So I would encourage what I would call that caliber of LPs, institutional investors, pension funds, high net worth individuals to invest in their markets. That's how we shall get this headroom. And then now to the technical question of, again, which David answered well, but I'll just supplement it, how the deal is closed. Now, there are two sides to that how the deal is closed question. Where I'm sitting, when I shake hands with entrepreneur X, like I'm about to shake hands with some people, with my fund Ascent Capital, next couple of weeks in Uganda, some deals that are coming close to fruition. For us in the industry, it's basically commencement. So Alan, I don't celebrate when I shake hands. The hard work is just beginning. Because I actually celebrate when I'm exiting after the agreed period. So, like you rightly said, I may be shaking hands on my funeral. My fund is finished. I've just committed myself to somebody who's going to bury my fund. So the hard work actually begins when you shake hands. But shaking hands is very important, like you rightly said. And I think you answered it very well. The fit between the partner and the fund is very important. You have to build trust with the entrepreneur. Most entrepreneurs are a bit concerned that you're going to come into their businesses and probably get rid of them, which happens at times, by the way. Because I've seen it by the Nairobi, where I spent some bit of time. Again, probably because of the traditional approach we've had towards the engagement, when we are starting out to engage you, we don't tell you how the process works. So you've been running your ship 100%, you make every decision, while playing golf, while in the gym, while having a drink. We're now telling you there's corporate governance. I've come on board as a partner, I'm getting you capital, but in return, I want some bit of process. Obviously, when we sign the check, some people may present that process. I'm sure you've seen that. We have had some interesting partners in some of the funds we have invested in, and it normally causes a bit of pushback. Then the other bit also is that, again, people don't understand that a startup CEO or founder may not have the smarts to scale up. It doesn't mean you're incompetent. Even globally, some of the best founders, people like Mark Zuckerberg, began Facebook, fantastic guy, but he had to get Sheryl Sandberg to come on board, help him scale up. The guys who began Google, brilliant guys, fantastic guys, but they couldn't run a big company. They had to get a guy like Eric Schmidt to come and scale them up. I've seen the same thing play out in East Africa. The companies that have succeeded in the industry have had to get professionals. Those that struggle, that stagnate, are when you think, I began this thing, until I die, it will be under me the way I want it to be. You may be a $1 million CEO, but you can't be a $10 million CEO. Because the dynamics of having a $10 million successful company are very different. So yes, we can do the deal, we'll shake hands on it, but the success of that deal, okay, post shaking hands and champagne opening, depends on a lot of variables. The final bit is the process. Again, David mentioned it, but I'll just walk through it. I'll take a step back to how a fund is started. So people like us on this table, the three of us can actually make a call and say, our collective smarts will make a difference in the private markets ecosystem of East Africa. So we kind of agree at a philosophical level, we want to make a difference in a certain sector. So we prepare what we call an investment thesis. So it shows our vision of how the market can be transformed, the sectors we want to play in, how we shall generate value, whose capital we want to have, because at the same time, a fund actually, incidentally, by the way, people think capital is, capital is a two-way street. I may actually refuse your money, because your money may not be aligned with my vision. So when we have that clarity, we do what we call a fundraising. Usually we kind of have an indication of who want to get capital from. Currently, many of the people in our industry have been, I don't want to use the word beggars, but they don't have a lot of choice. But as you grow more mature as an industry, you will find the capital owners actually fighting to give you capital. Especially like the people on this panel, my colleagues have seen, who have strong track records of success. Normally, if you've navigated one fund, the LPs come looking for you. So, you've written the thesis, you've done your fundraising rounds, you secure capital. Now, capital is not available to you as cash. It's a commitment. Okay? Somebody like NSSF will tell you, I commit, I will give you $5 million in the next fund. My gentleman here is not sitting the 5 in the pocket. It will be available when needed at a particular point in time, but there's a commitment towards that. So now I have a fund in place. A fund has a structure. We have the LPs, the GPs, the partners who run it, we have the investment teams, analysts, and then operating executives. And then you go out into the market. So when you raise a fund, say you raise a fund for maybe a duration of 10 years. What that means is, I am supposed to go to the market maybe the first 3 years. I am getting stake in the companies based on the model that I talked about earlier, whether it's venture capital, growth capital, impact capital, and whatever it is. And then over the next maybe 4 to 7 years, I'm focusing on generating what we call alpha, excellent returns. And then in the 8th to 10th year, I'm planning on my exit. Okay? Now you exit either through what we call primary markets. I don't know if the colleagues from USC are here, but I had a conference recently where somebody put me on the spot and said, why isn't the industry exiting through primary markets? Okay? Somebody, I don't know if it was you, someone put me on the spot. And I am not the ambassador of the industry. The ambassadors have a conference tomorrow. But not yet very big in East Africa. So I would say primary is still a bit small, but even globally, post-COVID-19, I think you've not seen a lot of IPOs. So a lot of exits are happening through what we call secondary markets. So I'll go and speak to David and say, David, there's an interesting proposition here. I probably need to maybe get capital out. He'll come and get my stake. So we're playing it at this level, peer to peer. And then we have the owners. At times the owners build the muscle to actually buy us out of the business. So that is how the exit happens. I know I've taken a bit of time, but I thought it's very important we share these technicalities. Because many times we come on these panels, we speak very big words, and we get out of there without adding a lot of clarity, because we are speaking esoteric technical terms. So I hope I've shared a bit of clarity on that. Thank you.
Well done. That's a master class, and you will pay me for organizing a quick class on private markets. But Tips, thank you very much for those deep insights. And I've been looking around the room, and I see Ali Twaha is really itching to ask you some questions. Across the room, let's use this moment to prepare at least 3 questions for the panel, and then we should be able to wrap up and move to the next bit of the session. Can I take 3 quick questions from the audience? I don't know who is ready. Quickly. I think Ali is ready. He's always ready. Ali, you have a question today? You are satisfied? Not yet. It's still fertilizing. Good. Let's use a second. Yes, the ladies have it. We have a question on my left. The ladies are well represented. They get these things quickly. So David, your gender thing is going to be shot down.
It's like you read my mind. Good morning. My name is Audrey and I'm from Swedfund. We're the Swedish Development Finance Institution, funded by the Swedish government that's very passionate about gender. So David, my question is to you. On gender lens investing, a lot of us have requirements that come from our owners, so not just Swedfund. If you talk to the Finns or the Danes or etc. And gender currently is one of the areas that we work a lot with. And our owners, when they fund us, they also tell us the funding we give should have 2x, either the 2x challenge, and even for some, the 2x challenge is not enough. So there's a few more requirements. So how do we marry that? Because our capital is coming with those conditions, and then what you find locally in the market. Of course, we're not saying just give every woman a loan. We're saying, you know, find good businesses. And sometimes it's not necessarily gender lens investing does not mean investing in a woman-owned business. It could be investing in a business that caters to women, that makes products for women. Women comprise roughly 50% in many of these economies. In some African markets, a bit more, and they make a lot of decisions. So how do you marry these conditions that we come with what you find on the ground? And it's not an attack, Dave. Yes.
Let's have one more question. Yes, again, the ladies. We have two ladies on this side, so they can take the questions quickly, and then the panel can respond.
Thank you very much. My name is Linda, and I work with Old Mutual Investment Group. Now, my question is around how do you safeguard against dishonesty? Because I have dealt with a number of businesses, and business owners are very, you could say, creative and sharp, and someone could take money out of the business, or some transactions are not reported, so you find that you're actually losing money because of dishonesty. How do you safeguard that as an investor in these businesses?
Gladys, she's itching to ask a question.
Thank you, Al. Good morning, everyone. My question goes to John, and this is regarding governance and putting in ESG criteria into the due diligence process. I know that part of the process in DD is just looking out for the correct kind of ESG or governance checkpoints. If you could speak a bit about how people can manage, or what are the red flags that they should look out for in deals regarding ESG, specifically governance. Thank you.
Awesome. The ladies, the questions are from the ladies to the gents. Who wants to go first? David, you are not being attacked. So
No, I don't feel attacked.
I'm here to protect you.
I don't feel attacked. I have two beautiful daughters, so I am extremely gender sensitive. Extremely. I am all about empowering women, because that's 50% guaranteed of the population. If it's not working, the whole system is collapsed.
In your house, it's 75%.
Yeah, now that is the despite. Yeah, I'm a bit of the skewed participant. So how do we meet the 2x challenge? And how do we work for these funds? You see, a lot of the fundraising, unfortunately, in Africa has been driven by DFIs in the private market. And the DFIs have written their agenda ahead of consultation of the environment that it's likely to be implemented. That's not to say that we are not grateful for the support, but just to say that the support is not being customized by the environment in which it's to be treated. But that is changing, and that is the role of these conferences, and that's the role of these rooms, to change the narrative that the gender lens view should be ground up. What are our agenda issues? Our agenda issues, the biggest one to me, or to at least many African families is land ownership. Now, if women do not own land, it's unlikely that they are going to do enterprises on land. So how do we address women access to land without necessarily saying that we are going to invest in businesses that are owned by women? Okay? So we create vehicles that, can distribute credit to lease land. And that land can be leased to women who then, plant product for a predetermined customer and who's an off-taker and have a market access to be able to pay for those leases. For me, those are the kind of creative gender lens businesses. Not saying, before I invest, I need 50% women on the board. Where are they? We haven't trained them. They are there, I understand, the room is almost 50%, but in many cases, and this is not something, even you women, when you've created companies, are you saying that your entire boards are full of women with the technical skills and expertise? No, you're going to have to bring in other people who have the skills. So we are going to have to apply TA to get, women who can step up to those roles to step up. So when these funds are being raised, and they're saying provide returns 2x financial and impact, I want you to stress the fact that if they insist on that gender aspect, it must be funded at zero cost. Because then that is a qualitative treatment of the fund. Now, when we go to the quantitative or financial aspects of the fund, then we can apply innovative tools to ensure that women have access. Okay? Not necessarily only at leadership. Because leadership doesn't directly influence the direction of the outcome. Because you have a woman at the top does not necessarily mean that she's going to make access to women available. Okay? So we must have an ecosystem that realizes that outcome is actually the critical element for the gender lens. It is not really at the input. And we're applying it at the input mainly, saying, I want the board 50 women. I want the CEO woman. I want the shareholder woman. So I was arguing this with, not arguing this with someone. We were visiting some of our portfolio companies, and one of the appraisers of those portfolio companies would ask the promoter, and we support a lot of family businesses. So he would ask the promoter, so who owns this business? The man says, I own the business, but my wife owns something. So he says, what does your wife own? Can she come in here and take away that ownership and, distribute it elsewhere? That's the answer he wanted to get. In an African family, now I'm wondering, I said, okay, do you want to break family for the sake of gender, or you want to support gender through family? How do you marry those two? So we invest a lot in family businesses. We realize that those businesses are primarily promoted and majority owned by men, but these are family businesses which are built to support gender. Now, if we break the unit family, because we want a woman to have a direct stake that represents her contribution, which is equally 50-50, so that she can even trade it anywhere she wants, that, for me, represents a total distortion of understanding what gender is.
Professor David on gender. We have a few minutes left, John and Tibbs. Let's use this time to respond to the outstanding questions, being mindful that we're being called out. Don't do another Professor John as well.
No. I don't have the Professor gene in me. I'll keep mine short and to the point. So the question was around red flags in transactions pertaining to ESG, specifically around governance. So, I'm in the advisory space, and when we're advising investors, both buy side and sell side, we, currently there's ESG due diligences are becoming more and more critical as part of the deal process, right? So within EY, it's something we offer. I'm sure a lot of the other advisory firms do as well. And we look at, 3 or 4 things, when it comes to governance. One is leadership, right? How many people are in leadership, and what level of independence is there in the leadership structure? So, for example, is there a board? Is the founder the only person who is on the board, or does he have other people who help him with the governance of the business? Is he related to these people, right? So is the board the founder, his wife, his children? Or is the board the founder and some independent people who have a bit of subject matter expertise within, whatever the business is doing? We also look at culture, right? So do the employees, now this is now, levels below management, do the employees feel empowered to call out, wrongdoings within the business? Do they feel empowered to make decisions quickly as well, or do they need to go to the founder? That's another red flag. So if the board is just the founder and his cronies, so to speak, that's a potential red flag. If there's no culture of, calling out wrongdoing and, people feeling like they can stand up for what is right without fear of retaliation by leadership, that's a green flag. But if that's not there, that's a red flag. The other thing, we're talking about gender balance here, but I think that's also something we look for within boards. And it's not just, are there women in leadership in this business, but, are there positions that they're being given, not just whitewashing, right? So I've been involved in transactions where there's, it's founder owned and managed. There's a lady on the board as a company secretary, but she's, just there to tell the founders, hey, we have a lady on the board, and she's the only one. And, that proved to be quite a big stumbling block when they were looking to raise funds. So we've had to really support them restructuring the government process, not necessarily bringing in more women just for the sake, but making sure that, this company secretary is empowered as a fully fledged member of the board and not just to take minutes, which is something that, unfortunately we've seen. I know the question around safeguarding against dishonesty, the answer I would give has to do with corporate governance as well, but I'll leave that to Innocent to wrap up.
Okay, thanks. Safeguarding against dishonesty, like David and has mentioned, 3 levels. Level 1 is a rigorous due diligence process, because everything starts before you actually do the deal. So you have people like Ernst & Young do their work. We have legal teams. Then we have operations due diligence. So you go to the trade to establish the unit economics, and then you look at the people, the structure. So even before you come on board, you understand exactly the reality outside the numbers that have been sent to you. Now, once you do the deal, for the first 6 months to 1 year, is when you set the tone that will ensure that in the long term, this dishonesty is either going to grow or will be nipped in the bud. So you have active involvement of the deal teams in the day-to-day operations. So most times we speak different languages. I know many companies keep 2 sets of books, unfortunately. Now to them it's the right thing to do. To us in the capital markets, it's the wrong thing to do. So if you don't handhold them or get to understand how they actually run the company, and then after 5 years you're calling out this as a dishonest act, then it's a bit of a challenge. So that is level 2. Now level 3 is the controls you have in place, people like yourself, but most of them start at the board level. So what we normally do when we invest in the business is we have 2 members of the fund sit on your board. We ensure the board has a proper committees and structure, a board audit committee functional. We have external directors who are experts, functional experts in their dockets, sitting on the board. You have an internal auditor reporting to the board of directors. You have audited books, an external audit, and action taken to safeguard compliance. So if you can have the process from the word go at due diligence level, deal teams with the hand holding, and a robust continuous controls environment, then you significantly minimize the risk of dishonesty. And of course the final part is repercussions. In the event of fraud and things like that, you take action. People are dismissed. The other bit is some funds normally come with either a CFO from the fund, somebody who has your back as the owners of capital, to kind of sense check and double check and keep the owners in check. So I think at that broad spectrum, you kind of minimize the occurrences of dishonesty. Of course, fraud is fraud. The smartest guys will always commit a fraud, but you can mitigate against it by doing these things. So I hope that has given you some bit of clarity.
Wow. We've had a master class in private markets introducing the conference today, and I want to take this opportunity to invite you to give a very big round of applause to my WhatsApp group. It makes me look very bright. Thank you, gentlemen, for really spending time to break it down. If you look around the room, it's a very young room. And we are trying to envision 10 years from today, a 28-year-old, 30-year-old in this room is going to be a boss in some ministry. So we want to seed and encourage them that when they become bosses, they should do these things and put them in place. And these conversations start early. We appreciate you taking the time to give them this information in detail and with clarity, such that as they make their career progressions, perhaps we have fertilized private markets today for them. Thank you very much, gentlemen, and I'm going to invite you to stand in front and we take a very quick picture before we hand over to the MC for the next sessions as well. Thank you. All right.
Another round of applause for the great team. Yes, what a great start. This is just a conversation starter. Feel free to approach any of the members of the panel after this to have a detailed conversation. We had Mr. Okumu, Tibbs, David Gongolo. Any of them are available for further discussion after this. That is just the beginning of this conference, and I think it's going to be a wonderful one. We've begun well. We had a lot to discuss. Exits, how liquid are the markets, the failure rate. Can we have a fleshed out success process? And I think that was very, very key to look at. Thank you very much, Tibbs, for that success process. I don't know if you can share that with us to convert, to get those 600x, 10x returns. I think it's something to look forward to. Next, we're going to have someone very dear to the CFA Society. Yes, he's with us. Allow me to welcome to the stage Francis Nashombia. He is the president of the CFA Society East Africa. He's also the principal at Capital Connect Africa. We've just mentioned here, you can't speak of Uganda without speaking of Africa. He's someone who has very deep knowledge on that. If we had the national anthem for the CFA Society, we'd be playing it right now. Here is the man with the big shoes. Please put your hands together and welcome CFA Francis Nashombia.
Hello, everyone. Hello. I don't know how to engage without being engaged. I'm a teacher, so I like being engaged. Thank you so much. My name's Francis Nasiomba. For the people who come from the eastern side of Uganda, that name sounds a bit familiar. So I keep saying I'm Uganda. Alan. And I'm the CFA Society East Africa president. I'm also the CEO and principal at Raising Capital, and also the founder of Capital Connect. It's a pleasure being here, and I'm looking forward to today. I'm very happy to see all of you here. I hope you will be able to get time to listen to me after the WhatsApp group. It's a very difficult group to follow. So I hope you'll give me some 5 minutes and just get away from your phones for a few and listen to what I have to say. I hope I won't be so boring. So first, I need to acknowledge some protocols. The team from the Ministry of Finance, Planning and Economic Development, Josephine Okuyosia, the CEO of the Capital Markets Authority, who's not present, but very well represented by Dixon Sembuya, one of our members. Patrick Ayota, Managing Director, NSSF, he's not here, but also very ably represented. The team from the Private Sector Foundation in Uganda. Paul Buiso, the CEO, Uganda Securities Exchange. Our sponsors, Bank of Uganda, Capital Markets Authority, Deposit Protection Fund, NSSF. Sorry, my phone is misbehaving. NSSF, UAP All Mutual, PKF Uganda, Uganda Securities Exchange, thank you. And our partners, ABSA, Gen Afrique, and TDB. The Board of Directors of the CFA Society East Africa, the CFA Society East Africa members and candidates, distinguished guests, esteemed colleagues and participants. I believe all protocols are observed. My name, I've told you, so I don't need to repeat, but I'm humbled to actually be here. I consider Uganda to be home, so when I'm told welcome, I always say it's home and thank you. Yesterday, there was a Twitter space. I don't know how many of you participated in it. Good, so you're not going to get bored with what I tell you. But I struggled getting into it. And when I dialed into it, Alan was doing a really wonderful job. So when I was trying to get into it, I was trying to figure out why am I struggling? And I thought initially it was a user problem. Then after a while, I figured where the problem was. And no, it was not a user problem. It was actually a network issue. So the long story is this. I took a border. I went to what I thought was downtown Kampala. I ended up on Kampala Road, but I was informed later that there's actually another downtown beyond that. So I was not really at downtown. The thing is I needed to buy a line, and I needed to buy this line for my data, because initially I thought the line would just be an alternative and I could use the hotel Wi-Fi, which is what let me down. So the logistics of it, jumping onto the bike, venturing where the tourists and visitors normally don't venture, and looking for Forex to get Uganda shillings so that I could look for the lady on the street to buy the Momo for my data. All that, trying to run for the X space, it actually made me think. It was actually up that it happened because most of us consider alternative investments to be that. But what we are not noticing is alternative investment is now becoming the main line of investments in Africa. If you look at our stock exchange in Uganda, for example, as of May, if I'm not wrong and my numbers are right, the total valuation was $5 billion. How long has the Uganda Stock Exchange existed? According to IAFCA, we had $70 million of investments disclosed in 2023. I say disclosed because the title is private equity, private investments. The first word is private. So most of these guys don't like disclosing these alternative investments. And I'm sure even if they tell you they've closed a deal, they'll tell you invest between this and that, and they don't tell you exactly how much the investment was. The thing is, Africa, East Africa is starting to rely heavily on alternative investments. So maybe, Alan, we need to consider how we call this conference, because it's now becoming the main source of investment for Africa. In recent years, CFA Society has deeply engaged in spearheading various initiatives so that we can actually be able to grow the capacity, the human capacity around investments. We've had remarkable member growth in terms of numbers. Across East Africa, we are at now 300 CFA charter holders. I want you to pause there and clap for us. So out of more than 100 million people, you have 300 charter holders, of which 57 are in this country, in Uganda. And I think we need to clap for that. But most importantly, we have a nursery of more than 400 candidates in Uganda pursuing the CFA charter. So together, we continue to innovate, to educate, to empower, ensuring that the collective effort to contribute to prosperity and well-being of East Africa is maintained. So this conference, now that it's in second year, and conceptualized and continue to be watered by the society, led by two of our very able members, that's Alan Letabe and David Wangolo, is a continued testament to the extent to which we actually are pushing and pursuing to make sure that we pay a whole lot more attention to alternative investments. The global ecosystem is undergoing a transformative shift. Traditional investment avenues, they're now changing. While they are relevant, they're changing significantly. There's a surge on alternative opportunities. So I know we've had a whole lot of conversation on private equity, but there's more than that. We have hedge funds. For example, I don't know how much we have in Africa. Real estate, someone called it a lazy investment today morning at breakfast. Venture capital, cryptocurrencies, climate and gender-less investing. I really liked that conversation. And I look forward to hanging out with David and Audrey after this. And we should understand that the implications should be that we need to equip ourselves and have the knowledge to navigate the complexities of these investments. So thank you so much for the masterclass when it comes to private equity. You actually put it so simply. I don't know if there's a better way of being able to do it. We are well positioned to take advantage of these opportunities. Our region is brimming with an untapped potential, burgeoning entrepreneurial opportunities, ventures, and pursuits. We have a youthful population. Thanks, Alan, for pointing it out, that most of us are actually going to be in leadership in a short while. There is a dynamic population eager to grow and innovate. So as we continue this economic transformation, we need to make sure that we are not left behind when it comes to alternative investments. I know that we've sort of picked on NSSF much. I'd like to also still pick on them and also all the other pension funds. The thing is, most of these private equities and LPs, these are external funds. These are foreign capital that's coming in. What does that mean? It means that when the profits are generated, where do they head? You can take a wild guess. So with the theme of us catalyzing private capital for value and social impact, it actually resonates very well and deeply with our mission at the CFA Society East Africa. We are committed to the highest standards of ethics, education, and professional excellence, as you've seen with some of our members here. And we look at this conference to actually continue being a testament of our dedication in fostering the environment for financial professionals to share insights, debate ideas, as you've seen the first debate, and forge pathways that can contribute to economic prosperity. So as we set out, I encourage participants to engage actively, network, absorb the wealth of knowledge that will be shared. The conference is not just an opportunity to learn, but to collaborate and to forge connections that will drive collective progress. I wish to extend my heartfelt gratitude again to the sponsors, the friends of the society, the participants, the panels for bringing your knowledge, and all of you for being here and being humble enough to know that we keep learning and being willing to keep learning even more. So in closing, let us remember that the true power of alternative investments lies not just in the potential for the 10x returns that everyone is talking about. It is actually the ability to create positive, lasting change. As we explore these opportunities, let us remain committed to fostering a sustainable, inclusive, and prosperous future for East Africa and beyond. At this point, I'm supposed to say I declare this conference open, but it's already open. So I just want to welcome you and look forward to being able to interact during the day. Thank you so much.
Thank you so much, Francis. Just to console you, it wasn't boring at all. I have the opportunity to introduce the next presenter. Our next presenter is Dr. Bagenda Peter. he has a very extensive CV. I will just breeze through a bit of it. Dr. Babyenda is an assistant lecturer in the Department of Policy and Development Economics, that is in the College of Business and Management Sciences. He also holds a PhD in economics from the University of Nairobi in Kenya. His areas of specialization are experimental and behavioral analysis of both micro and macroeconomic aspects such as the environment, agriculture, forestry, inclusive growth, climate change adaptation, and welfare. Beyond these, the doctor is an enthusiast of time series, cross-sectional survey, and panel data analysis and interpretations. Dr. Babyenda has about 6 peer-reviewed journal articles, policy briefs, and many newspaper articles. He has been a member of several consulting teams, including the most recent ones and the design of the second national strategy for private sector development, empirical analysis of youth employment projects and their impact in Uganda, and the value chain analysis of beef subsector in Uganda. Peter is also the current policy engagement specialist, best for the Inclusive Green Economy Capacity Building Program for senior civil servants at the EFD Mark Center. He's also coordinating a peer learning capacity program on the community forest management, among many others. So please join me as we welcome Dr. Peter Babyenda.
Thank you so much, the Masters of Ceremonies, for those kind words of introduction. I also want to join the previous speakers by thanking the organizers, but also to stand on the already established protocol. I am glad to be here today to attend this conference. But I must say that I'm here to represent my dean, Professor Ibro Okum Mike, who was unable to be here. We appreciate this invitation as the School of Economics. And since we are in that college of Business and Management Sciences, where we, together with the School of Business, we teach these things of investments, returns, capital markets. So I want to use these few minutes to just highlight some of the few things. And I must say that it's quite difficult for me from academia now to come after the first panel, the WhatsApp group. I think they mentioned most of these things, and with from the practical point of it. And it reminds me one time I was teaching investment, especially on portfolio. How you need to diversify and all that. And then one of my students asked me, okay, sir, you have talked about this, you should put your money here and there. Where have you put yours? So it was really, I will do some small introduction since the organizers want me to talk about the concept of inclusive growth you know, we can grow, we can see more growth coming up, but when it is not inclusive. Then talk about the sources of local capital, as we have been. Yeah. So, and what initiatives have come up, at macro level, some challenges, and then recommendations. And I want to do this as fast as possible. So the local capital, simply the financial resources generated locally, generated within, not from outside. Generated but also invested within our. And where can we get this capital? From the individual savings. Individual savings, we as individuals, institutions, business savings, if businesses are making some profits. And we are at a time when you look at various reports in this country, I don't know colleagues from Kenya and Rwanda, but here most companies, most businesses are crying a lot, even when you look at the URA records, so at the decline. Then the insurance, and I think insurance players have done their best in trying to mobilize savings. The mutual, the UAP mutual, the unit trust now, and the other players have come up, not only UAP and others. I think they are trying, recruiting these younger people that keep moving in offices, looking for savers. So they are bringing that money. Then we have the circles. Most workplaces have circles nowadays. This circle, the forces, the Wazalendo circle, the police, and the rest. And all these are finances, which we can tap to use locally. The retirement schemes, like that of Makerere, we have ours, our own, which has grown. It is quite big, and it is already investing. Shares, here we have quite a big problem that we have very few companies in our country that have gone public, that have listed. So still most people want to own their businesses by themselves. They don't want to invite others, and that one limits capital. So you can attract the local capital here by opening. And here informs, I want to talk about savings, investment loans, equity, financial assets, and here largely I think the government assets, the treasury bills, the bonds, and the players, the brokers here are now doing good work now. You can open an account and start buying, contributing. So these are the innovations that are coming up, that are attracting investors. So anyone, simply using your phone, if you are registered on mobile money, you have a USE account, you can buy, you can trade. We need to encourage that, although there is some problem on information sharing, and just like the lady asked the question here of integrity, a lot of counterfeit, so some people are not yet sure if I buy this share on my phone, I've not seen anyone, I have no receipt, is it genuine? So those are some of the issues we the players need to talk about. You can see the equity is growing. According to Bank of Uganda records, you can see around 70 million US. That is 2022. I don't know by now whether this has increased. And even from abroad, we are attracting some money. Although in 2022, we had a very big drop. And this was showing uncertainty in our markets. The financial sector is still, people are not so much certain, and they fear for risk. But looking at other investments, construction is doing well. Of course, you can see everywhere you're moving, even across the town here, Kololo, everywhere there people are building. The structures are coming up. electricity. I think that one wanted to make the point of our electricity. But where is the money going? Oil, transport, someone talked about here, Uber and what. The Uber sector has so far failed to pick up in our country here. So I don't know the players, what you need to advise these people of ours who are involved there. Compared to Kenya, even Tanzania are doing better in the Uber. I think here the other point of integrity is still the ICT, but only 4% in finance and only 3% in manufacturing. So the inclusive growth, which I said I'll talk about, simply it means not leaving anyone behind, irrespective of the gender, age, so all the youth, everybody has to be involved. But as we are doing that, we need to be cognizant of the employment. Is the growth, you can have a growth that we call jobless growth. The figures are showing, we are reading the GDP has increased, the GDP per capita has increased, we are now entering the lower middle income. People are busy languishing without jobs. So that is jobless growth, which is very common with, if the growth is largely moved by the service sector. The service sector does not create so many jobs as compared to manufacturing sector and the rest. And you can see this if you just moved here in Mukono, that place called Imbarara in the morning. You see so many people in a very small factory. If you have a mobile money, you need only one person there. So, but also environment, poverty, income inequality, all those should be at their minimum. And similar to that is sustainable growth. So as we are growing, we need to take into consideration the future generation, not only looking at ourselves. That is the sustainable growth. So here you have to look at 3 components. The social component, which we talked about, job creation, the environment, and most people theoretically say the environment. People demand a better environment when they have more incomes. As your income increases, your desire for a better environment also increases. So the poorer you are, that's why you see when you go to slums and the rest, it is very hard to find a rich person in a slum. So as we are growing, these 3 things should move. Economic, because we need to create jobs and the rest. When you look at our budget, which is going to be ready tomorrow, it's talking of, when you look at their SIM, full monetization. So this is an advantage to us, that even the other people remaining, the 36 that are remaining in the village, in the subsistence sector, we need to bring them. So we need to increase our efforts for financial inclusion. And the telecommunication companies have done well. The MTN, Airtel, the mobile money. There are so many people now with the mobile money. So therefore, us in the asset portfolios, we need to target these people by making the processes very user-friendly. These people should learn how to start investing in the bonds. But also encourage as more firms to list shares on the stock exchange market. We want to have more companies, especially the profitable companies, listed at our stock exchange, at Uganda Stock Exchange. So as I start to wind up, once we have attracted more local capital, then it is the ease, the access. And here you can just look at the circle. If I use an example of the circle, for example, people are able to access funds for school fees from the circles. So that's how easy it is without so much hassle. Even at the workplaces, if you go to the circles at the Ministry of Finance, the officials can easily walk in and in the evening put their order, and then in the evening they have their money. I don't know in the other circles. Then also the more people will be included in the financial sector. So the village groups, which started, they used to call them the Nigina groups at the church, Mother's Union, are now slowly moving into having an account. So you are bringing more people in the financial sector, and that one will help you to raise enough local capital that we can borrow, we can lend to manufacturers, those who are ready to invest. And that's what also the insurance sector is doing, the unit trust and the rest. Although the challenges of low return, our people still think that once I put 100,000 somewhere in a month, it should bring me 100. So when the investor says it can only give you 1,000, the person looks at it as I rather stay with my money. So we need to look at, I don't know how shall convince that actually money grows gradually. Money does not grow in one day. It is a big challenge even with us, the younger people, who think we can become rich in a mass. That if I've gotten a job as an officer somewhere, then tomorrow I should start driving. Money grows gradually. So even when you look at these big investors, even they don't make 20% profit of their money. So here now, the people, you have to come in and make our people. We have, they talked about startups. We have so many startups, capital rounds, many venture capital, not only from the government, but also from the private, from our development partners. They grow. For example, they grow. You have funds, I think, at the private sector foundation for the youth, but also in the Ministry of Gender, many grants to help our youth startup. Now, my thing cannot move. So, I just wanted to mention one thing of the financial literacy, that we need to do more efforts to make sure that people are financially literate. And this one will help people to increase their transaction in the finance sector. And that's what the mobile, the MTN are doing. But others are still struggling. For example, the internet banking is still struggling when you look at the figures as compared to the mobile wallet and so on. But remember here, there is also a big problem of fraud. So we need to guard our systems. As we innovate, we need to guard. And you can see that there is a lot of money that moves in an economy here. One time over a weekend, I think it was last year, where close to 8 billion shillings were withdrawn in Endeavour, around Endeavour area. I think you heard of that. So if Endeavour area can manage to have 8 billion just moving there, we need this money in the financial sector. And once the money is in the financial sector, it also helps to guard on this thing we are talking about, the corruption. Because any money that passes through the bank, you can trace. But this money in the sacks, people are keeping money in the sacks. But also that money is barren. If I can use the term that is very common, barren money. When you keep money somewhere, that money is barren. Invest it. So even when you say unit trust has low return, you put there your 50 million. Every month at least you'll have something like 500,000. So the money is producing, is not barren, as opposed to, but also someone will borrow that money and be able to create a job for our people. What has come up? UDP has some money. We have the good regulator here for the stock exchange market. The CEO is here. The national security, there's NSSF, a lot of money there. Already the WhatsApp group talked about it. We need to invest that money here so that we generate more. But also now, the law has been a bit, some liberalization. Now we have other saving schemes coming up, including like that of ours of Makerere, which I've told you has grown. What remains is the investment, where to invest the money. Voluntary saving, so this one will help to bring money from the people, so that we have big money in the basket to lend out to the people. The new PDA, I think you have heard of the new PDA guidelines and the Act, which is a bit friendly, although the problems still remain of the late payment. The late payment of our local people. Actually, that's why our local people, if you go to private sector foundation in AGM there, you'll find people complaining. They are not paid. And then we have these bad manners of some accounting officers. You have to come, then agree again on some percentage, then you are paid. So the integrity issues affect so many issues. So if we overcome that, we shall move so fast. The industrial parks, so now you have where to put your money. The industrial parks are there. You can ask for space. The agricultural credit facility at the Bank of Uganda is available. The other day, I heard there is another facility in the Ministry of Energy if you want to invest in renewable energy. So if you have started your SME somewhere, you can go there. What we don't know is how easy is it to get that money. You know, sometimes we hear of the money, but getting it, I think people just want to hear it. Capital grants from State House, and the rest. And this one has helped some youth in the ghetto. But because of lack of financial literacy, this money usually is not productive. Challenges. Late payment, I've talked about it. Low returns, but that one is on our economy. A few farms, I've talked about it. Sometimes tight monetary policy. Someone talked about people here from Bank of Uganda being... Usually for us, we are low inflation. Our inflation should be low. But sometimes then we tighten so much and we increase the cost of credit, making it further difficult. You are aware in this country, our cost of credit is very high. So it is very difficult to sustain a business on the loan. Some of these small SMEs that move around, when you look at the survey, some survey we did, it's because the owners are workers elsewhere. You are an officer in URA or NSSF or Makerere or where. So sometimes you use actually your salary to pay back. That SME cannot pay back itself. For those who just depend on that, it collapses in a year. So and then money going outside because we don't own most of those businesses. Information asymmetry here, the information. So I don't know how we are going to overcome this issue of information, so that people are aware. For example, there are very few people who know that you can actually open a USE account on your phone and you start investing in these assets. So we need to come up and deliver this information in various languages, not only English, so that people can understand. You can come up with some pictorials, things of that kind, so that people can know. I have seen people who never went to school using mobile money. How did they know? So the same can be done. We cannot only say that should be education. I think the screen is telling me my time is gone. Counterfeit financial products, someone talked about it. Counterfeit, I don't know who shall guard this. But we also have these Ponzi schemes, you have heard of them. Usually, I think, spearheaded usually by Nigerians, where they come here, collect a lot of money. What I know from my knowledge from the financial investment is that any sweet investment is not genuine. So if someone comes and tells you, put in 10,000, just 10,000, then you'll be earning 5,000 every day. Just know that is not genuine. So anything that is so good to be true is not genuine. Unfortunately, many people go for that. So we need to come in and do that. Of course, some taxes. Even in Kenya now, you see Kenya had now gone at a stage that nobody wanted cash. Just use your phone. Matatu, Mama Mbogo, everywhere, M-Pesa. But now I heard they brought a tax. So now people are going back into the cash. The same is applying here. We had gotten used just paying on petrol station and what. Then we put a tax there. So sometimes what is the intention? Do we want people to stay with cash? Or we want to go cashless? Cashless way is the way to do. It can even help us avoid some of these kicks you have been seeing around, because someone suspects Ugandans move with money and then he kicks you. But if they know actually we don't move with money, it will reduce. Technological difficulties use access, internet infrastructure and the rest. As we are moving into this, we need a stable. The president has just told us how he suffered. At least here in Uganda, you are able to buy a line. But in some countries, they have tightened. You may not buy it on the street. So that what tells you how open our economy is. One time I remember I went to Tanzania and then bought a line. And then it didn't work. You have to go and register. In Kenya now, it's also very difficult because of securities and the rest. So that is the uncertainty and so on. More financial literacy. Easy means for trading, more flexible monetary, that is that. More companies should be listed. And finally, thank you so much for inviting us.
Thank you very much, Doc. Another round of applause for Doc. He had some interesting phrases. He spoke about money should not be barren. And I thought that was interesting, barren. It's a new financial term that perhaps we're going to have in the academia. So his conversation, his presentation was really about sustainable growth. He showed that we are having a lot more money coming through. However, where is that money going to? And he said manufacturing is receiving just 3% of that money, and yet it's the place that creates the largest employment and perhaps has the largest impact. We have changed the program a little bit. With us is the keynote speaker. We're privileged to have the keynote speaker with us. He's going to be speaking to us very soon, and then we'll have a panel. The panel should have come just right after this very good presentation. But before that, we're going to listen to a video from the DPF as we get ready to listen to the keynote speaker. Could you please play that video?
It's our mission to secure your money.
Protecting your money is as important as earning it. It is for this reason that the Deposit Protection Fund of Uganda, DPF, was established by the government of Uganda to provide deposit protection to customers of regulated financial institutions. In the unlikely event that your commercial bank, credit institution or microfinance deposit-taking institution fails, the DPF will pay you up to 10 million Uganda shillings. Keep your personal information such as national identification number, mobile phone, or an alternative bank account updated with your banker. Terms and conditions apply. For more information, contact DPF at Aha Towers, Plot 7 Lodell Road, Kampala. Call 0312 206 400 or visit our website at www.dpf.or.ug.
Thank you very much, the DPF and all our sponsors. We have several sponsors today. DPF is one of them. Thank you very much. DPF protects your bank balance up to 10 million. Anything above that is at your own risk. Yes, it's good to have the awareness and the reminder. Okay, without any further ado, allow me to welcome Mr. Dixon Sembuya, CFA, who is representing Ms. Josephine Okweosia, the CEO of the Capital Markets Authority, the regulator of this very good sector, the capital markets sector. Welcome.
Thank you very much, Sam. Colleagues, ladies and gentlemen, good morning. My name is Dixon Sembuya. I'm the Director in charge of Research and Market Development at the Capital Markets Authority, and I'll be standing in for my Chief Executive Officer, who unfortunately could not be with us owing to an urgent meeting with the board. So she does send her apologies, and I hope you accept the apologies. Now, I'm delighted to be amongst you. I'm seeing so many familiar faces, you know, colleagues, associates, and you know, it's really a pleasure to stand before all of you. You know, when the previous speaker was talking about kicks, you know, there's something I normally share with people and they don't believe. I was an expert in karate. And I can see you also don't believe. So I actually trained in how to kick people almost 15 years of my life. And, you know, I went as far as brown belt. So I mean, in terms of categorization, you'd have Bruce Lee at the top with a black belt, then me just below, just below Bruce Lee with a brown belt. But nevertheless, so colleagues, just allow me to deliver remarks for and on behalf of my Chief Executive Officer. So distinguished guests, esteemed colleagues, ladies and gentlemen, all protocol observed, good morning once again. It is indeed a pleasure and humbling experience to stand before you this morning to address you. And I would wish to start by thanking the CFA Society of East Africa and other partner organizations for putting together today's event. And I think a round of applause to the CFA Society of East Africa and the partnering organizations. Thank you. So, ladies and gentlemen, the Capital Markets Authority, or CMA, has had a long-standing partnership with the CFA Society of East Africa, governed by a memorandum of understanding. So we do have an MOU which provides a framework, you know, for engagement with the CFA Society of East Africa. So allow me, on behalf of my CEO, to reiterate the CMA's ironclad commitment to supporting the CFA Society of East Africa. The CFA Society of East Africa remains a critical partner in championing both ethical and professional conduct within the investment industry, as well as the deepening of human resources needed to drive the growth of Uganda's capital market. So the CFA Society is critical in that particular goal of ensuring that we have, you know, the necessary skills, you know, the necessary resources, human resources to drive the growth of Uganda's capital markets, the necessary resources to drive innovation, increased appreciation of ethics. I think, I mean, when it comes to the financial world, I mean, it's all about trust. It's all about confidence. And I think, as you know, during those sleepless nights when I was struggling with CFA, I think as I was reading ethics, I think part of the emphasis is on the impact that the actions of one individual can actually have on an entire industry. Okay, so one individual goes ahead and, you know, engages in something unethical, and consequently, you know, the whole industry is painted with a single paintbrush. Okay, so it's really important to emphasize the importance of ethics, you know, in as far as driving investor confidence is concerned. Okay, it's really important that, you know, that point is hammered home, and the CFA Society has been a reliable partner in as far as you know, driving the agenda of ethics within the investment industry is concerned. So, ladies and gentlemen, today's theme, that is catalyzing private capital for value and social impact, appropriately reflects the crucial role that alternative investments can play in shaping Uganda's economic future. The theme itself underscores the immense potential of alternative investments. This conference aims at shining a spotlight on investable opportunities within the alternative investment space. So this is really timely. I think, again, referring to the curriculum, the CFA Institute curriculum on alternative investments. I think there's that realization that owing to the fact that alternative investments normally have low correlations with your traditional assets, equity, fixed income, and consequently, in terms of adding or creating value, once you include them in your portfolio, you actually you're able to reduce the risk within your portfolio, and so alternatives are important in terms of risk management, higher risk-adjusted returns, you name it. Well, I hope for those who are still doing level 1, I'm actually helping you revise. So, ladies and gentlemen, the financial landscape is constantly evolving, and alternative investments have become a significant force driving that particular change. So, from private equity to real estate, alternative investments offer investors the potential for diversification, higher returns, and exposure to unique opportunities. So the CMA understands the critical role that alternative investments play in fostering a more robust and diversified portfolio for investors. And consequently, we are actively working to create an environment that encourages the growth of alternative investments. And this should ultimately fuel Uganda's long-term prosperity. So CMA recognizes the importance of alternative investments. So we are alive to that. And we've taken certain steps to facilitate the growth of alternative investments. Key among the steps include the passage of regulations for real estate investment trusts. And I think with those regulations, you can basically structure different types of REITs, the income REITs and development REITs. So those regulations are actually in existence. And I think my only plea would be for, the experts, the financial intermediaries to actually make use of those regulations because they are there. And it's really important for us to make use of them to actually test and see whether, they would work as envisaged. Okay. So I'd actually urge market intermediaries, the experts in this room, to actually look at those regulations. And I believe, those regulations are good in as far as, encouraging exposure to real estate as an alternative investment. In addition to that, we've embarked on the process of reviewing the Capital Markets Authorities Act. And that act has got some few definitions, especially around private capital and private capital vehicles and funds, which we believe are a bit ambiguous and are not really facilitative. So what we're looking at doing is reviewing the existing definitions and provisions to ensure that they are as facilitative as possible for the private capital space. So that remains work in progress. Now, we've also engaged with different other partners from the Uganda Registration Services Bureau, the East African Venture Capital Association, to try and develop regulations for limited partnerships. Now, for those who know, the current Partnership Act has provisions for limited partnerships, but we believe there are gaps within those provisions, and those particular gaps do not facilitate the structuring, efficient structuring, as well as domiciliation of private capital funds domestically. I mean, I'll give an example, issues around winding up. I mean, private capital funds usually have a term, 7 to 10 years, and after that you wind them up. But if you look at the current provisions, they actually tag the winding up process to the Companies Act, making it a bit complex. So that remains unattractive. So with these partners, we're trying to come up with a framework that will allow for efficient structuring and also encourage domiciliation of private capital funds within Uganda. So that remains work in progress. And the beauty is that we've obtained support from different players within the development partnership or development partner community. And they're enthusiastic about seeing a more vibrant private capital space in Uganda. We've also been lobbying for a more favorable taxation regime for private capital funds, and I believe this should bear fruit pretty soon with the passage of more friendly fiscal incentives for private capital funds. I think you should be hearing something around a much more favorable fiscal policy for private capital funds. This has been ongoing for almost 2 or 3 years, but there is a lot of light at the end of the tunnel. So you should be seeing or hearing something in the next few days with respect to those fiscal incentives aimed at encouraging, private capital as a source of alternative, non-bank, market-based, patient financing. So, as I come to a conclusion, I think building a strong and sustainable market for alternative investments will require continuous engagements, collaborations between, the regulator, the industry, and the different players. Okay, and we are committed to open communication and fostering dialogue that will prioritize both innovation and investor protection. So we are very much willing to engage. We're very much willing to hear from everyone. And I think what we're looking for is constructive criticism with actionable solutions. Okay, so that's really important. Let's criticize, but let's also provide actionable solutions. Very, very important and very key as we engage in different discussions today. So that will be very important. Let's criticize, but let's also ensure that as we criticize, we also provide actionable and workable solutions. So together, we can ensure that alternative investments continue to be a valuable tool for investors while maintaining a fair and efficient market that benefits everyone. So, ladies and gentlemen, at this juncture, I would wish to wish you good deliberations, and actually hope that we can keep tab of resolutions, discussions, so that at least next year when we come back, we can have some sort of tracker. We can have a tracker and see what we discussed and what has either been progressed on or what has been implemented. I think that will make this engagement a lot more meaningful. So I think that is a challenge that I'll throw to the CFA Society of East Africa to ensure that we clearly track the deliberations. The conversation is clearly tracked, and actionable proposals that are made are captured, and we create a tracker so that next year, we can be a lot more accountable, and we can make these engagements a lot more meaningful. So, ladies and gentlemen, at this point, I would wish to stop. I would wish to rest my case for God and for my country. I thank you.
Ladies and gentlemen, another round of applause for Mr. Dixon Sembuya. We are very grateful to the regulator for the promises that he has made. Dixon is the Director of Research and Market Development at the CMA, so he's very passionate about everything he has just mentioned over here. We look forward to the fiscal incentives that are coming very soon, so this is something to really look forward to. I was hoping for a round of applause for those fiscal incentives. We know that we've been pushing for these for quite some time, so it's good that it's finally here. And the CMA has given their word that whatever we discuss here and present to them, whatever tracker we come up with, they're going to work on it, so that next year we're going to come and have follow through and see what we've been able to achieve and what's work in progress, and to move this market forward as we should. Ladies and gentlemen, we have one panel before the break. It's a fireside chat with the Private Sector Foundation. We have some very good people on that panel. I don't want to preempt too much, but we're going to speak about a catalytic fund, and there's so much good stuff in there to do surgery on. Like we said, we are surgeons and we are farmers. So in keeping within that line, let's do some extra surgery on this catalytic fund. To do that for us is none other than Alan Luetabe. Alan is Director Investments at the DPF Fund. He's also overseeing the startup. He has a startup ecosystem which we'll speak to. Alan, please, welcome to the floor. Take us to the fireside chat. Thank you.
Good morning once again. I know we are pressed for time, so I won't bore you with my very light CV. But there is a very interesting conversation that has come to my attention over the last 6 months, and I felt it was important for this audience to hear the initiatives different interested parties in our ecosystems are doing to address the challenge of local capital being deployed to local businesses. So our next two speakers are leading different initiatives in that area. And I felt that hearing from them on what they are working on will also offer a hope, actually. I think in this room we need hope. It will offer hope on how things are likely to shape up in the next couple of years. Allow me to invite, she's my boss in another space, Ms. Damali Sally, who works at the Private Sector Foundation, and she will be sharing later in her introduction what she's working on. She will be joined by my student in another life, Ivan Karugaba, a very seasoned engineer in electronics, who is also doing some fantastic ventures, and I think I have given him the flu of wanting to change this market as well. To set us off, guide me. How many minutes do we have? 30. Okay. So, Damali, Ivan, use about 2 minutes just for introductions, just to share your minds. Where are you? What are we working on? And then we can delve into the topic on the catalytic funds. Thank you.
Okay. Good morning, ladies and gentlemen. My name is Damali Sally. I am the Chief of Programs and Projects at the Private Sector Foundation Uganda. And I don't know how many of you know about Private Sector Foundation Uganda, but I'm going to use my 1 minute to talk about Private Sector Foundation Uganda. We are a business membership organization. We do policy and advocacy on behalf of our members. We have 310 members at the moment, and they are clustered into sectors, including manufacturing, agriculture, telecom, banking and insurance, professional services, where CFA actually falls. And our mandate is to do policy and advocacy on their behalf. And we are also, so the likes of Casita, Uganda Manufacturing, Uganda Bankers, all those are members of PSFU. And we represent about 3.5 million enterprises below us. This also includes Federation of Small and Medium-Sized Enterprises. We are also the focal persons of the East African Business Council, COMISA Business Council, and the African Business Council. So we do represent the entire business community in the country. And I will delve into what we are working on for the catalytic fund.
All right, Ivan.
Thank you very much, Alan. My name is Ivan Karugaba, and I'm an engineer by profession. But I run a company called Loera Electronics and Semiconductors, which is a consortium of over 20 companies doing electronics design and manufacturing locally. And what we are doing is trying to develop an ecosystem. The ecosystem is quite big. Things like semiconductor design and manufacturing, things to do with artificial intelligence. We had the previous speaker say, if you see returns that are too big or too sweet, it's a lie. But I don't know, those of you who follow the global markets, I think you have been able to see a company called NVIDIA. Just last year, the company grew over 260%. And such emerging technologies and frontiers, I think it's about time that Uganda looked into it. And we are glad that through our government, government of Uganda actually gives out grants for these kind of deep tech and impactful sectors through the Science, Technology and Innovation Secretariat. So I'll be able to share in detail what we do and the opportunities we have for young people in innovation, research and development. Thank you.
All right, thank you both Damali and Ivan for those intros. Now to speak to our topic, it's largely looking at how do we catalyze local capital, Uganda shillings, to be invested in Ugandan businesses. You have both trying to tackle this problem. Let me start with Damali. From the Private Sector Foundation, what is the problem you have seen leading towards the solution catalytic fund that you are developing? What is the problem that you are seeing from the private sector side? And Ivan, you could also speak to the problem that you're seeing for the semiconductor electronic space.
Right. The biggest problem we've seen, of course, PSFE, we've been in existence for 29 years. In those years, we've been doing policy and advocacy, especially around capital, cost of capital to be available to businesses. We've been doing it for like 29 years. But of course, over time, we've realized that we need to come up with our own solution. Just policy and advocacy itself is not sufficient. So we've decided to design what we're calling the Private Sector Catalytic Fund, that is looking for providing capital to SMEs, young people, women, that doesn't require collateral and is patient. So it will be designed in a way that, depending on which value chain you are, if you're going to, you're in horticulture, we'll design your capital in a way that you can pay it back within the value chain that you're in. If you're in coffee, that will be designed also in a different way. But uniquely, we also are cognizant of the fact that not every enterprise in Uganda has capacity to meet the due diligence requirements that the other WhatsApp group was talking about, where they look at 500 companies and only pick 5, because those are the ones that meet the due diligence. So the catalytic fund is saying, but what happens to those other 495 actually? Maybe there are 100 of them that may be viable if they are supported. We know that enterprises in Uganda begin with the one man, the one woman, and then they grow. But sometimes that one man, one woman doesn't have all the capacities to be able to scale it. So the catalytic fund that we're designing will be 1/2 capital, non-collateralized capital, patient, but the other half, it will be business development services. For those enterprises that are failing due diligences, are failing to get to that next stage of getting private capital, they're not meeting those requirements, but we know why they're failing and they can be given support. So that other half will be grant financed. So, and that will be supporting them on the business development services so that they can get to a point where they can either attract capital through the private equity through the banks, or they can thrive and be able to grow. The critical thing about the catalytic fund is that we're trying to build from the bottom. If you don't have enough enterprises that are viable enough as an economy, you can't grow anyway. So the private sector catalytic fund is trying to look at those two problems in one way, and it's looking at impact investing. Actually, currently the global market value of impact investing, according to the Global Impact Investors Network, is at $3 trillion. There's $3 trillion globally out there that is in impact investing, and the private sector catalytic fund is looking at actually impact and ensuring that there is a social return. That's why we're targeting SMEs. It will be targeting also youth enterprises, and it's also going to be looking at the business development services. This global value of impact investing capital around is estimated to grow to at least 7 trillion within the next 10 years. So we need to develop vehicles or instruments that can attract that kind of impact capital, that can look at things that are targeting those enterprises that naturally may not be looked at by commercial banks, may not be looked at private capital. Who is looking at them? How is someone helping them? And this is what the private sector catalyst fund is trying to deal with.
Ivan, on your side, what's the problem? What are you seeing in the semiconductor electronics that we're trying to solve?
The actual problem is, let me just give a real life scenario. When I was starting out about 10 years ago, I worked with Kira Motors at the start. That is before I left off for China, Shenzhen, to work in one of the world's biggest factories. And what I saw was sort of life-changing. When you look at these emerging technologies like AI, electronics, semiconductors, actually these are issues of national security. They are very high impact, but it is very difficult to get a local investor to invest in such things. So as you go out to pitch, it is very difficult actually to convince a Ugandan that, okay, look here, I'm manufacturing, personally I manufacture computers, but to get a Ugandan to invest in your business, it will be outright. He will tell you these are things for Chinese. But when you look at how fast the global economy is running, these are some of the biggest anchors for this very fast-paced development. And actually, they give some of the best returns to date. Okay, we always argue that, okay, Uganda is predominantly agriculture-based and it's our key activity, but I always argue with people and tell them there's no way, however much you plant maize with the acreage the size of Africa, you won't make as much money as Apple is making, even in one quarter. And we always argue, I don't know, till morning, but that is the fact. You find one company in the United States, its revenue in one quarter is way larger than our GDP. So in Africa, we have very brilliant minds, actually. Before I came here, I've been able to meet very innovative engineers across Africa. We're in Nairobi, and we are convening under the Royal Academy of Engineering. So when you look at what young people in Africa are doing, last year we were in the UK, but I managed to meet a young gentleman. He's into quantum computing. So when you look at such fields of deep tech, mostly the governments are the ones that actually put out the initial investment. But when you look at the leverage such investments give a country, for example, that gentleman's company, its biggest client is the UK Royal Navy. And through such technology, you find that the UK has sort of more advanced and is quite ahead of the rest of the world. So at Luera Electronics, we do have a fund, and actually we are financing young people. As I think we deploy the same mechanism as Madame Sally. We don't focus so much on the books and the projections, but the bigger picture. Are we building the right human capital that will take Uganda and Africa to the next level to compete globally? So our focus is quite different from the usual.
Okay. Thank you very much for those takes. But just to deepen the conversation a bit, On the catalytic funds you're both building, who are your initial anchor investors or funders? Who are those parties you are focusing on? And then for this audience, we can use the same breath. What would be your message? This room has fund managers, largely, and investment professionals. What would be your message in regards to the work you're doing? What would be your message to them?
Great. I didn't mention that the private sector catalytic fund is going to be domiciled in Uganda. And I do remember when we're doing the feasibility work, and a lot of the consultants were advising that it shouldn't be domiciled in Uganda for reasons we all know. And I'm glad that Capital Markets Authority has talked about the regulatory changes that are going to happen, the physical incentives that are going to happen, so that we can get more FDIs here with the right incentives. The reason why we're domiciling it in Uganda, and the reason why it should be domiciled here, is that we need to look at a local solution for a local problem and design it in a way that actually deals with the local problem. But in order to do that, we need to do it ourselves. So the Catalyze Fund is looking at domestic investors, actually, primarily, first and foremost, because we are not, allergic to foreign investments, but we're looking also at domestic investments. Look at the likes of NSSF that is required to invest a certain percentage of the fund domestically, but NSSF says it also doesn't have enough vehicles in the country to invest in. So we're developing the catalytic fund so that there is an investable vehicle for NSSF to invest in, and NSSF, because it's the national fund, it's supposed to also be interested in impact investing. It should be interested in how many young people are actually continuously employed, how many companies are supported at the bottom, so that they become savers of tomorrow. Because NSSF at the moment, based on its trajectory, there are fewer people who are going to be saving in future if less jobs are actually created today. So it actually is an impact investor. So we're looking at that. We're also looking at pension funds, other pension funds in the country, to be also our anchor investors, looking at the long term, but also taking a Ugandan approach. Your pension funds, you're Ugandan, we're in Uganda. So we expect that you're going to understand when we are saying we should target young people, we should target the youth, we should target women. Someone was here talking about the gender conversation came up here, which sometimes is considered controversial, yet it shouldn't be. Women in Uganda own 40% of the enterprises. So if we're having a conversation about capital, why would it be that I'm the first woman to speak? You see? And if you look at the room, we are everywhere. So we need to ensure that we design vehicles that tackle our contextual problem in a way that we can solve our problem the way we understand it, the way that can actually solve it. If we only look at foreign investors and foreign pension funds, they come with their restrictions, which they're allowed to because it's their money, right? So they'll come with their restrictions and say, no, you do a due diligence, and if they don't pass, sorry, you can't invest in them. And I'm saying, what happens to those? Who helps them to be able to meet the due diligence tomorrow? But who is going to do that? It's going to be a local catalytic fund that is going to be interested enough in those that can't meet the threshold and helping them to meet that threshold. And I think that's critical for us to find local solutions that are developed by us, funded by us. We can't expect other people to fund them. We need to put our money where our mouth is. So we need to look at domestic investors. If there are any high net worth individuals, which is not a typically Ugandan culture, high net worth individuals tend to invest in themselves. But we're also trying to also see, are there any high net worth individuals in Uganda who can invest in such a catalytic fund for impact and for prosperity, for contribution to your country, and then also pension funds and the NSSFs of this world, and even the government. If you're investing, we have a PDM, how do we see that there's a public-private partnership in PDM and ensure that we can use a private sector angle that has an impact aspect to partner with PDM, where we still get what the government wants us to get, but in a way that that those enterprises can thrive even after PDM. So those are the angles that we're looking at.
Right, Ivan?
Thank you very much. As Luera Innovation Catalyst Fund, our biggest investor is the government of Uganda through the Science, Technology and Innovation Secretariat. And I can say it's a bonus for us because, as Mrs. Sally mentioned, there are not so many attached strings, and what we are looking at mostly is the impact and development of the human capital, the human capital building. But let me give you a scenario, because we are so anchored into manufacturing and deep tech. We were doing sort of a survey, and in the field of electronics, since I worked in Shenzhen, China for some time, by the time maybe a device as simple as a USB cable gets to Uganda, the price has gone up by over 50% to the final consumer. So what we're looking at the end of the day is, okay, we have people importing some of these things, for example, USB cables, power banks, chargers. Some of the people actually we have convinced are the former importers of these items to join us and set up assembly lines for such items, such that at the end of the day, we have more employment opportunities, we have more human capital development. So just briefly talking about what science and technology is doing different. This time around, it was so deliberate to the point that the people who were awarded these grants are actually the private sector industry leaders. Because previously, maybe people from academia, I'm not saying there's not so much results from there, but this time around, it was more of a deliberate effort by government. We actually partnering with other global industry players, the likes of people like Intel, Qualcomm, that are into the chip design and manufacturing. And from such companies, you may not directly get maybe money, but you may get capital, maybe in form of upskilling the engineers that you have, to mention but a few. But I know in this room there are people who run funds and VCs, and I would really, really encourage you, because this sector, it's more than proven. The global giants, China, US, what's making them fight is some of these things, semiconductor. I don't know if you get that. So I would encourage you to actually look into such ventures. I know you won't be disappointed. The high returns will come, the impact will be there, and also Uganda will sort of be autonomous from some of these.
Right, thank you. We were given some 10 minutes. And before we close, perhaps I could invite the audience if there are one or two questions that you want to share. I see the director has a burning one, and Mariam as well. Please go ahead.
Okay. Thank you very much, Dixon Sembuya, Capital Markets Authority. And I would like to start by thanking you all for your contributions. Very, very insightful. What you shared is quite insightful and edifying. Just a quick comment, specifically on your opening remark, where you alluded to the first presenter, saying that when you see very high returns, you need to think twice. That's a message that whenever I get any platform, that's usually a message that I share. That where you have unrealistic returns, you need to think twice. And I think you gave the example of NVIDIA, and I felt there was a bit of a mismatch, because if you look at the growth of NVIDIA, it's driven by fundamentals developing those semis that are needed for large language models, generative AI. So if you look at the prices, I think they're just a collective forecast of the commercial opportunity presented by AI, artificial intelligence. So I think we need to differentiate between the two, where those sweet returns are not backed by any sound fundamentals. You need to be very careful, but where there's some fundamentals behind that, I think then it's justified. Well, I think you're a visionary. I've actually followed the semiconductor race, arms race, for about 5 years. So I'm pretty much alive to the wars between the US trying to stop China from developing a viable semis industry. But my question is on the fund and how it works. What's the criteria for awarding grants? What's your success rate? I mean, if you talk about, say, investees or portfolio companies, what has the experience been like? I would really like to know what the experience has been like for this particular fund. Thank you.
I think let's take the question from Mariam. She's at the back.
Thank you so much, Al, Ivan and Damali. My name is Mariam Nansuga. I'm a director with Sync Consults. We are an indigenous advisory firm. We do a lot of advisory on BDS capacity building. We focus on indigenous institutions and family-owned businesses. And Ivan, my question is to you, perhaps to understand better, and maybe closely related to what Dixon raised. At what point do you actually assess feasibility and sustainability of your investees, especially because you have a lot of government or subsidized funding at the moment? So when are they ready to stand on their own and become feasible? I also wanted to ask a little bit about innovation versus reinventing the wheel. And bear with me, you can explain better when you give the example of manufacturing your own computers, to Alan's question around what the problem is. Is it the price? Would it be the price locally? Would it be access? So what problem are you actually usually looking to solve, or the companies, the investing companies that you work with? Thank you.
I think those, there is one more. And then we take the responses.
Thank you for a good discussion. My name is Audrey and I'm from Swedfund, the Swedish Development Finance Institution. And one of our goals is to support SMEs in developing markets. So this fund that you speak about is very interesting. What is the size of the fund? What size of investments, tickets would you invest in these companies? Is it debt, is it equity? You mentioned that it's patient. How long is the plan to recycle it? It would be a very interesting vehicle, and I think if it can kick off, you could provide companies that are then ready for more larger tickets of financing from private equity funds or eventually from development finance institutions. So I'm very curious about this fund and how it's structured.
All right, let's start with Ivan. You got some burning ones. NVIDIA, fundamentals, big returns.
Thank you very much, all. I do agree with Mr. Dixon. I think we're at par. Then you asked a question about what is the criteria, what is the fund about, who does it target. So how the fund is structured is actually we do offer grants to micro grants to people specifically doing electronic product innovations. I would give a vivid example. If someone is, for example, trying to set up a factory to manufacture maybe USB cables, such a person can always approach us, and we see how to support them, maybe in terms of things like the equipment, the material costs, research and development of the product. That is what we offer. Then the criteria is simple. We always have people doing applications. You apply to us. We do evaluations, and we have thematic areas. Anyone doing, for example, medical devices, Internet of Things, AI, consumer products, consumer electronics, and a few others. Then we do evaluations, and after evaluation and a few other processes, we elevate this to our biggest stakeholders, government. Once we agree, we always award this either in cash or in kind. And I think that answers that. Then I'll just marry this reply with Adrian. Audrey, yeah, sorry. Mrs. Audrey. So the size of the fund, right now, we have about, because it's a new fund, we have about $200,000 at the start. And the maximum ticket size actually we're offering is up to 50K. But this is going to be a revolving fund. Like every other year, we look at this fund growing. And as we support these innovations, people actually do, maybe in terms of money and other ways, we do recapitalize this fund such that other people actually benefit from this fund the next time or the next year. And Madam Mariam asked something interesting about reinventing the wheel. When you look at the way we approach this, for example, if I say we are manufacturing computers, we try to put into context what is the problem. The problem is the cost, actually. This technology is so costly to many Ugandans. It may not make sense to you, but actually how it would make sense is, for example, let me give you a statistic from UBOS. 3% of Ugandans have access to computers. 3. So the underlying, actually, some of these innovations we support, we try to localize them, make them so organic to the point that we address the reason why, for example, they are not accessible to many. For computers, it's the cost and the energy efficiency. Most of the population being rural, there's no way you will take, for example, to a school that is off-grid, computers that are consuming maybe 260 watts of power. So if someone comes up with a solution of a computer that is going to consume maybe 30 watts and be supported by renewables, I think that would be a very good innovation to support because the underserved will be served. Then how we do the feasibility is quite different from the usual. Mostly we look at impact, impact in terms of economy. How much import substitution are we doing? You see that? Will the product be cheaper than what is being offered? will it be of the same quality? So those are some of the aspects we look at. I don't know if I've, yeah.
Damali, you're going to close our session. But as you think about your closing remarks, you could touch on some of the aspects he has addressed on the catalytic fund on your side, how it might work, but also give us an indication on the size, expectation on size as well. Okay. And then perhaps a call to action. And then we can close the session. Thank you.
All right, thank you. So the private sector catalytic fund, someone did ask a question about the ticket size. And based on our feasibility study and our experience in working with the private sector of Uganda, is that we realize that not all companies are the same, depending on the value chain you're in, and not one size fits all. So we don't have a blanket ticket size. We have ticket sizes depending on the value chain. If you're a company that is in oil and gas, your ticket size is going to be probably different from someone in agriculture, someone in transport and logistics. So it will depend on the value chain that you're in, or the sector that you're in. So we are tailoring the ticket sizes to that. Again, trying to find a Ugandan solution, understanding that not all enterprises in all sectors are the same. Because otherwise, if you have a blanket ticket size, it may end up only helping, a few. You may ignore a certain sector that has impact, but probably their needs are not as high as, if you say your ticket size is $100,000. So we are going to be bespoke and sector-based in defining the ticket sizes. Then I did mention that the private sector catalytic fund has two arms: one, the investment arm, and then the other arm, the business development services arm. That business development services arm is grant finance, and I could say that we've already raised the grant financing. We have a grant portfolio of $350 million at the moment, and that half, you would say, is grant finance, and it's continuing, but it subsidizes or gives the foundation to the catalytic fund, the investment side. So our goal, of course, being that we're Ugandan and we're here for forever, our goal is to have a private sector catalytic fund that is at least $1 billion worth. But of course, we'll start off with cycles. It will be revolving. Of course, the funds underneath it will close, because a fund under fund of funds. The funds underneath it will close, but it itself won't close, because we are Ugandan and we're here forever. It should be here in perpetuity, though the different funds should be able to close. And with those few remarks, I would like to call to action is, as Ugandans, can we support each other and support our industry? We know the problem. So wherever you are, wherever you're working, whether you are in a fund that's funded by foreign capital, find a way to ensure that it's actually impactful. So while you're complying with the restrictions, then I'm calling on to institutional investors, domestic investors, to also look at domestic and local solutions and invest in them, and also look at using local solutions, not a foreign concept copied and pasted here where it won't work. We're Ugandans, so we should be able to contextualize it and ensure that it will be working. Thank you.
Awesome. Thank you very much. Let's give a very large applause to our team today. I know for a lot of us today, this is new information. There is grant funding. There is a lot of initiatives to domesticate the conversation around local capital, private equity, building new ventures, growing Uganda together. And I believe that the message here is very clear. It's our burden together to grow these capital markets. We should not expect a solution to come from out there. It's going to be in these rooms that we solve these problems. So thank you very much. I hope everybody in the room has appreciated. Let's take a minute to take a photo. Some of us have to give evidence that we were here. But thank you very much. And let's give again a very large applause to the team.
Oh.
Listen to me, my child. Learn from me. You're young, you're strong, but one day you'll grow old. Don't make the same mistake I did. Start now. Start saving for your retirement.
Don't wait for life to get tough. Start saving for retirement and live better in the Zabo Life. Zabo Life. Happy retirement. A message from the Uganda Retirement Benefits Regulatory Authority.
Hello. Thank you so much, Alan, Dameli, and Ivan, for the very, very insightful but then also very hopeful presentation. They raised a couple of interesting points. Dameli introduced the private sector catalytic fund that is a bit more patient than our conventional sources of capital and is tailored to specific business needs and cycles. Ivan talks about what they do and brings out something really interesting about not only focusing on numbers, but also looking to grow the human capital, which I think is a very pertinent part of growth as a nation. They also tried, Ivan also nudges the investors within here to critically look at the semiconductor business, at least if you're looking to earn some alpha, and generally encourage us to come up with a better solutions to our businesses by looking to invest even domestically, so we don't have to only look for external sources of funding. At this juncture, I would like to invite us for a tea break. Because time is fast spent, it's going to be a working one. It will take about 5 minutes, and please go out and take a cup of tea or a cup of coffee and interact with your neighbors if you haven't, and we'll be back here in 5 minutes. Thank you. Have the opportunity of introducing the next panel. Our next panel is going to discuss a very interesting subject. They're going to talk about Gen Zs and their investing attitudes. So we'll hear things like social media, cryptocurrencies, FOMO, fear of missing out, and the influences families have on investments. And our moderator for this session is going to be George Jato, or Tim. George is a corporate finance professional with over 10 years of experience in this field. He heads the corporate finance function at BDO East Africa. And he's also a management accounting lecturer at Matt Abacus under the SCCA curriculum. George has an extensive CV that I will not delve into because our time is fast spent, but I would like us to welcome George to the stage. Thank you.
Good morning, ladies and gentlemen. Some energy, just from a tea break, please. Yeah, just as Julie, my colleague, whom I serve with on the CFA East Africa board, mentioned, I'm here to moderate a panel with colleagues of mine that I'll introduce briefly, but for now I'd like to take this opportunity to introduce the topic. We'll be covering Gen Zs and their investment attitudes towards social media, cryptocurrencies, the fear of missing out, and family. And by show of hands, does anyone know the definition of a Gen Z, or do you reckon to fall within that age bracket? How many? I only see one at the back, yeah? So a Gen Z is someone who's born within the mid 1990s to the 2000s. And like I said, I don't think there's anyone who falls within that age bracket. I miss out narrowly. But nonetheless, I think we have all been through those age brackets before, and I'll give you my brief introduction to investing. I think if you look at the ages 18 to 25, I finished my A-levels when I was 18, and my first experience of investing was actually sports betting. That's when sports betting was introduced in this market, and there were quite a number of merchants or vendors who you could approach and predict on what's going to actually happen in those games. But for sure, I didn't have a good record. And there is a book called Eat the Rich by P.J. O'Rourke, and it goes on to define gambling as, I quote, "Everyone knows that gambling is an immoral act and thoughtless activity engaged in by fools and derelicts." So I guess I was a fool at that time. So nonetheless, after that, I also managed to study ACC, and then I was lucky enough to get a job by the age 20, and had some experience in investing on the Uganda Securities Exchange. I think that's where I started off my journey, and my first investment was New Vision. That didn't turn out well. I think it had gone to the price of about 1,000 shillings per share. My bet was that heading in towards the heading into the election, the price, my expectation is that the price was going to double then, but guess what? It didn't happen, so I lost money. And right now, the price stands at about $153 per share. So generally, investing is risk, and everything is a possibility. So with that short story, I would like to go ahead and welcome the panelists. I'll start off with Josephine Nachitende, the financial accountant at NSSF. So I'll give her a chance also to introduce herself. We have Cindy Kukunda, the investment manager at ICA. And lastly, Charles Omol, an investment manager at Gen Africa.
Thank you, George, for that brief introduction. As you have rightly stated, my name is Nachitende Josephine. I am a financial accountant at NSSF. I am also an ACCA and CFA charter holder, so I know my numbers. But before we delve into the topic, I just wanted to speak a bit about what NSSF does in the space of private equity. NSSF, because most of my colleagues who have been up here have been saying that we should provide funding, and we do welcome collaboration, but NSSF is the only pension fund in East Africa which has actually gone a step further
in providing funding to so many private entities. And we do this through a program called High Innovator Program. It's a collaboration with NSSF and MasterCard Foundation, and we do this through our implementing partner, Outbox. My colleagues are there seated at the table. But what we majorly do in this space is basically to train, provide funding, and also ensure that there are realized jobs from these platforms. So in that space, we have provided over 30,000 training to so many young people. We have funded over 340 businesses and provided over 170 jobs. So I just wanted to just sneak that in there. I know the topic is not related to that, but I just wanted to sneak that in there for you to know, and we welcome any partners that would like to work with us. Thank you.
Thank you, Josephine. So we'll dive straight into it, and given that you're the first speaker, I would like you to address a question in relation to social media. So how do you think that social media has influenced the financial education of the Gen Zs in this market in particular?
Thank you. So if I was to look at that topic and to look at what it is, we all understand Gen Zs, the generation that has grown up with a mobile phone in their hands. And as Alan said, I know this topic is going to be very exciting for most of us here because he said it's a very young audience. So I hope we can take some notes after this. But that generation basically has grown up with a mobile phone in their hands, and through that, they've actually been exposed to a lot. They've had a lot of exposure, and studies have shown that the exposure has become related to investing towards around after COVID-19, where most of us were spending loads of time on our phones. So after COVID-19, around 2021, we saw a lot of investment coming from the Gen Zs. And in Uganda, if you could say, I know so many Ugandans, young Ugandans have delved into forex trading. I don't know if sports betting is investing, but it's still as a result of social media. So on the good side, social media has actually opened up so many of our young people's eyes. It has given them exposure. It has given them information that they would otherwise not have. And through following their influencers who talk about these platforms and these stocks and these different asset classes, they're able to also actually try out and invest in them. So on the upside, I believe it has actually influenced them positively, because our education curriculum doesn't really provide a lot of financial literacy and financial education. So it's a good thing. Although on the flip side, it has actually not been regulated. It's not regulated. Anyone can become a fan influencer. And studies have shown that most of them don't even have a degree, but they'll go ahead to provide things like courses. So so many Gen Zs have been exposed to scams. They have lost their money, and when a influencer goes ahead and tells them about an investment, they will not disclose that they are being paid to actually push this particular asset that they are pushing. So there are risks to that, and I think it's an opportunity for us as young financial advisors to actually go ahead and get on these platforms, because we ascribe to a higher level of standards, and we will be able to provide more viable information to them. So, yeah, thank you.
Thank you. And just as you mentioned, is that through social media, the Gen Zs are exposed to various asset classes. And I think one of them is cryptocurrencies, which is also considered to be an alternative investment for some of the international institutions and also institutions within the country. With that said, I would like to ask Charles here, and what do you think drives the interests of the Gen Zs in investing in cryptocurrencies? And do you reckon that the risk appetite is also considered when they are making these decisions?
Thank you, George.
Some of the key drivers, at least I have seen, have come from social media. We noticed that during the lockdown period, there were a lot of, when people were at home, people were stuck at home. In some countries, we have a lot of fiscal stimulus. There was a lot of money in the economy. People had, with nothing much to do, started to develop an interest in investing. And crypto was one of those markets that greatly benefited. On top of that, there's so many platforms that have opened up. You know them. You have Binance. You have things that are now defunct like FTX. Even the more established brokers like Interactive Brokers have also increased access to trade and participate in this particular asset class. So awash with all these opportunities and a bit of cash and social media influence, like Josephine mentioned, Gen Zs have started to go in big numbers. Gen Zs being a young demographic, are also influenced a lot by short-term, I'd say, financial goals. Things like someone wants to make some money to be able to travel in the next year or so, or to have some supplementary income, because usually at that age, salaries are low if you have a job. So with that in mind, it also causes them to have an abnormally high risk appetite, in my point of view.
Do you think the returns are commensurate with the risk related to crypto?
The risk return sort of interaction with crypto, my personal view is I don't feel it is appropriate for most people, most investors, most Gen Zs, because it's sometimes quite asymmetric, depending on what vehicles are chosen, what particular cryptos, where they invest, which platform is used. All those factors come into play. Maybe I'd like to highlight something like the fact that crypto is often unregulated. So going in, you know, you don't have someone watching your back. There's no government entity that will provide recourse if something goes wrong. We have seen a number of meltdowns over the years. I think the biggest recent one was the demise of FTX platform. But even before that, a number of crypto exchanges either have been hacked or there is fraud within, and your investment disappears. With that in mind, looking at the characteristics of crypto as an asset, we as financial markets practitioners and professionals, we don't even know what kind of asset it is, if we are being honest. Is it a currency? Is it a commodity? Is it really a store of value, or digital gold as it's often touted? I don't think so, because of all the volatility and all the risks therein. Having said that, and with the view that, okay, this is a speculative asset, and we have all agreed that it should be handled a bit more responsibly, I still believe that it could still have a place in our investment portfolios as individuals, provided we take certain considerations first, chief of which is your risk appetite. To measure risk appetite, there's what they call the sleep test. If you have an investment, one asset, and you cannot sleep well at night, get out of it. Just don't bother. Don't look at numbers. Don't look at history, the financial metrics. Leave that stuff. Get something you feel you can handle. In line with that, we need to, if at all you've chosen to go into this asset class, position sizing is extremely important, given how risky it is, from one, the lack of protection and regulation if something goes wrong, and to the nature of the asset itself. Position sizing is extremely important. Do not put your entirety of your net worth into an asset like this. My advice would be, first start with a solid base. That would be the responsible thing to do. Take advantage of the numerous opportunities and assets that we are now lucky to benefit from. Take advantage of traditional assets first. Things like unit trusts, money market funds, fixed income funds. It sounds boring, but someone gives you a return of 13%. You are sleeping the whole year. It's a miracle of finance. We shouldn't take it for granted. Build that foundation and then have some capital you can risk into something riskier like crypto. And for God's sake, don't borrow to invest in an asset like crypto. Crypto being volatile as it is, we've seen drawdowns of even 80%. Making an investment within this space shouldn't mean that if it goes bad, now you have to go back to the village. So appropriate sizing is important, and just be a responsible investor. Start from, I would say, foundation of the traditional asset classes, and then build up from there. Add risk as you go. The advantage with it is you can get in even with smaller amounts of capital because of something called fractional trading. You can get a piece of a Bitcoin instead of owning the whole thing, and you still benefit from upward movement. But I advocate for responsibility. Thank you.
Thank you, Charles. And just as you've mentioned, someone should conduct a sleep test in relation to the risks that they're facing. But there's also that concept of the fear of missing out that causes people sleepless nights. So, Cindy, how do you think the fear of missing out, FOMO, affects the Gen Zs in relation to investing, especially if they are witnessing exponential rises in some of these asset classes like cryptocurrencies?
Thank you. So mainly in regards to FOMO, so we find people fearing to miss out on potential gains and experiences, so they act irrationally. So basically FOMO is something that's psychological, an impulse. You're just diving into something you haven't done enough research on, you have no risk management strategies for that investment vehicle. So I'll start off with an interesting survey that was done by Deloitte, and it covered 22,000 people. Those are Gen Zs and millennials, and more than half of them were saying that they live paycheck to paycheck. I know most of us here can relate to that, and they find themselves having to take on a second job in order to cover the costs. So such things drive people to act on FOMO, and this affects the investors' decisions significantly. So one of the main ways is they end up holding on to losing positions. They are taking on market risks that they haven't done research on. They're affected by market volatility. They have no regards of understanding exactly what they've invested in. So you find them really exposed to significant losses because of FOMO. And it's also interesting to know that in the UK and both UK and the US, that's where the statistics are. Here in Uganda, not much that I could get, but it shows that most Gen Zs and millennials started investing before the age of 21. So you can look back at where you were before in that age, what you were doing then, whether you knew about these financial assets, but for them it's happening. They are more financial savvy, and they're challenging the norms of traditional ways of making money. There are influencers coming up. Before you know it, they'll start looking for the PE firms to invest in them in order to earn a return. So in a nutshell, it's very key for them to be responsible when they decide to act on FOMO. They need to have a long-term mindset when they decide to follow the bandwagon. Like, where is this going? How does this look for my retirement? Am I just in it for just short-term gains? So with social media, there's a lot of people acting on FOMO and being influenced with the kind of lifestyles they're seeing. And you see a celebrity enjoying themselves in the Bahamas, you do not know how they got there. They might be financing it upon a bank loan. And these are the things that they don't see. So FOMO is real, and the main answer to this is it will lead to less diversified portfolios and exposure to significant losses for the Gen Zs. So I think that's it. Yeah?
Thank you, Cindy. And then this leads us to the final aspect before we ask the audience for questions. In terms of family, I'll start with you, Charles. How do you think family is still a trusted source of financial advice for the Gen Z?
Yes, I do think family is a trusted source for financial advice for this particular demographic. Studies have shown that in terms of sources of information that they trust, the Gen Zs defer to family before they get to even professionals. So it is a very important source of knowledge, a source of information. Perhaps I would also advocate for the older generations, the millennials and Gen Y in the room. For those that have youngsters in your lives, please teach, share experiences and knowledge. We are in a world where there's an information overload, and some of the sources of information that the Gen Z generation normally interacts with, social media particularly, is full of misinformation. So it's important for the older generations to come in, share, befriend these guys, and sort of panel beat and allow them to grow into more responsible investors. Another form of support, I guess, could be in terms of some seed investment. If you have a kid maybe who has just finished university, as opposed to a grand graduation party, give that guy some money to do his first investment. Thank you.
Thank you, Charles. Josephine?
Family is actually very important, because if you look at the Gen Zs, they don't have a lot of experience. So they will tend to believe and trust what their elders tell them and what their family tells them. So, which also now, as Charles has alluded, calls to us to have information. And if you have someone younger who wants to invest, they will look up to you. Much as they have like 4 social media accounts and sources where they get information from, most of the time, more likely than not, before they actually put their money in an investment, they will ask someone older than them or someone who's in their family to actually give them advice. So, and they trust that advice because they trust you as a person. So it's quite important, and it's a trusted source for information for them. So we also need to read up and get to know these different, even if crypto is spoken about as a worldwide west, as everyone says, you need to arm yourself with information about it, because it may not be all bad, and this kid is going to invest in it, but they need to know the risks that come with it. If they're going to do forex trading, studies have shown that people who do forex trading actually fail the sleep test. They usually check their apps at like 27 times in an hour. So at what point do they sleep? So before someone goes into that, and if they have that information, it would be very helpful to them. So yeah, family is quite important, and it's a trusted source.
Thank you, Josephine. Cindy, your thoughts on the topic?
So my thoughts on family is kids really pick off a lot from their parents. I have a toddler and she does exactly what I do. She really looks up to me. So the answer is yes, family is the most trusted source of financial advice, and they're feeding off from the decisions that we make. If you are a father out there with so much debt and you're careless, trust me, that's what they're picking up. So it's important to know that it's family first, and then financial advisors follow closely when it comes to the most trusted source of advice. So the way forward to treat the FOMO is you have to guide them to stick to a budget, not to let this lifestyle creep come in. I mean, you find yourself in a group of, hey, holiday in Bali, just like that. You haven't planned for that. You're just going to panic and try to look for short ends and ways to make quick money so that you can make it to those trips that your lifestyle can't actually afford. You're living beyond your means. So it's always good to stick to the budget, and it's also good to start them off early. Let them start saving early. The earlier the better. And it's good to keep your eyes on the goal. The long-term goal is retirement, not this short-term enjoyment. And then the financial apps is something to encourage. There are so many apps out there that do portfolio simulations, interactive brokers that show you the 10-year average return, the kind of risk you're taking on before the Gen Z actually gets into that investment venture. So yeah, basically that's what I can say on family. We need to be responsible when it comes to acting on social media, and also not to forget the mental impact that it has on the Gen Zs. It's some of them find themselves isolating themselves because of the success stories that they're seeing. Someone has made quick money, but they don't know the real truth behind that story. So it's affecting some people mentally, but on the good side, it's boosting confidence for others. It's giving them a sense of belonging, and it's taking them to the next level. So it's important from the family perspective to really be key on our mental health when it comes to social media and following up on FOMO. So those are my 2 cents. Thank you.
Thank you. At this point, we'd like to welcome some questions from the crowd, if there are any. From the audience, sorry. Yeah.
Thank you, George, and the rest of the panel for an engaging and exciting discussion. You've spoken a lot about, first of all, my name is John Okumu, Director of the Board of the CFA Society East Africa, Director at EY as well. We've spoken a lot about FOMO as pertains to investing, but with Gen Zs, and not just Gen Zs, millennials as well, there's a lot of life FOMO as well. Right? So as someone that identifies as a Gen Z myself, these days it's how you identify. So as someone who identifies as a Gen Z, how can you convince me, right, to save or invest the little money that I get? Maybe it's my first job. I've been working for a couple of years. I see my friends going to Bali, the Bahamas, Zanzibar on holiday, my friends. So this is not FOMO that's far removed, but it's FOMO, my everyday circle. How do you convince me to think long term and invest that money and forgo this trip that I know I'll get likes on Instagram, which obviously will gratify me. I'll feel good for a bit. How do you convince me to hold off on this, invest in a return that might never come, at a period that might never come for me because I might die tomorrow or something. And that's a question for the entire panel.
Thank you. We'll take 2 more questions. There's one here.
Some haters on my table are saying I'm not a Gen Z, but so my name is Kampala Mwesigwa from Absa Bank. I think as Gen Zs, we live in a 30-second time scale. Everything is 30 seconds. Anything more than 30 seconds, you've really lost us. So how are you guys going to fit your financial advice into 30 seconds? Because that is where we are deriving our FOMO from. I know Cristiano Ronaldo is advertising Binance, and 30 seconds is all it takes. So how are you guys addressing us in 30 seconds? Thanks.
So I'll start off with the first question. Oh, there's one more. Okay.
One of the things I've noticed with Gen Z is, they want high returns quickly. How do we encourage them, or what funds can we create for? Is it possible to create a fund where someone can invest, with their little money and take advantage of the alternative investments? Because most of these investments are targeting big funds. They are. How do we get these Gen Zs to invest? Because they want fast returns. If we're talking about 10x return, how can we create vehicles for them so that they can benefit from these alternative investments?
Thank you. Cindy.
Okay, so starting off with those who are tempted to go to Bali when they can't afford and they want quick money. One thing you should know is clean money does not make noise. Like, seriously, it doesn't. So how to address that is you have to have discipline. The word is budget, and don't let the lifestyle creep in. So there's a rule you could follow of 50, 30, 20, where you have 50% going to your essentials, then there's 30% to enjoyment. It's very important. And then maybe 20% is going into investments. So what's key to note here is always plan for those enjoyments. If you're going to Bali, what's your budget? Or are you someone for Bali or you're someone for ginger? Like, know your level, eh? Yes, and sometimes it's also good to buy yourself something to spoil yourself once in a while. When you taste that good life, it drives you to go and look for money. So to avoid them from panicking, the word is budget, and have some money set aside, 10 to 20% in investments, and emphasize on enjoyment and not to breach that. I hope that resonates with you.
Thank you. Josephine, the 30-second question.
Thank you, George. I think this is TikTok. The gentleman over there, you must have a lot of TikTok. But you're right. You are absolutely right. And this calls that for all financial advisors, if you do want to get this generation, the Gen Zs, as your customers, you actually have to have a high social media presence, because that's what they resonate to. They're not going to read your investment papers. They're not going to read your 50-page document that you have spent a lot of time putting together because an IPO is coming through. They're not going to read that, but they will watch a 30-second video. And I think if you think about it, MTN actually did it successfully. They really, really pushed their stock when it was coming through, and so many people bought. They made it so easy for people to buy, and social media adverts were going out. They got all the partners that they could use to actually push their IPO before it actually went into the market. So it's doable. If someone can show you how to cook a recipe in 30 seconds. I think I can tell you about a bond in 30 seconds. So it's possible. We just need to start and do it. Thank you.
Thank you, Josephine. I'll let Charles address the question of convincing the Gen Zs to invest in the traditional investment opportunities that offer lower returns compared to the high returns promised by some of these other asset classes.
On the issue of 10x returns, I guess for us as maybe a challenge to us as some of the fund managers in the market, a challenge for us could be to come up with some funds that offer a higher risk exposure, but within the context of professional management. I'll give a couple of examples. We could do some specialist, maybe non-balanced funds. We could start with something as simple as an equity fund, and then have a strategy that is a bit more risk-seeking. That way, someone as uninformed as many people normally are, simply knows, these guys, they have my money, they are the experts, let me put in money and see what happens after a year. The collective investment scheme platform, for me, would be the way to achieve this. I know some discussions are also going on around how to utilize that structure for alternatives. Some heads are being put together, but I think something positive will come out of that. I'll close by saying for the non-Gen Zers in the room, or the older generation, we also need to impart some life skills in the younger generation. Issues such as formal and instant gratification is not, they're not problems specific to that younger generation. These are things that affect a number of people throughout life. We know that the fact is that quick returns and quick gains are unsustainable. There's nothing in life like that. So I think the onus is upon us to instill some of these skills as we look for more responsible interventions. Thank you.
Any closing remarks from Cindy, Josephine?
Well, my closing remarks is technology, AI, robotics are here to stay. They're not going anywhere. We'll embrace them and make the most out of them to our advantage. And keep in mind the person that's working for the company that's using AI will replace the company that's not using this AI and these financial options. So being tech savvy is the way to go. It's not going anywhere. We just have to make it work for the Gen Zs and the millennials and the Gen, which other Gen is it? Gen Y? Gen X, yes, the very old ones. Yeah. Okay. Apologies, I'm nearly there. So yeah, those are my 2 cents. It's here to stay. Social media is here to stay. Let's embrace it. Let's not fight it. Thank you so much for listening.
My closing remark would be for us to get out of our shells. You know, we like to sit in our suits, in our AC offices, and we're actually not making that much money. There's a lot of money out there. This is a niche that we should take advantage of. These young people are getting into the workforce. They have money. They have goals. If someone wants to go to Bali or to Ginger, as Cindy suggested, you can actually advise them and push them towards that goal, and you have all the knowledge. So don't just sit with it. You can share it. Of course, you have to make sure you don't lose your charter in the process with pumping a certain asset class, but get out of your comfort zone. You can actually do it professionally. I have seen people who do it, and we have customers out there for us. So let's just get out there. Thank you.
Thank you, Josephine. I think we deserve A round of applause. And some gift hampers from the MCs, because we've saved you about 11 minutes of your time. So thank you.
My name is Admasu Tadessa. I'm the TDB Group President and Managing Director. And TDB Group is a multilateral African financial institution. We cover about half the continent, some 25 countries, but have a much larger shareholding base of about 46 different shareholders, combination of sovereigns and institutional investors. TDB Group has entered the asset management space some 7 or so years back. We moved into that sector, so to speak, with the view to building up special purpose funds that would have specific focus areas. So we have a fairly mature trade finance fund, which we launched just about 5 years ago. It's been running for that period of time. It's been a successful fund. We've got just soon $200 million of assets under management in that particular fund. And we are considering several other new funds that would be specialized in specific segments. It's too soon to announce it, but yeah, we have some exciting thematic funds that are under construction, so that should come out in the next 6 to 12 months. But it's on the back of a successful run we've had with the trade finance. The trade finance asset class is distinctly different from many of the longer term asset classes you'd have, whether it's private equity or debt. Because of the nature of trade finance, it tends to be short-dated liabilities. And so we've tended to have a very strong positioning in trade finance over the years. And then we realized that with the good track record we had as a bank, doing this as our bread and butter for many years, we set up a special purpose vehicle so that we can do more on the basis of our experience from track record, but using capital from other partners and investors. And so our trade finance fund is about 5 years old. It's soon going to be $200 million of assets under management. It's not very big at the moment, but it's done very well. It's had a very strong record in terms of performance. Its return on capital has just exceeded the 10% mark for the last 12-month period. And for a short-dated trade finance fund, it's very compelling, that kind of return profile. And so it's been a very good story. Non-performing loans are way below 1%. And that's also been a very healthy aspect of the track record of the fund. And so we've been very happy with it, and we're looking to grow it out further. We have some very strong partners already in the fund. Mauritian banks here in Mauritius, of course, have been part of the fund, but we also have banks out of the Gulf region that are also very strongly invested in the fund, alongside ourselves, of course, as TDB Group. TDB Group is a diversified financial institution. We're diversified geographically, we're diversified in terms of asset class, and also diversified in terms of shareholding and management and staff. And so the value proposition is very much linked to that diversification. And then, of course, we have the track record that goes with an institution that's been 14 years or so in existence. And our last 10 years have been very good years. And we feel that the future has a lot of promise for us. We've been growing our shareholder community, but also our funding sources have diversified and gone global. We're active all over the world, whether it's the US or Europe, as well as Japan, China, the Gulf region very much so, and all across the African continent, all the 5 regions of Africa as well. And so we've got a very good footprint, both in terms of our loan assets, where we've actually generated and originated the business and the actual asset base, but very much on the funding and the equity and shareholding side as well. So that spells a lot of promise for somebody who knows the sector. It's very healthy to have that kind of representation, to have access to multiple possibilities of originating business, but also funding the business and growing the shareholder community. That I think is the value proposition that makes a great deal. And of course, in the final analysis, we are a treaty-based body, so we do have the benefit of being a multilateral that has immunities and privileges and very strong relationships in all the jurisdictions where we do business. That puts us in a very strong position to be able to manage the risks in the markets that we operate in, as well as to find good deal flow at the same time. You know, sovereign institutional investors have become a very important segment of our investor community, especially over the past 10 years. They've come into our capital base in addition to being regular participants in our bond issuances. And so we're really pleased that we've established a very robust track record with institutional investors from the sovereign domain, of course, as well as the non-sovereign domain as well. They have, of course, come in and contributed to our risk capital, but also on the debt side. They've also supported our debt origination efforts, and we've managed to grow our balance sheet to over $10 billion at the moment on the back of strong participation in our various issuances and private placements that we've had in the marketplace. And so we have several sovereign wealth funds, pension funds, insurance companies, reinsurance companies, and other specialized financial institutions who have come into TDB Group and joined the other shareholders in establishing a strong foundation for our risk capital, on the basis of which to leverage on the through credit and other instruments and other ways of scaling up. And so it's been a great story. Today we count at least 20 institutional investors in our shareholder community. If I go back 10 years, I would struggle to count more than one. And so we've come a long way with sovereign institutional investors and also other institutional investors, and it's been a great story. And we've actually managed to demonstrate the potential of getting African capital to work successfully on a collectivized basis through a very professional and committed financial institution model.
The CMA, PKF, and all other partners, the USE, Gen Africa, and all our good partners. Thank you very much. We'd also like to thank the previous panel, Gen Zs. Gen Zs have their money and their unique goals going to Bali and not Ginger. And FOMO and all that. We're very grateful for that panel. We are going to have two panels before our lunch who are going to speak to some of these changes in our demographics and also asset classes. The next panel is going to look at commercial real estate, and to moderate this panel is Eska Namirembe. Eska is currently serving as an investment manager at Gen Africa Asset Managers Uganda Limited, and she's a seasoned professional in the banking and asset management industry in Uganda. Eska is officially our first female moderator today, so I expect a thunderous round of applause for her. Eska will introduce her panel. There'll be, I believe, one person joining us virtually. Eska, over to you.
Thank you for the introduction. As introduced, my name is Eska Namirembe, and on the panel today, we shall be discussing opportunities in commercial real estate. So I'll be joined by three individuals. One of us will be online I don't know if she's on already, but I'll start off by introducing the members who are here. I'll start by introducing David Mwaura from Bora Africa, and Matthew Rukari from NSSF Uganda. So as they come on, I'll be checking to see if Michelle Wanjiku from Acorn Holdings is online. So as we wait for Michelle to join us, I will ask David to introduce himself and Bora Africa as well.
Thank you, Eska. Hello, everyone. My name is David Moura. I'm a board member of the CFA Society of East Africa, and my day job is at a fund called Bora Africa, where I'm the finance director. So Bora Africa is a private fund. We invest in industrial real estate all across Africa. We are a subsidiary of a company called the GREAT Group, the GREAT Real Estate Income Group, which is actually a company that is listed on the London Stock Exchange and also listed in Mauritius. But at Bora Africa, we are private and we invest in real estate all across Africa. So industrial real estate, by that I mean we'll invest in logistics centers, we'll invest in factories, we'll invest in big warehouses, we'll invest in data centers, and also we'll invest in BPO facilities, business process outsourcing facilities. Thank you.
Thank you, David. Most of us in this room are, aware of NSSF Uganda, but I'll still ask Matthew, who is in charge of the real estate. He's a portfolio manager under the real estate arm of NSSF, to just briefly introduce NSSF Uganda to the members in the room who are not familiar with it.
Thank you, Eska. Good afternoon, everyone. Gen Zs. Good afternoon, everyone. Thank you. My name is Matthew Rukari. I'm a portfolio manager on the real estate desk at the National Social Security Fund. For those that don't know, and I don't think there are many that don't know, because our Kenyan friends also have NSSF back there. But for those that don't know, NSSF is a provident fund. It's a collective investment fund that collects pension money. It's a defined contribution fund that collects investment money, has the mandate to invest that money over the life of someone's working life, and at retirement, give that person a lump sum payout. So we obviously invest in the traditional asset classes, equities, fixed income, and real estate, and the non-traditional, which is the theme of this conference, the alternative asset classes. Broadly speaking, our portfolio is about 20.7 trillion assets under management as of the last quarter. About 79.1% of that is in fixed income, which is government paper across the East African region. About 13.8% is in equities. So that's public equities and private equity. Our breakdown of that equities space is 90-10. So it's 90% of that 13.8 trillion is listed equities, and 10% of that 13.8 trillion is in private equity, which is TDB Bank, TPS Serena, HFB Bank. Some people don't know we have almost 51% shares in Housing Finance Bank. And the Yield Fund, David Wangolo was here in the morning. We have a portion of money that he manages. So my role in the investment department is I'm a portfolio manager on the real estate desk. So yes, early in my career, I was a valuer. So I was the guy taking pictures of houses and walking around sites with a tape measure. And like many of you, at some point, I felt it prudent to begin my CFA journey because I felt valuers in our space were lacking in their knowledge of the alternatives in the investment universe. Besides real estate, what do the financial assets have to offer? I felt to be a truly well-rounded investment professional, you need to understand both the financial assets and the real estate assets. Hence my foray into the CFA program. So that's it now.
So thank you, Matthew. I'll start with you. I think everyone in this room is a member of the NSSF fund. Okay, the Ugandans at least.
We hope so.
Are members of the NSSF fund. So at least we know your investor base. It's us, the regular employees in different companies. What I would like to understand more is that in the real estate portfolio for NSSF, what is the breakdown? Because we do know that there is residential properties, there is office space as well, but I would like to know what is the breakdown between the two, and what does the return look like overall when you look at your entire portfolio?
Okay, so I didn't give you the allocation to real estate. The allocation to real estate presently is 7.1%. And most people in this room will know that a pension fund is placed in the category of conservative investor, right? That it's prudent to have your strategic asset allocation skewed towards lower risk assets. Now, real estate is put in the bucket of slightly higher risk than traditional asset classes. Although we can have an argument, a debate after this conference about real estate versus public equities. Which one over the last 10 years has been truly high risk? Because if we go back to the definition of a deep market is one with many buyers and sellers, right? Right? Yeah, so there's price discovery because there are many participants in the market. There are many people on the buy side and on the sell side. Our stock exchange, does our stock exchange have many buyers and sellers? And if it doesn't, then what's the true risk exposure if you put your money in Stanbic Bank? Something to think about after here. So to go back to your question, the 7.1% represents about 1.4 trillion. Within that 1.4 trillion is what we call investment property and work in progress. So investment property is defined as property you hold for either capital gains or income yield or both. So workers' house, for example, is an asset within the investment property bucket. We hold it for rental income, so rental yield, and every year, perhaps a capital gain. So every year, valuers come and tell us if there was any capital gain or loss. So within the investment properties space, you'll have workers' house, you'll have Temangalo land, Nsimbe land, you'll have social security house. That makes up about 900 billion of the 1.4. The rest is what we call work in progress, your capital investment in ongoing projects. Because real estate, unlike a bond, Muhammad will just buy a bond of 100 billion and that's it, invested. My 100 billion investment will come throughout a multi-year period. So in the work in progress bucket, you'll have Pension Towers, which is that tall building on Lumumba Avenue. You'll have Temangalo houses, 550 houses being built right now. You'll have Chanja houses, about 130 houses being built. You'll have a small commercial complex in Mbale. So that will be about 500 billion right now. So the return that real estate contributes to the overall portfolio will come from the investment properties. And over the last 10 years or so, real estate return, again, because the bulk of it, for the longest time, has been vacant land, which is also an investment property, but now its contribution to your return is capital gain. And capital gain is a function of your valuations every year, and your valuations every year are conservative, right? 5 to 8%. So overall, the real estate portfolio will have about 8% return presently. But once you convert that work in progress into actual investment properties, that return will now start to touch the double digits. Not quite at the same level as your fixed income, but I think we can all agree risk-free investments shouldn't be giving you 15, 16%. So yes, that's where we are.
Thank you, Matthew. I think we shall come back to that discussion on the return vis-a-vis what we earn on our government bonds currently. I'll move to David. So for NSSF, we know the investor base. It's us here in the room. What is the investor base for Bora Africa? Who invests with you?
Yeah, thank you. So currently, our investor base will be the DFIs. That's our primary investors. So we do have, the usual names that all of you guys are aware of. We have indeed tried to raise money from the local pension funds and institutional money all across the region, which has been a bit difficult, for various reasons, including the regulatory environment. But it's something that we are really, really working on. We are trying to raise this institutional money, specifically private capital from the likes of NSSF in Kenya, in Uganda, and across the whole region.
Thank you. So in the past, you've been doing this, I think, for a minute. So say Matthew is interested in the products that you have to offer, and he wants to know what the return has been. Could you give us a range in what it has historically been and what he should expect it to be going forward if he was to get a portion of that and invest with you?
Yes. So when it comes to returns, as Matthew mentioned, there is your income return, which is the cash flow that you actually get from the properties earning rent, and then there's your valuation gain. But just before I talk about numbers, I want to go into a bit of the profile. So the beauty of investing across several jurisdictions is that you spread your risk. So rather than having all of your geographical risk in one country, say in Uganda, if you're investing all across Africa, so for example, we have properties in Mozambique, we have properties in Nigeria, we have in Kenya, we have in Ghana, all across the continent. The beauty of that is that it spreads out your risk. So when one country is having problems, another country is actually doing very well. So that means that even if you have properties in that country that is having problems, it's sort of compensated by the other properties in the other countries which are doing well. So that really, really helps your returns. And then the other critical thing for our fund is that we are a hard currency fund. So we choose our tenants very carefully because we only do leases in hard currency, that is dollars and euros. So our typical tenant is a multinational, a big company which is actually able to have access to that foreign currency. So regardless of how the currency goes, I'm sure you guys saw what happened with the Kenyan shilling last year and part of this year. Regardless of how the currency goes, you're able to generate a strong return because you're still earning your rent in dollars. So basically factoring in all that, we are looking at a return of 10 to 12% in dollars, not in local currency, in dollars, which is, and I think Matthew will agree, a much stronger return than what you mentioned.
Well, again, sorry. It's what I mentioned was the portfolio return. Again, within the portfolio, you'll have the individual performance of, let's say, our Mbuya project, built for 17 billion, launched in December 2019, sold within the 2 years of COVID to get 26 billion. That's a 52% yield. Now, because you built over a number of years and sold over maybe 2 years, IRR will come to about 16, 17%, right? So again, so our total portfolio return for real estate is dragged down by the fact that we have 550 acres in Luboa. And its contribution to your return is what the valuer says the per acre valuation has changed by.
Okay. I get you. So Matthew, NSSF having been in this space for quite some time, it has built quite the experience. As a fund manager, we work with quite a number of pension funds that want to enter the property space. They don't have the same, should I say, financial power that NSSF has. What advice or what pointers would you give trustees in this room who would like their pension funds to venture into property?
I happen to be one of the trustees for our staff provident fund. So I've had the opportunity to see reports from different fund managers. And I don't know if by show of hands, how many fund managers here have some exposure to real estate? Your fund invests in some real estate. Okay, that's one. So most reports I've seen have 0% allocation to real estate. So much for diversification, right? We studied the CFA hard, and we are violating the first principle of prudent investing, which is to diversify your money across different asset classes. So the question I have for all of you is what are we waiting for? Let's say, I understand, are you waiting for the vehicles that will give you indirect exposure to real estate? Or should you be the ones that are creating those vehicles? Should you be the ones that are going out? If let's accept that you do not have the expertise to directly build 40 apartments, granted. But go find someone that doesn't have the expertise to structure a financial product. Walk up to them and tell them that your capital structure for the funding of this project is inefficient for the following reasons. You're borrowing from the bank at 19-20%. You shouldn't be, right? This is how you should structure. Let's say you have a the Mbuya project. Your total development cost is going to be 17 billion. How do you intend to finance that? Demonstrate to him why his plan is suboptimal and how you can bring in private capital from somewhere that will supercharge his returns and give him a better overall return. So my advice is go out and find credible developers and sell them on the dream of efficiently raising capital for successful, what you believe will be successful products. Now the next question then becomes, how do I know if those apartments will sell within the 2-year period that I've forecasted? That's when you also go and invest in professionals that will give you insight into the performance of the market. So your only job is to ask the right questions. So let's say you have a Knight Frank coming or a Bagene, whoever, a professional in the real estate space, and you ask him, I have a project, I'm doing a feasibility, this is the description of the project, this is the location, I need to understand the probability of success for the offtake of this project. So then deeper questions. What has been the absorption rate for products that are priced between 200 and 600 million shillings? Have him go answer the question about absorption rates, about the actual realized sales prices, not the listed sales prices. I want to know what the performance of Mirembe Villas actually was, of Pearl Capital, of Pearl Marina in Garugo. I want to know what the performance of that project I drove by in in Kololo. I had apartments are selling for $300,000. I need to confirm that. So ask him very specific questions that he has to answer. Then you come back and you do what you do best, which is come up with the financial models. You input assumptions on the absorption rates that you've been given by the professional in the field. You input the costs that have been given by another professional, that's the quantity surveyor. So your only job is to gather all the professionals in the room, ask them the right questions, and then do the due diligence on paper.
Thank you, Matthew. I think this topic on property would go on and on and on. I would like to open it up to the audience for those who have questions for David and for Matthew to be able to bring them forth at this point.
Steve Uganda is my name from West Africa. This goes to Matthew on so the discussion around allocation to real estate for the other pension funds could be that they don't necessarily have appetite for development risk, but myself having had that experience, then it would be the need in terms of them rolling out these projects and getting their pension funds as takers. Then initially they build a portfolio just based on yield before then being property developers. But I think it's also important for away from just focus on CRE, you're also looking at being a lead in master planned projects, mixed-use projects, focusing on new urban nodes, as opposed to this standalone either CRE or residential or industrial, but basically looking to be a leader in terms of developing new nodes. I don't know that that is part of the focus. Lastly, just around green buildings and how then you intend to position yourself as again a leader in terms of having efficiency for your projects.
Thank you. My name is Gladys. My question is regarding real estate investment trusts. And this will go to both panelists. The first question is, what are your thoughts on REITs? And then my second one is specifically to Matthew, because I think he practices within Uganda. David, I'm sorry, you also practice within Uganda. Feel free to respond as well. What would it take for REITs to succeed in Uganda and in the region as well? Because looking around, we have not been able to make any progress, and yet we know that property there's a high appetite for investment in property, but the price point for individuals to get it, individual investors to get it, is quite high. Thank you.
I don't see any more hands for questions, so I will request Matthew and David to respond to the questions.
Okay, thank you for the questions. I'll just go with the REITs one to begin with. I think REITs are really effective vehicles for real estate investment. We have had a few in Kenya. I practice out of Kenya, although we do invest all across Africa. We have had successful, a few vehicles. Unfortunately, one of them delisted, but we have had successful ones. The other lady who was meant to be on the panel works for Aecon, which, as you guys probably know, have a very successful REIT for student accommodation. So I think the goodwill is there, and I think the opportunities are there. I think the challenge that we've had with REITs is the legislation. There was, there was some talk earlier that, the legislation has been passed for REITs, but it's not necessarily very streamlined. For example, there's this whole split between a development REIT and an income REIT, which might not make a lot of sense, because for a development REIT to make money, it has to develop and then sell. Now, for you to sell, it means you have to have an offtake. You have to have someone willing to buy, and that might take some time. So, for example, what Aecon did in Kenya is that they have their development REIT, which develops the student accommodation, and then they sell it to their other income REIT. So I think that creates additional work, and also it creates a lot of costs in terms of administration of the REIT, and also for compliance. Being listed comes with a lot of compliance costs. So I think just streamlining that legislation so that you can have a REIT that can do both development and income and hold those assets, I think that will make things significantly easier. And when I look at our fund, we are structured like a REIT, although we are not a REIT. But we do both developments, and then we hold those properties and we earn the rental income. So we're not under any pressure to exit and sell. So I think that would significantly help a lot of REITs. I think that would be what it would take. I think let's try streamline our regulations. And also I think for the for people like pension funds who sit on a lot of real estate and banks, I think they should be willing to let go of that, because unfortunately that's not your core business. So they want to hold the real estate on their balance sheet, but managing real estate and building real estate and doing all these things is a lot of work, and it's not part of your core competence. It might be better for you strategically to put those into a REIT and have a professional manage it and do the new development. So I think there also has to be a bit of focus from the people who are holding the assets.
Okay, thank you. I'll start with that last question, since it's part of from Gladys. What would it take for REITs to succeed in Uganda? So, like David mentioned, you have your income REITs and your D REITs. They say your REIT behaves more like an equity asset class, like an equity than real estate. And again, do we want that off the top? Do we want, say hypothetically, you had Workers House, Renzori Towers, Pension Towers, and some other A-class building put in a portfolio, and this REIT is going to distribute 90% or so of the rental income earned to the shareholders of the REIT. Fine, you have that, but remember that your income yields to begin with are not quite in the double digits, right? So for a real estate investor, your total return is a function of income yield plus capital gain. Let's assume for argument's sake my income yield, say let's pick Pension Towers, is at about 8-9%. And every year my capital gain is going to be 3 to 5%, right? So my total return for Workers House will be 12, 13, 14% max. Now, the capital gain portion of that equation is going to be a function of the trading volume of the REIT shares, right? You would hope that they trade quite close to net asset value. But in our market, the traders, in my opinion, my personal opinion, not the fund's opinion, there's not enough trading that's happening that will effectively have a steady upward capital gain of the share price over time, right? But what I do believe that would be successful is the D-REIT, right? Because you guys all have 0% allocation to real estate. If I told you that this is my prospectus for a middle income residential housing project that I'm raising funds for, so far there's a farm in Kenya called Mivida Homes that has been successful with lower middle-ish income housing. So Mivida is a farm that is a combination of Actis the money side of the equation, and a developer called Shapoji, right? So the reason they've been successful in the D-REIT is because their motto is build and sell, just let go, right? And in this part of the world, it's not yet illegal to have accrued interest be yours. Effectively, if you gave me 20% down payment before I finished construction of the house, in a more developed market, the interest accrued on that 20% should be for the buyer of the home. But here, what you're effectively doing is subsidizing the developer. You're giving him cash to build. So, for argument's sake, if he got 100% of the money required to build, do the math for me. What's his IRR? He got 100% of the money. He didn't put down any money. And then he sold the product for 30% more than construction cost. What's his IRR? I don't even know what it is. No? Because he didn't put a single shilling down. He got all the money from the off-taker of the final product, right? So the reason I think a D-REIT would be successful is because, again, you have to be careful with which income class product are you building. The middle income in this country has real buying power, and all focus is on Kampala and Greater Kampala metropolitan area. No one in this room is dreaming of buying a home in Jinja or Arua. All of you want to eventually own a home in Kampala or Greater Kampala. So the demand for product in this region within a certain segment of the income is real. So if you guys went out there and found credible developers, and there are many who built decent products, and you helped them structure something and you sold them on the dream of a more efficient capital structure, right? It would, in my opinion, would be successful. Should NSSF take the lead in structuring a REIT? Should we be one of the investors in the REIT? Perhaps both. Maybe if we took lead in and gave you guys the opportunity to partake in our next Temangalo 2 project, because Temangalo 1 is receiving so much interest. If we initiated Temangalo 2 and sold off plan, perhaps we could invite you. It's now public knowledge that we're building government offices in Bwewaja. We've signed a fantastic deal with the government. For those that don't know, the government pays close to 200 billion every year in rent at locations they don't own across Kampala. If they left Kampala and went to that location would now be making over 200 billion annually. So I'll let you do the math. So perhaps we'll invite some of you at the point we are ready to start constructing to partake in a fantastic commercial project. Thank you.
Thank you, David. Thank you, Matthew.
Sorry, Jessica, sorry. The gentleman spoke about our appetite for development risk. Yes, it's slightly higher than the rest of you because I'm now part of a team back in the office. We have engineers, architects, quantity surveyors, civil engineers. The development team, I'm just one of them, right? So we have a vacant piece of land. Your first task is to come up with the highest and best use. So you're master planning it, you're pricing the product. And yes, we do have mixed use projects. Luvoa, for example, is the master plan for the entire 600 acres is a mixed use project. It has been green certified. It has its own wastewater treatment plant, and that water is recycled, and so many green spaces and things of that nature. And again, people tend to appreciate that. Temangalo as well is going to be green certified. So yes, we're taking a lead we're also exploring alternative technologies that are more efficient than your regular brick and mortar. And yes, we have close to 2,000 vacant acres of land. 490 in Temangalo, 823 in Isimbe. The goal is to master plan all that, and maybe even at some point consider just subdividing, creating titles, creating infrastructure, and having the market come by 25 decimal plots. Why not? Right. Thank you.
Thank you, Matthew. Thank you, David. So what I'm hearing today is that this space, there's actually a lot of potential that I think the people in this room can benefit from. A lot of things to do on the REIT area that we can come together and work on. So that brings us to the end of this session. Thank you so much for being on the panel. We'll have a photo session and then we'll move on to the next item on the agenda. Thank you.
Thank you so much, Eska, David, and Matthew, for the very elaborative discussion on commercial real estate. I think Matthew asked us a very interesting question that sent most of us pondering. And I hope our take home from here is at least let's practice what we preach by reallocating something more than 0% to real estate as an asset class. David also spoke to the importance of diversification as a way of reducing portfolio risk. That is geographical diversification. I'm very cognizant that our time is fast spent, but before we break off for our lunch break, I'd like to invite one last panel for the morning session, even if it's afternoon. And this panel is going to speak about alternative investments as unit trusts for investments for licensed funds. And the session will be moderated by the MC himself, Mr. Samuel Samia. Samuel is the CEO of Goldman Advisory Services. And before that, he worked as the education officer of the Capital Markets Authority. Please allow me welcome Samuel, and I'll ask him to introduce the rest of his members. Thank you.
Thank you very much. Yes, we have the all-important panel of regulators. We're going to have regulators from the Capital Markets Authority and participants in that market as well, and as well as the Uganda Retirement Benefits Authority. Join me in welcoming 4 individuals. Firstly, allow me to invite Benjamin Katende from BRA. Round of applause for him. Lynn Tukey from the Capital Markets Authority. Philip Musinguzi, Zamara. The applause, please. And finally, but in no means least, Godfrey Bukomeko from UAP Old Mutual. Yes, getting us underway. This conversation is really about the industries, the two sectors that feed into each other, which is firstly the retirement benefits sector, and then the capital markets sector that feed into each other. Industry data indicates that there's a demographic transition due to declining fertility rates and increased longevity in Uganda. So we're having an older population with us, which causes certain changes in the market. And we're trying to see how well these two sectors are prepared to deal with this demographic change. At the end of 2023, the retirement benefits sector had about 22 trillion shillings in assets under management, which is about $5.8 billion. Of course, the big player there is NSSF, but there are very many other schemes that have come along the way. Looking at the capital market side, there's about 2.7 trillion in assets under management for collective investment schemes, which are about $700 million. Fund managers have about 5 trillion, which is about 1.3 billion. And then the exchange domestic capitalization comes to about 11 trillion shillings, which is about 2.9 billion. So we're going to talk about whether this is sufficient to realize the kind of Uganda we want. There's a lot of talk about Vision 2040, a middle income country where everyone is doing well financially. And speaking to this, I'm going to ask the panel to each introduce themselves and just react to these statistics. Starting with Benjamin.
Thank you, Sanya. I'm Benjamin Muchiri. I'm head of research and strategy at UBRA. And really, when you hear UBRA, we're just to ensure that members get the best possible outcome. So the approach we take is we question efficiency, we question adequacy, security, coverage. At the end of the day, we want to make sure that even when you make nominal contribution, they are invested, and at the end of the day, you have a good outcome. So the member is at the front of our mind. And when we start raising questions about how best can we drive the agenda of resolving the challenge of old age poverty, we are looking out to see that we get the most profitable mandates. So we have been discussing real estate and all these other options. And really the perspective that we have at UBRA is, regardless of the legal and operational constraints that we have in the sector, we must be mindful about the member. So when we talk about coverage, yes, indeed, the demography shows that we have the youth bulge. So we have so many Ugandans that are graduating into the workforce, and there's potential to get so many Ugandans to make contributions that can turn into investment in the different classes. But the question is, do we have a preposition for value for them? So when we have 10%, 9%, in some discussions I've had in rooms where you have all these CFAs, some things that we can actually do much better than the average return that we get, 10%, 8%. So when you question the 10% and you say, how do we value even the 10%? Are we getting the best, or we could be getting 20%, or we are actually getting less than 10%? So when you tell us that you are giving a return of 20%, we must be confident that it's actually 10% or 20%. So as we look at getting more Ugandans to save for retirement, we at UBRA think that whoever is making that decision to make that saving, we are looking out to make sure that we get a good return. So for now, that's what I can share with you, and I hope we can engage more on this specific on how we see this alternative investments contributing to member outcomes.
Thank you, Benjamin. Over to you, Lynn.
Thank you, Samuel. My name is Lynn Tukey. I am the Communications and Public Relations Manager at the Capital Markets Authority. I just want to speak again to what our mandate is.
The Capital Markets Authority was set up by an Act of Parliament in 1996, and our role is to regulate and develop the capital market space. And to react to what Samuel has raised about the statistics, and you can see, for example, the adult population in Uganda is at 24 million. And yet, when you look at the collective investment schemes, for example, as an avenue for investment, we have only about 131,000 Ugandans investing in unit trusts. And so this begs a question, where are the other 23 or so million Ugandans? And so this is something that we are very passionate about in doing, especially when it comes to investor education. So the Capital Markets Authority has actually looked at all these avenues in terms of the partnerships. For example, Ubra here, there is so much that we can work on in terms of the bank accounts that are opened for the, the 12 million plus Ugandans, for example. How many of those are actually looking at unit trust as an investment avenue? And so our role is to basically create that awareness, especially when it comes to collective investment schemes, as a safe avenue for investments. And so ours is to tap into such forums where we can actually be able to spread the word and work with, for example, the CFA Society to make sure that this is taken to the everyday Ugandan, but also it starts with the corporates here, because I can also see that many of us would not have known about the many advantages of collective investment schemes had we not been a party to one or two comrades in this space, for example. So there is a lot of awareness to be done, especially in the investment space. And it's not all gloom, because we have also seen the fund managers rising in number from, for example, 2 to 6 currently, and many of them are represented here. And so this is just a wake-up call to say there is so much to be tapped into. And so as the Capital Markets Authority, not just looking at the investment avenues available for individuals, but also what are the capital raising options. And I'm glad that the theme today is all about private capital. How can we again work together? And you have heard from the different funds that have spoken before the panels, and these are people, or these are what we have to regulate, and we are putting the regulatory framework in place, as you heard from the keynote address given by the director Dixon Sembia, who has actually shown our commitment to actually make sure that the regulatory framework is strengthened. So there is a lot of thriving in terms of the private capital space as well.
Thank you very much, Lynn. Philip, I'm going to ask you to introduce yourself, but at the same time, I want you to speak to what you see in the sector. Do you feel empowered enough by the regulator? It's a good time to have a heart-to-heart. Maybe you could just speak to that as well.
Thank you. Thank you very much, Sam, and good afternoon to the attendees in the room. My name is Philip Musinguzi, just as has been mentioned while I was being introduced. I work for an organization called Zamara Actuaries, Administrators and Consultants Uganda Limited, and our job at Zamara is to primarily undertake administrative work for most of the pension funds within Uganda, but we also have spread outside Uganda. To come to your question, particularly, Sam, and just to start off by reacting to the statistics that you've just given, before I can dive into the actual heart of the matter that you asked me to speak to. The statistics that you give paint a very positive picture. You've mentioned that the retirement benefit sector has grown from 20 trillion to 22 trillion. The assets under management by most of the fund managers in this room have grown to about 5 trillion from 4.8 trillion. That's within a space of 3 months. The CISs under the unit trusts have also continued to grow. Other statistics suggest that there's been a growth in the circle space. I was looking at a headline just recently, and the headline was saying that the circles have reached 33,000 So what does this all mean? This basically means that the savings culture within us as Ugandans has improved. There's been a lot of financial literacy that's being spread around. I've just seen colleagues from NSSF at the table there who have been very instrumental, along with other private industry practitioners who have been instrumental in the success of the statistics that we are reading here. But the question, particularly the one you asked on whether we shall be financially free by 2040, is one that is still worrisome. And it is worrisome because the statistics that you are reading are but for a few people. Uganda has about 44, 45 million people who are not, most of whom are not included in the statistics that we are reading out. These statistics basically cater for about 20 million people who are mostly the working population within the country. So is the coverage adequate enough? The answer is most likely no. But also on the question of adequacy and whether this money is sufficient to cater for an individual and make them empowered or financially free at a certain point in time, I think the statistics from NSSF show that this is not the case. So there's still a lot to do. I'm very glad that we're having a conference such as this one. One of the things that contributes to the growth in these assets is ideally the yield that these assets attract once they're in the capital markets. Are the yields that we are currently seeing in the capital markets still sustainable? The answer is probably no from economists, analysts who are forecasting into the future. So everything that we are looking at today, the futuristic outlook on the investment environment is quite interesting and answers all the questions that I've raised on adequacy, whether it's enough money, but also whether the growth of these assets to cater for the adequacy problem is sustainable.
Okay, thank you. We're going to hear from Godfrey. Godfrey works with UAP. You're the largest, when it comes to collective investment schemes, you are the big boys, so to say. I'll let you speak to that, introduce yourself, and just speak to, same thing I asked Philip. When you, regulation, do you feel there's enough space to innovate in your introduction, Godfrey?
Thank you. My name is Godfrey Bukomeko. It's such a curious seat to be when you have the regulators up here. So my answer will be quite broad, so that I can offer some perspective from what we are seeing at Old Mutual. So before we look at whether regulation is actually suffice at the moment, the question we need to ask ourselves is, what is the value proposition that we're giving to the ordinary citizen out there beyond the CIS? So we are speaking about the proposition for saving and how that has progressed. But what is the correlation between that and investing? Now, when you're looking at the investment attitude or sentiment, and the panel that was just here before was relating to the Gen Zs, they are actually not only yield seeking or a return seeking, they're looking for a proposition that tends to satisfy all their other interests. Now, alternative investments comes in to help bridge that. Now, Old Mutual in Africa manages a fund in this particular space north of $8 billion, and it's cut across more than just the real estate end. Now, the regulation we have here, while it's still not yet fully formed, is looking at only real estate. But the question would be, as you form that value proposition for the individual out there who is just starting to work or who's maybe in the 8th year of work, you need to then think about all the other channels that would fall under AI. And we are trying to come up with a few products in that line, so that the value proposition to the people out there is way broader. And this is in line with the hybrid funds, infrastructure funds. Looking at a hybrid fund would be ideally looking at high yield debt and the mezzanine debt and different, basically to give the citizen out there or the investor out there a chance to invest in asset classes that will be able to return a higher yield if the market go to tank. Now, should the regulation be set up in such a way as to enable that? Yes, well before we even come to market with the product. Currently, you find that the limitations that are put in place, or the limits in place, make it very tricky for different asset managers to actually play in these various spaces. But that is from the value proposition point. Now, from a distribution end, many of us here in the room have seen how Bitcoin trading has really taken shape. We've seen how different people out there are actually looking for fractional ways of participating in these markets. Now, distribution of alternative investments beyond the REIT is something that locally is still baking, but it would be key to push that dial a lot further so that we can be able to onboard them. How would this help the market? The numbers you spoke to they relate to what has happened, not what is yet to come. So with 131,000 members under the collective investment schemes, you realize that there is over about 15 million people that are on the telecoms. If you get the unique accounts, all those are potential savers and potential investors, and they're actually looking out there. Their money is not sitting in the banks. So for the bankers in the room, we wouldn't be even competing with you. This is money that is not in the markets right now, but is seeking for a way to come in. And then maybe to also bring it home, when you're looking at regulation and the alternative investments, you have to note that we would like to not only invest in houses, but we would prefer to invest in projects that we can get to talk about. Say, for example, in Namibia, in Malawi, we have invested in schools, hospitals, things of the like. Just imagine if the Aga Khan hospital that is being put up was actually crowdfunded, and maybe NSF or Old Mutual or the different other houses were supported to partner together to bring that as a product for the market to even invest in at a fractional level. The impact alone would be so broad that even those that are outside this room would be happy to participate.
Truly a long-winded one, as you promised. But to all the panelists here, maybe we need to address the elephant in the room. I think both sectors are dominated by the NSSF. If you look at it's the largest retirement benefits provider, and then I think when it comes to the listed stock, and if you're looking for investors, they're still there. So the question really is, what plans are there, especially Benjamin? You have so many schemes that have come along. Do you see any promise that perhaps we will have competition to NSSF as the big boy in your sector? Are there any? You have a long-term plan. In that long-term plan, do you envision someone being able to compete with the NSSF to provide more variety from the investment point of view?
Thank you, Sanya. I think the issue is not really competitors with NSSF, but to make sure that whoever is operating in this space does it in the interest of members. Because as you may be aware, many times people think about, say, NSSF as a fund, but we must look at it as members' money, not an institution. So when you look at it with that perspective, then you look at Makerele's and all the other 60 schemes as such, you look at it as members' money. And we are saying, what is stopping us from getting profitable mandates that we could get from alternative investments? So at UBRA, one of the things that we are looking at is the design. We have a provident fund model, whereby for the voluntary schemes, when you exit the employer where you are now, you are paid your lump sum, so you exit. So that creates a disruption. Then when you see what we have as midterm access, then you have the notional retirement age of the NSSF, 55 years. And yet, what we are speaking of now, we are looking at committing capital for the long term. So those disruptions are really affecting some of the things that we are discussing here today, because profitable mandates can only be got when you have the long term with no disruptions. Now, when it comes to the way the Provident Fund model is designed by law, you notice that we do not have a provision for lifetime products. So when you're exiting at 55, then you get your lump sum, and that's it. Then you choose what you want to do with it. And I think the recent study by the NSSF shows it. They're asking people, what do you use your money for when you get paid? The lump sum. People are buying land, they are going back to school, you know, they're improving their homes and all that. Yet, the intention of saving for retirement is to make sure that you deal with the contingencies of old age. So the first thing is to look at the design to make sure that we are responsive to the retirement objective, and through that you can see that we can commit resources for the long term that we can get from this kind of arrangement. Now the second one is about, if you look at for instance the trustees we have, the stewards who are making decisions, they have terms of 3 to 5 years, and there's a lot of member activism that is coming up, just like you would see shareholders. If you go to some of the AGMs, you will find that for the smaller schemes, members are asking tough questions and trustees are under pressure to perform annually. So now we are talking about committing to liquid these assets where you cannot easily get reports every year that you are doing very well. You're making commitments, you expect a turnaround over time, 5 to 10 years. So you see that we must look at the tenure of trustees and also create a mechanism that allows them to be accountable for decisions for the long term. Because if I'm in for 3 to 5 years and I exit and there are new trustees and I made a decision, then I'm out of it. So how do we hold you accountable for the long term? So those are some of the things we're examining. Then of course, one that you're aware about is the investment regulations. Why only in the East African region? Why not beyond? All these are things that we are looking at. We believe that we must create flexibilities that allow us to venture out, because diversification shouldn't be diversification just for its own sake, where you say we're in real estate, but what are we getting out of the real estate? So when you look at 10-year information of some of the investments, be it with the NSSF and these alternatives, even when we have just a small portion out of what we permit with our investment regulations, you believe that we could do better, and competition could come in, not to compete with a fund, but to compete with value propositions from other jurisdictions. So if members know that we can do better with Fund A or Fund B, members of the scheme will be asking questions. They will be asking Makerere, they will be asking Makerere, why not invest money here and not there? So we want to make sure that we widen the scope of diversification through geography, but this is something we must discuss together and see how we move forward. Now, the last thing we are thinking about is to address the level of segmentation. I know we have the big fund, but with the smaller funds, you notice that employers will have all these small schemes. We encourage them to join umbrella schemes as well, because how far do you go to diversify when you have 10 billion, 20 billion? So we are looking to consolidate such that we have fewer schemes, but very strong to be able to make investment decisions and also mandates that are more profitable over the long term. So for now, that's what we are looking at in terms of what it is we must do internally to make sure that those that are making investment decisions are not constrained by the quantitative limits that we have in our investment regulations.
Thank you very much, Benjamin. I'm about to open the floor to questions, but there's something you mentioned, which is looking at consolidation of schemes, getting smaller schemes and coming together to form larger ones, and then providing unique value propositions. And for that, I wanted to ask Philip. We saw a large turnout for midterm access. Does that perhaps point to something going on in the market? Do we have not enough variety of value propositions? Things like medical, real estate, and other things that people might require their money midterm. So do you feel that there's enough value proposition for the current market? We've just been hearing about Gen Z and all that. Yeah.
All right, thanks, Sam. Sam, you'll allow me to make a rejoinder to my regulator and just add a bit more detail. Because the space that NSF plays in is the same space that I play in. You asked what we are doing to become bigger than the NSSF. I think without liberalization being on the table, it becomes very difficult to compete with the NSSF. But what we have done as private practitioners, competing with the same membership as NSSF, what we have done is to then come and compete with them on the informal sector of things. NSSF is put in place by an act of parliament. They have a mandate to collect contributions from all the employers within Uganda, which makes it easy for their asset base to grow, hence making competition very difficult for people like ourselves. I think on the informal sector, we've come up with products, and that's an area, a landscape where we can compete favorably with NSSF. We have empowered that, or we have driven that or enhanced it with ensuring that we drive financial literacy, but also we've looked at our investment strategy and tried to fine-tune it to ensure that it delivers much stellar results or enhanced results compared to the NSSF. The NSSF still is a competition on the informal space because they are now allowed to go for individuals. So it's very important that as we attack this particular space from a return perspective, our return is a much better value proposition than the NSSF. So the investment strategy has changed to be more tuned to higher yielding securities such that we can attract more membership and hopefully in the future become bigger than NSSF. I think I'm also very excited that alternative investments offer much more yield than what we currently see with traditional assets. So with this kind of knowledge exposure, my call to action for the PE managers in the room would be that let us have a discussion with people like ourselves. We are much more flexible to make decisions because of our size compared to the bigger funds. And hopefully that should drive return, but also give us a competitive advantage against NSSF. The question you asked around midterm access, we can come to it specifically. I think midterm access, in my personal opinion, was one of those things that was unprecedented in the world. The cry for midterm access, I would believe, was not because there are not enough financial products on the market, but it's purely because sectors closed. For most of us within this room, we belong to the financial services sector, a sector that continued to pay either partial salaries or full salaries. So we're not really affected by the closure of the economy. But if you take a sector like the tourism sector lost over 600 jobs. And if the NSSF statistic is correct, that over 90% of the people in the working population have NSSF as their only savings, then it only makes sense for these people to actually go to the NSSF to get a part of their money to get up for the basics of life. I think inherently it's a much wider problem with our social security structure. Our social security structure should not only provide for age benefits, but should also provide for unemployment benefits. So for things like this that currently happen in the world or have happened, where you have complete shutdown of economy, people are then able to go and access their money. In terms of housing and medical that you spoke of, the framers of the UBRA Act envisaged this need, and within the UBRA Act included the use of retirement benefit money to cater for medical expenses, but also a part of that money can be assigned towards housing for an individual. Thank you.
Thank you very much. Lastly, before we open the floor, I'm going to ask Godfrey and then Lynn to speak to our theme, actually. Looking at the prevailing macroeconomic environment, which way forward? Where should retail investors be putting their money? Godfrey first, and then Lynn.
Thank you. First, allow me to have a rebuttal to the two previous speakers. First, NSF is not part of competition. You can view NSF as a client when you're a fund manager. Then two, why NSF is not a competition, why NSF is not part of the competition, you find that if we innovate the product offering very well and align it with their mandate, NSF would actually be very much a source of funds to really pilot some of the things in the market, to monetize them and bring them up front, so that then the regulators will be able to have something to benchmark on to grow the space. Then on the other side, though it has been thought about at the NSF, when you read their annual reports, there's a whole wide blue ocean that has not been tapped. It's been locked out simply because of access and lack of access and the knowledge. And that is very much wider and bigger than the current portfolio book that NSF has. If you have the same, NSF has been around for a while. If you give the market the same time lapse, you find that the private side of asset management can actually match up and even be bigger than that. Now, in terms of the question that you've asked, what should a retail investor do? The retail investor is one very dependent on what is currently offered in the market. The retail investor is not as sophisticated as many people in the room, and two, has a few characteristics that are not key to us. One, liquidity. They always want their money close to them. Two, they want to make sure that their money is safe, because they play in high risk spaces, and the question has to be, how do we be able to give them those two, so them to be able to have a high return and also have a high liquid investment while they're actually taking advantage of participating in the different investment channels that we know we can bring to them. So it's not really what they should do, it's more what should we do for them. And we've seen significant traction come in, even on products like the dollar fund. The people out there actually asking the questions, and they're very interested. Then lastly, the trustees of the different pension houses, I think over the course of the last 18 months, have been asking persistently, what are we doing to bring alternative investments to them? Well, what are we doing for them in that space? And I believe any fund manager wants to keep a client or to keep a fund within the next 24 months. If you don't have that offering, they will actually have exited, because you can see that they're now starting to ask the questions. They realize that should the yields on the fixed income side start to drop, and this has happened in other markets, alternative investments become a very key asset class, and they want that exposure. Beyond that, I believe the retail investors will also start to appreciate that exposure. Thank you.
Thank you very much. Over to you.
Yes, thank you, Samuel. I think before I go to the way forward for the retail investors, I would just like to also let the audience know that the capital markets authority is actually working on a regulatory sandbox, which will actually help with the different innovations that are coming up, and that can actually help the market grow in terms of testing out these many products that they keep innovating. And beyond
what we have as NSSF as an enabler for investments for the retail investor. We can see, for example, with the midterm access, many Ugandans could easily fall prey to misusing these monies. But with our flagship project, which is the collective investment scheme that we usually try and promote amongst our the public and all the Ugandans at large, we sort of bring it to them that the collective investment scheme is actually something that is safe, as he said, but also we have regulated fund managers that actually make sure that this money and all the people investing their money in terms of unit trusts are actually assured of the safety, because there's such a thing as the custodian, which is normally a bank which acts as the vault for this money, but also you have a trustee which acts as a legal eye. And so they're literally the legal owner for these funds when it comes to collective investment schemes or unit trusts as they're commonly known. So this project is one that is easily adaptable, especially for the Ugandan people. And we can see through the numbers that it has been growing year on. And the liquidity point that he mentions is actually very crucial, because this is money that you can actually take out in under 48 hours. And most of the Ugandans will cry about the illiquidity, for example, in some of these markets, because most of us would want some quick cash. And so we are swayed to sort of leave our money in banks, thinking there are no investment avenues, for example, that can actually help you have this money out as soon as you expect it in under 48 hours. And so these are some of the awareness campaigns that we are doubling down on as the Capital Markets Authority, as our mandate is actually to also increase the investor confidence, to let the Ugandans know that even unit trusts can be the actual bank account that you can actually put aside in terms of investment. The previous speakers talked of the 10 or 20% investment put aside, for example. But most of us have bank accounts and the money sits and it's not actually working. Samuel, there is a term you used for money working for you that you coined today. What was it?
We borrowed from the good Don, who said that your money should not be barren.
It should not be barren, yes. So this is one of the avenues that we're looking at in terms of growing the capital market space. So again, just to reiterate, because our mandate is also to regulate the market, there have been so many financial scams or investment scams that have come up, and this is also because of the lack of awareness when it comes to which funds are licensed to get investments on behalf of Ugandans. And so our appeal, at least one takeaway from this, is that there are so many funds that we license that should be taken into consideration instead of looking for quick money, quick returns from investments that are actually not licensed or regulated by the Capital Markets Authority. Our core mandate is to actually make sure that whoever is getting monies from the public is actually licensed or regulated by us or has a no objection. And if you are a business and you are actually looking to raise capital, there are more legal ways to raise capital. And we have the deal flow facility, for example, in partnership with the European Union that the Capital Markets Authority put up, in also partnership with the financial sector deepening Uganda. And we're saying, can we get you investor ready? And there are programs that we actually put you into. I mean, we're just from a 2-day training conference with business owners and trying to let them know of the many investment and capital raising avenues that they can tap into when it comes to the capital markets. So the awareness is still ongoing. We keep making sure that all this information is known to the public. And so we are just grateful for the different sister agencies that we continue to work with and partner with.
and also the entities that we regulate. And again, the CFA Society is one of those platforms that help us put our message out there.
Thank you very much, Lynn. Thank you, the panel. I believe there may be one or two questions. Remy, do I see your hand up? Yeah, one or two questions? There being none, I wish to thank the panel for the time and for the input that you've given us. I think it's in order to give you one just very brief closing comment, starting from Godfrey and then ending with Benjamin. Very briefly.
Yes, my closing remarks will be really a call to action that when thinking about alternative investments, we need to think beyond real estate, and then we shall be able to, because the members, the people in the room here are the ones with the mandates to actually do this. We need to think beyond the real estate and be able to, and then be able to bring those different other asset classes to the market, and hopefully then we shall be able to capture a bigger part of that retail segment that we do not currently have.
Right. As part of my parting shots, mine will be to the PE managers in the room, or to the managers that particularly look at alternative investments, and is really to welcome them to institutional money, particularly pension funds. Pension funds have been left out of the conversation on alternative investments, but I think when we look at the future, pension funds being part of this conversation is inevitable. The yields, the interest rates that we currently see in the financial markets, most especially for the bonds and bills, are unsustainable. Some of the pension clients would want to benefit from the PE returns that we hear about. It's very interesting that the people that actually invest in the PE markets are not institutional investors from Uganda. PE money is money that is actually coming from outside. So it is like our institutional investors here are not able to see and seize the opportunities that currently exist in front of us. So the call to action is, again, for the PE managers. Please, you're welcome to the pension side of things. Let's have the discussion. Let's be part of the party. Thank you.
Yes, and mine is do not let the money be barren. When you're getting your mid-term access for the Generation X, is it? Please remember, there is such a thing called the collective investment scheme.
It's Gen Z.
Gen Z. No. There's the older ones.
Oh, Gen Y.
They are the ones I'm seeing in the room. Oh. Generation Y. Yeah, the midterm access is coming, right? And I think even some millennials are about to. Yes, please think about the collective investment scheme as an investment avenue for starters. It is safe. And as the Capital Markets Authority, we have a list of all the licensed fund managers, brokers on our website, www.cmauganda.co.ug. Please check them out, and always check the regulatory status of any entity before investing, especially in the capital markets. Thank you.
Yes, thank you. My parting shots about first. I've heard that trustees are asking, the fiduciaries of retirement benefit schemes are asking about these alternative investments, but at the same time, they are asking the regulator to increase the proportion that they should invest in government securities because they think the rest are not profitable. So you can see it means that the signal we have in the market is telling trustees that they can do better with government securities. So we have a number of those applications, about, I think the biggest percentage of schemes are saying, I think we can do better in this space. So Why I say that is because, one, in our quantitative limits, we have for real estate up to 10%. I think largely NSSF about 6%. Then for private equity, it's just 1.6%. So the window is there, but what is stopping schemes from making this decision? So first, it's because they don't trust that these mandates can actually bring them good outcomes, and that is the challenge before us, to make sure that trustees believe, not just believe, but they are confident that even when it is in the long term, we have at least the basic guarantees that we are going to get a value proposition. If not, then they want to look for a level of certainty. So risk management is important for us. We want to make sure that the fiduciaries are prudent. So what UBRA is looking at is, for this class of alternative investment, is actually Prudential Standard Plus, because we expect that those that are running these entities or these funds like the NSSF are prudent, but you know that there are cases when they are not. So we want to make sure that those that are doing this business are able to identify and respond to risks, but also make decisions that they are accountable for, such that members get the best possible outcome. Thank you.
Godfrey, Philip, Lynn, Benjamin, thank you very much. A round of applause for the panel. We are going to recess for lunch. We have a very good lunch. Ruth and team at the CFA Society have made sure of this. I think we will be receiving coupons as we head out. We shall reconvene at 2040 for the afternoon session. Thank you very much, ladies and gentlemen. Wait, it's 2:40, not. I think I need some glucose myself. Yeah. We are set to begin our first panel after lunch. This panel is titled Navigating the Landscape of Climate Finance, Balancing Sustainability and Economic Viability. This is a very important topic given the shift towards, climate awareness, ESG, and all things to do with social responsibility. Leading this panel is Mark Mutahi. Mark is a partner at BID Capital Partners. I'm going to invite Mark to take the floor and invite the panel. We will have one person joining us by link. Mark, please come and take the floor. Big round of applause to Mark as he comes forward.
So good afternoon, everybody. Hope lunch was good. As mentioned, we're going to have a quick panel on climate finance. We have 3 panelists, including myself, so we're going to sort of play a hybrid role here. Our panel is thin in terms of people, and that's on purpose because not many people have this knowledge. So I think you guys are going to be fortunate that you're going to have the actual experts, of which I'm one of them, in the industry when it comes to climate finance. I was having lunch with somebody who asked, she actually said to me, you're doing the panel on climate finance, meaning ESG, right? So these are the myths we want to dispel. Climate finance is not ESG. It is not impact finance. It's not sustainable investing. It is not all these things that people, green financing. So I want to welcome my panel. So like I said, we're going to be a panel of 3. One of us is on the phones. I just hope we can get him connected. I don't know if the tech team can confirm. Christian is with us. Perfect. So I'll let Christian introduce himself, after which I have my second panelist. Maybe I'll get him up here first, sorry. Aaron Werike, who is with the Climate Finance Unit at the Ministry of Finance. Welcome, sir. And then Christian, who is online, unfortunately cannot be with us today, is the founder and CEO of an organization called 1MTN, 1 Million Tons, and he'll explain what he does. So Christian, I'll pass it on to you for now, whilst we take our seats, and then we'll pick it up from there. Thank you.
So much, Mark. I hope I'm loud and clear. Ladies and gentlemen, it's who wanted to be here together with you, unfortunately via virtual tool, but yeah, let's see. I really hope to make it well. As Mark mentioned, my name is Christian Valda. I'm the CEO and co-founder of 1MTN. It stands for 1 Million Ton Nation. As we are carbon project developer, then our aim is to take the project not less than 1 million ton carbon equivalent removed from the atmosphere. So we are operating mostly right now in Uganda, a small team in Kenya as well. And we remove carbon by restoring degraded lands with native bamboo and also implementing agroforestry practices. Important to mention is that we do leasehold concepts, meaning that we lease the land from the private landowners mostly, and we give the land back after the project ends with a full mature bamboo forest on it, which is generating recurring revenue due to the fact that bamboo needs annual thinning, because it is by definition it's a woody grass. We need to take care of it regularly. Our first pilot of 400 hectares is done in North Uganda as a success. To be honest, I'm also surprised that it's the largest impact commercial bamboo plantation all in East Africa. And regarding our clients, they are local, regional, and global corporates who offtakes our high-quality carbon credits, but also crops and bamboo. The last but not least, the most important for me and for the people of Uganda is that 90% of our team actually are living and operating in East Africa, boots on the ground. So we consider heavily ourselves boots on the ground and the Ugandan company. Thank you so much. I'm excited to be here.
All right, thank you, Christian. I'll ask Aaron to introduce himself. Just so you know, Aaron has graciously accepted to be here, but because of our schedule, he might have to leave a little bit early, so we'll try to run through this panel because he has another engagement at 4 o'clock. But over to you, Aaron. Turn it.
Thank you, Mark. Aaron Weruhe, I work with the Ministry of Finance in the climate finance unit, and the unit is in charge of mobilizing domestic and international climate finance from public and private sources to be able to implement our climate change actions across several sectors such as energy generation, transmission, energy efficiency, clean cooking, agriculture, transport, urbanization. So we are largely in charge of mobilizing that kind of finance which is earmarked for green and climate sensitive projects. But we also offer capacity building to the private sector, to public sector agencies in developing bankable project proposals aligned to different funds across the world. We also coordinate all climate change action, the financing aspect of it, because we have a number of financiers coming in with different instruments. So we are like the hub and the one-stop center of all those actors to have this money in one basket and then be able to disburse and deploy to different investment needs. So generally that is what pretty much is Ministry of Finance. Thank you.
Thank you. So our choice of panelists was based on trying to get a mix between policy and private players. So Christian, just so you know, in the room we have a lot of fund managers, we have CFAs, we have practitioners in the financing space, many of whom talk about climate finance, talk about green financing, sustainability, ESG, as I mentioned. And there's a lot of words that get thrown around, but if you come down to the numbers, not a lot of investment is happening. So, and for those of you, I don't know how many in the room are actually getting the depth of some of these transactions. Christian can explain some more, but you'll hear things like VRs, CRs, carbon credits, CDM, DNA, LOA. All kinds of acronyms are getting thrown around. RED plus, mechanisms, all kinds of things happening. But many people are not very familiar. And as a result, I think the thinking is that financiers have shied away from this asset class, especially because they don't understand it. So Christian, from you, I would like to understand, one, your choice of Uganda for your project, and number two, what your journey has been like in trying to raise capital and where you are to date. Over to you, Christian.
Thank you, Mark. How much time we have?
I'd say probably about 25 minutes for the panel all in, and then we're going to take some questions from the crowd.
It's a loaded question. Why Uganda? It's simple regarding the financing. We can take hours or maybe days to try to start one. But I would like to start why Uganda. I mean, first of all, I love Africa. I think the first trip to Africa for me was 2004, something around that one. And since then, I have been traveling in different countries in Africa and Uganda most effectively the last 6-7 years on a annual basis, because I knew that one day I would build something over there. Didn't know back in time what, but I had a good, warm inner feeling. So coming back, why one and decided to start from Uganda, I can give you five very strict reasons. First of all, the impact. So I have been founding and exiting actually commercially driven businesses all my adult life. I have been a couple of businesses, so then made some money and then started to invest as an angel investor into early stage, mostly technology startups. After this time, I understand that I'm still more operating type of guy. And if I build something new, I would like to put impact as a first. So combining my previous experience doing already a small scale business projects in Uganda before, and my co-founder experience in power markets and ESG, Uganda is very much found and to really generate a huge impact. To be frank, our project is contributing to 8 sustainable development goals organizations. The difference is impact first, impact in business, but not only. Second is that I really would like to address a huge problem for Africa and also Uganda, specifically North Uganda, have. That's that most of the area of land is degraded. This problem is huge and it needs an immediate action. Via our project, our business really wants to tackle this solution. The third one is definitely the social economic impact, because our project generates thousands of jobs along the way, and as from who is native in Uganda, for some it's the nicest surprise, but it's native in Uganda. And the bamboo bioeconomy globally is 65 billion USDs around the markets. How much Uganda is doing it? How much Kenya is already Africa? It's close to zero. So I'm very triggered and excited about actually helping supporting the bamboo bioeconomy in the region of East Africa, which is basically non-existing at the moment, and tapping into the global major monster bamboo markets all in all. And of course, with the partners, local partners, with the operating groups, we really want to contribute to that. And then last but not least is finance. We are talking about climate finance, as Mark you mentioned, but truth to be told, only 3% of global climate finance are towards that. This number is ridiculously low, and we need to work together to increase this number significantly. So these are the reasons why we started in Uganda. First of all, we see our project is suitable as an environment. There's a need, a basic need from the nature of the food, but at the same time contributing and helping to attract capital to climate finance to increase that rate. And how has it been so far? I mean, it has been rewarding and challenging at the same time. Fortunately, there has been private investors who are believing in what we do, who are believing in Uganda, who are believing in nature-based solutions. But at the same time, as you mentioned as well, the awareness is low. So if I'm talking specifically investor from the global north, for example, then after nature-based assets and carbon markets, for most of them, they are all yellow or green, or not green, but yellow or red. That's one investor put me nicely. Okay, Christian, if you give one of these, I can handle it. You can give all these three. I cannot get that approval from the IC. So in essence, we need to educate a lot the investors, what it is actually, what the carbon markets are doing, actually how to de-risking the investments, how to also provide community investments and support from the public funds, from the public sector. This is all I think, where jobs need to be done. So yeah, I think this is as short as possible to give us some reflections for the funding efforts.
Thank you, Christian. Picking up on what you just shared, Aaron. So Christian says 3%. Now, being a government agency or department, number one, are you guys aware of this number, the 3%? And if you are, what's your role and what specifically is actually getting done to up that investment, specifically in Uganda?
Like as rightly put it, we have when you look at global climate finance flows, the private sector accounts for about 3% of it. And that is because of a number of challenges. First, the investors are not aware of the economic opportunities which lie within climate change. Climate change is a challenge. You have floods happening, you have dry spells with implications on agriculture and very many other things, but it also comes with investment opportunities, like investments in activities which build resilience of these communities. For instance, irrigation. You want less emissive sources of energy like solar farms and solar plants, investments in geothermal, solar dryers, etc. So there are all these technologies which can help communities to cope with climate change, which can be business opportunities, but there have been challenges of trying to do to illustrate their bankability, because there is perceived risk. Some of these are new investment areas, and there are no clear success stories and even clear feasibilities and economic and financial analysis to show the commercial viability of that. So what we are doing as the Ministry of Finance, and in particular the Climate Finance Unit, is to, first of all, kind of try to bridge all the policy and strategy gaps which are in place. We didn't have a climate finance strategy, so we're kind of addressing these challenges from a piecemeal perspective. We are working on a strategy which has a great component on the private sector. And the other thing is we are also working on a taxonomy. A green taxonomy is, it tries to define what is green and what isn't. We've been having demands from the private sector, particularly the financial sector, the banks. They want to invest in green, but there is no clarity on what is green and what isn't. There are no clear incentives and rewards. So this taxonomy is going to help us to bridge that, to clarify on what is green and what isn't. We are also coming up with fiscal reforms. By fiscal reforms, I mean about tax incentives, tax holidays. We already have some of these in place. For instance, if you're importing sprinklers or for irrigation, or you're importing solar panels, they are exempted from VAT, but that is just a component of earnings from it. We have green entrepreneurs who are venturing in clean energy. They've come up with electric pressure cookers, which are very efficient, but the cost of the cooker is like 500 USDs, which is out of reach for the ordinary Ugandan. So what we are doing is to reach out to different funds, like the adaptation fund, to get money to be able to de-risk these investments and make them more affordable and roll them out in urban areas. But the other concept of fiscal reforms, of trying to relax the taxes, is that now, like if you look at that electric cooker, it has solar components which are subject to tax exemptions. But there are other components which are imported that are not exempted from tax, and it is these components which drive the price to 500 USDs because they are imported. So we're also looking at increasing the number of commodities and green imports which are on that exemption list of the Uganda Investment Authority and URA. And we think that by doing that, by creating an enabling environment, we shall be able to unlock more capital from the private sector for climate investments. Lastly, we have a facility in UDB. It is the first of its kind. It's called a climate finance facility. Right now, the capitalization is still quite minimal, USD 50 billion. That's what we started with. But we are going to replenish it annually and ensure that we have some clear window for climate finance with the private sector, because when you engage with green entrepreneurs, they say there is no money. When you engage with the bankers and other sources of finance and other funders, they say that we have money, but there is no demand. So it's like there is some kind of information asymmetry. We are also trying to come up with a clear platform of engagement between these to match the demand and supply side of climate finance to ensure that we're able to unlock more climate finance from the private sector.
Thank you. And to sort of attest to what he's sharing, in the development of this the climate finance strategy, they've really engaged some. I think some people in this room have been part of this technical working group, where we have been giving them feedback on their strategy. They've invited us to a series of meetings, which I think have been instrumental in helping us shape it, involving private sector in the development of it. Christian, back to this question of finance. Of course, One MTN is still on your fundraising journey. But for the investors in the room, what do you think they are missing in terms of low-hanging fruit when it comes to opportunity in the climate financing space?
That's a good question. I think, again, I'm stating huge profits, which is happening not only in Uganda, but also in Ireland. 2/3 of arable land is degraded, and this is causing a massive loss in terms of lives of the livestock, people, also the loss of the economic growth in terms of GDP. Now, what is the solution? In my opinion, to be honest, for example, the tree planting campaigns, they are nice to have. Of course, this must be supported, but as a single campaigns, one here, another one here, I have seen and learned that sustainability, long-term sustainability of these initiatives, the effects and the impacts are rather low and high. Why is that? My belief is that there is a general perception that all the land restoration and tree planting activities are taken and considered as a very long term, high risk, mostly for people and planet kind of activities. There is no commercial interest in it. If it is, it's a very long time. You need to wait to get your investments and returns back. But we are advocating, and our efforts in a business and project planning plan is not only people and planet, but it's people, planet, and profits. If you also emphasize profit in your design, in the project, which makes the project and approach the business long-term, sustainable, financial, then this changes the whole game, and this changes the whole perception, not only for the locals, that they can be sure that their workplaces will be there also 5 years from now or 10 years from now, but also for a private capital. Because unfortunately, impact capital, there is too little of impact capital in the world to rely only for that. And public capital, no way it's going to happen. So the key here is to counter private capital and put a similar projects, what we do in terms of the land restoration, including all the additional benefits for comes along with that. So I would say that maybe the low-hanging point is to understand the return periods, also to understand what are the true risks, learn how these risks are already managed by the project developers and companies, and then looking into the right investment instrument. And as I said before, from my fellow panelists, the public sector can come and help support with the de-risking, for example, player or catalytic player. Yeah, there is multiple different ways how we can look at that. And right now, even in the carbon market space, maybe you know, there are also insurance, so local insurance, who are enjoying providing the insurance for the carbon credits delivered in the future, which is basically financial de-risking the financial risk. The rest is only operational, and also operational risk you can de-risk. And if you look in terms of the return periods, and because of the holistic approach, which includes carbon credits in our project, which includes, for example, crops, and of course, as we know, there is 200 a year in Rwanda, and then of course, bamboo as a renewable source of biomass and timber, and this makes it holistically important. And my point is that if you want to make a macro impact in the country or regional level, private sector players needs to work together with the public sector players as well to develop kind of the epicenters of the activities of how to really sort of turn around the markets. And then if this epicenter project or projects will start to thrive, then of course naturally it will also start to attract more and more small players into the same concept, into the same model, that they will benefit as well in the end of the day. But first, we need to have a strategical epicenter players to play crucial role. This is, I think, it's important to think of as a strategy, how we can really turn this climate financing issue around and use it for our own benefits, to attract more capital, and also to make more capital returns, as the audience are most investors.
Okay, thank you, Christian. Back to Aaron. Aaron, for me, this question is sort of dear to me, and it's really around local expertise and capacity development. So over 10 years ago, myself and a few partners started a carbon crediting business, which has since gone on to be maybe one of the largest carbon credit sellers in Uganda. We have clients like the Norwegian government, the Swedish, South Korea. It's fairly big and present in multiple countries. But in that time, I'm pretty sure we've spent north of $1 million in consulting fees. So when it comes to verification, validation, and all those technical aspects, we have to get consultants either from Germany, from India, South Africa. And at the time, there was the Belgian government through Enable, their development corporation, had set up a capacity building scheme with the environmental science students from Makerere University, and they trained them on carbon finance and all that. When I came to your strategy review, all those individuals work in your office. So my question is, who's doing that work now? And from a policy level, what's happening in terms of, and I think my opinion is a lot of the reasons why many people can't get into this space is they lack the expertise or the capital to pay for that expertise. Because it's globally recognized, similar to CFAs, it's very expensive to do, highly technical. What's happening at a local level when it comes to building capacity of our people to be able to understand this sector, this industry, and have the technical skills to actually support the development of local players?
The capacity gaps, like you've said, in the climate finance space are quite evident. It's a new space and it's really evolving at a very high paced rate. So even the people who were trained about 5 or 10 years ago, they need to refresh in a way. be able to catch up. So what we are doing, we've been in operation for just 1 year. We established last year in around April, so it's slightly over 1 year. But what we are doing, one, we are partnering with academic institutions. We have a partnership with Makerere University Business School and then Makerere University, but that is to target people who are already in the space or who intend to enter in the space by offering some certifications in greenhouse gas accounting, preparation of bankable project proposals aligned to different climate financing windows like the Green Climate Fund, Adaptation Fund, the Climate Investment Funds, and the World Bank. So we've established a partnership with them. We've not commenced the capacity building process, but we've established a partnership with them to kickstart that process, to come up with a capacity needs assessment. If you're in the SPRED meeting, you remember one of our objectives and interventions therein is to build institutional and individual capacity in a number of aspects in the climate and green investment space. So we have those partnerships at the academic level, which could be accessed through by paying, but also at the ministry level, we are trying to establish a community of practice. A community of practice is like-minded people, like people who you have people of CPA, people of CFA, different people. So you agree, and then you get like champions. So we're trying to come up with a capacity building plan where we're going to have a train of trainers and then be able to have these people go out there and try to roll out these different things. We're having carbon markets coming on board. They're already operational. We're working on the carbon markets regulations, but some people don't know how they can tap into carbon markets finance. And particularly the private sector, the issue is about, there is some passive thinking that when you begin going cleaner or more climate change sensitive, it's going to impact on your viability and on your profits and all that. So we also want to kind of allay those fears and show that as government, we are also coming up with tools. We are coming up with a blended tool where we're going to have a private and public partnership mechanism where we are able to de-risk some of these investments. Like Christian said, some of these investments are new, and when you look at most of these investments in climate change and green and the environment, they are kind of provision of public goods. So the viability is not there at the start. So we want to come in as government and shoulder a portion of this risk and then leave a threshold which is commercially viable to the private sector. And we are going to be able to build that capacity and show them how to do all that. And then we've also come up with some business models for the investments in the climate change space. We have dry spells where our agriculture is not really yielding as expected. So we are designing some insurance packages which we want to roll out to potential financiers who may want to take it on in partnership with government, where government can meet. For instance, if you're going to provide agriculture insurance to our farmers, about 60% of them are smallholders. They may not be able to afford the premium. But if government comes in and pays like 40% of the premium for these farmers, they come and value your crops or your animals, and then government meets a portion of that premium, then the other 60% can be commercially viable for the private sector to come on board. So we have all those models and tools, but which we plan to roll out, and we are working on a capacity needs and capacity building plan for now. We've just been in place for 1 year, and that is one of the things which we want to really roll out and try to alleviate all the capacity gaps which are prevailing at this point.
Okay, thank you. I had a few more questions, but I think in the interest of time, because like I said, Aaron has to be at another event speaking about the same things shortly. I'll open up the floor to a few questions first, and then maybe we shall continue on with Christian. I don't know if anybody has burning questions, especially for Aaron, because he has to run. Maybe I'll take 2 or 3 questions. Anybody? No? Either we haven't understood anything or we've understood everything. Which one is it? The both, eh? The latter, we've understood everything? No? Okay, no question. I'll let him offer a few parting shots before he goes. If you have anything else to say before you close, because I know you have to run, and then I'll come back to question.
Thank you. We're grateful for being part of this conversation. And I also want to rally all of us to be a part of this climate finance space. It is a growing space with very many opportunities locally and globally. So take initiative, take interest. There are very many resources online from the World Bank, UNFCCC. You can just put in climate finance and they will show you how the landscape has been evolving over time. There are certifications, some of which are free of charge, to be able to bridge the current capacity gaps and also be able to tap into the opportunities. But also for our businesses, we have transitional risk coming on board. There are many policies coming, regulations and laws. So you don't want to be found non-compliant when those laws come to hold you accountable on climate change. So we should stay ahead of all that by participating in all these capacity building initiatives online. So thank you for listening.
Thank you, Aaron, and thank you for your time. Christian, any parting shots from you? Because we have to close the panel in the interest of time.
Yeah, absolutely. It has been a pleasure. Thank you so much for the invitation. Mark, great moderation. Maybe a couple of final thoughts. Thoughts from my side. I will emphasize again the need to work together in the private and public sector together. I have been spoken, and at least I am speaking based on the experience. I have been spoken more than 200 as something other markets investors globally. And I have a pretty good understanding what they want, what they don't want. So how to attract the private capital and how to make it attractive for the private capital to enter into the carbon markets. Some of the key elements that I have picked up in my conversation is that, first of all, there is a government bonds, government green bonds. Second, there is a debt to nature swaps. There are guarantees from the private sector. There is first loss takers kind of vehicles. What the public sector can work together with private ones, make to de-risk the investments in the nature and in the carbon markets. As mentioned before, there is insurance players in the market. And last but not least, I would like to emphasize about favorable regulations and legislation. And why? Because voluntary carbon markets and compliant markets, it's come here to stay for a long period of time. And there is also the fact that even if the global corporates, they are on the journey to decarbonize themselves first, and then go to the market and buy offset to offset that last mile, because ships need to drive and airplanes need to fly. Very simple example, of course. Then Uganda and East Africa is part of the global south, pretty highly competitive markets in the carbon markets field. So we also need to learn and to understand what others are doing, why others in the global south will get more funding than Africa, specifically East Africa, what they do better, how they affect better the private financing funding, but also the public funding, but maybe the global north. So it all comes down to the favorable relations, legislation, tax incentives, the investment protection acts, etc. I'm not competent here to give advice, but definitely there are people who can make a big move in that sense to attract a huge amount of climate finance. Covers the East Africa and covers Uganda. That's maybe my last point I would like to emphasize. But overall, thank you so much. It's great to be here. I really hope to see everyone soon face to face when I'm back in Kampala.
Thank you, Christian, and thank you for your time. To everybody, thank you for your attention. I know it's a pretty broad topic. We didn't have time to get into everything. I'll offer myself to give a masterclass to any of your teams if you want more knowledge on how this works. But overall, climate finance is not a hype. It's happening. Climate change is happening. There's a lot of money. There's a lot of opportunities. And the sooner we'll, similar to blockchain, I guess, the sooner we'll educate ourselves and get more skilled on this, there's a big investment opportunity that will promise returns to both yourselves and to your investors. Thank you, and thanks for your attention. Cheers.
Recording stopped.
Thank you very much, Mark. Those who are still doing a CFA, I'm guessing this is one area that you're going to encounter in the new notes that you get. Climate finance, it's here, it's big, probably bigger than blockchain, who knows? But I can see many people were amazed by the discussion. We will let that simmer a little bit, and I think with time, we'll begin to sip through, and Mark is with us. Can always approach him and get the masterclass that is promised. Thank you very much, Mark, for that discussion. Moving on, we're going to have a presentation on something that is closer to home, and that's going to be taxes. Before we have the next panel, we're going to have a presentation from PKF on taxes. Before that is a very short 2-minute video to ease us into that session. Please play that video. Thank you very much for that. Once again, I'd like to thank our sponsors, BKF, the Uganda Securities Exchange, URBRA, CMA, TDB Bank, and all of you for coming today. I'd like to welcome on stage Gilbert Ariho Ruchiri, Tax Director of PKF, to give us a very short presentation. Gilbert, round of applause to Gilbert.
Good afternoon, ladies and gentlemen. Thank you very much to CFA Society East Africa for organizing yet another alternative investments conference. I think this is very informative, and it is transitioning the way we think and look at the space of financing and developing this economy. So I'll quickly take you through the Uganda tax environment. And when this was suggested to us, and given the time frame that we had, I said it's too broad. So the best we could do is to keep the discussion going. So we shall look at a few highlights of what we think should change and where we think we are in terms in the context of alternative investment. So the discussion by and large is about where we are, how do the investors feel, that's the environment, and then we shall quickly run through the attractiveness, the investment attractiveness. So, of course, this is not exhaustive. This will be a little bit of the highlights and what is informing what we are seeing. I know it is very difficult to talk about taxes now in Uganda without being emotional, without being political, but that's where we are. I think everyone is feeling the heat, or at least everyone is feeling the tremors in the ground. So one is to look at what everyone has been talking about, the narrow tax base. Of course, the economists need to come in here. Depending on where you're getting your what your source of information is, it's between 12 and 14% of GDP. Whichever one is saying it is very small compared to our peers and the average in sub-Saharan Africa, which is about 18%. So this has informed some positive changes because we've seen the tax authority becoming very innovative. They have deployed technology, but at the same time, I think they have also firmed up on the grip around some people's necks. So, and I think as we try to analyze and look at the investment attractiveness, tax, those who are here in the room, you know that when you're doing a due diligence, tax is one of those critical 3 areas. Finance, tax, legal. Usually the investors will always be interested in those 3 areas. So, of course, the other aspect that is being talked about is about the informal economy. Also something that seems to be behind a lot of actions that we are seeing. Is it responsible for the low tax collections, or is it that the economy is actually underperforming? Some people argue, even if you formalized it, but if the productivity is as it is, we may not see much traction. But of course, this is one of the areas that this is the economy in which we operate, that over 50% is estimated to be informal. And I put an example of employment. The argument is that 80% of the employment in this country goes untaxed. So then we can look at also still related to the narrow tax base, the taxpayers on the URA registers. As of last, I think September last year, it was estimated at about 2.7, maybe, could be anywhere at about 3 million. What is interesting to note is that about only 1 million or lower are active taxpayers. It would be interesting if we had more time to go within the 1 million. You see the bulk are individuals, most of us here, and very few corporates. And if you go further and you look at how many of those are actually reporting profits and paying their tax, it would also be a good dynamic to look at. So in all this, would love to see this environment change such that it becomes more optimal for the investors to be attracted here and to from a tax context. So when we moved to, I saw there were representatives of Ministry of Finance, CMA, the policy makers, those who are behind influencing what policies we have. So it is, I think, also true and evident that our tax policy, yes, it has been progressive, it's dynamic, but it is not predictable. Those who are practitioners, those who are investing in the real estate, like they were saying, if you've seen the changes we've had in rental income At times, someone asks you a question and you say, let me double check, because you don't know where we are. Because the last 3 or 4 years, we've had significant changes. And the argument also has been, are these policies informed by scientific research? Are they achieving the intended objectives? Or they are coming in, adding. So they are coming in and they are not necessarily achieving the intended objective in terms of cost and what it is causing to the taxpayers. Of course, all this now comes down to the enforcement. I think we've seen a very firm grip by the URA. We've seen the technology they have deployed. Recently, everyone was on the streets about IFRIS, and that informs the general tax environment that we have. That, of course, takes us to the issue that we can keep on discussing maybe in the next couple of weeks, months, as we try to lobby. For us to be attractive as a destination for these alternative investments, what is it that investors would like to see? One, I believe every investor would like to know how much tax are they going to pay. And this, of course, comes to issues of our tax rates. I don't think we have the lowest rates necessarily compared to our peers. Would not like to look at tax incentives. I think, notwithstanding the critics, I think we've had some significant tax credits, tax incentives, the exemptions, the capital allowances. Of course, at times we make 2 steps forward and 1 back. We are giving capital allowances, but later on we are saying we are capping the tax losses carried forward. So give with the left and collect with the right. So some of these influence the decisions by some of the investors. Then the cost of compliance. This largely goes to the issues we've been speaking to: DTS, the digital tax stamps, IFRIS. Most of us at times look at SMEs. Can they actually afford the cost of IFRIS? Do they have the infrastructure? Someone was saying that IFRIS is a 21st century innovation, but in a 19th century, not kind okay, economy. But these are the facts on ground. Of course, when it gets to the stability, that's what we've been talking about. Investors are looking at 5 terms, they're looking about 5 terms, 3 to 5 years in terms of investment strategy. Every year, something is changing. When they made the investment decision, something was exempt. Midway, the exemption has been repealed or has changed in some other ways. Of course, when it is, when you look at it in terms of enforcement, if you look at it in terms of enforcement, that also goes to the cost of compliance. How quickly can you resolve an issue with the tax authorities? Most of you are in business, you know the issue of tax ledgers. Up to now, you might not know what your correct position is. So when we answer all these questions, when we find solutions to this, then they will inform us about the attractiveness. So something specific about alternative investments, I think in the recent past we've made some bit of progress in this area. In 2021, we saw the introduction of a provision that actually was literally considering non-recognition of gain or loss on disposal of interest by venture capital funds. There was a condition of reinvesting. Now we've seen this repealed in the proposed amendments, and it will be replaced with more of an open exemption of income that will be derived from or by venture capital funds that are under the regulation of CMA. I've seen some few critics about the issue of being regulated by CMA, but I think for now this is a positive move. I think in the interest of time, there is not much we can deal with in terms of the depth of this. So allow me to bring this to the end, and thank you very much for being attentive. Thank CFA Society East Africa for organizing this conference, and we look forward to many more and partnering with you at PKF. Thank you very much, ladies and gentlemen.
Thank you very much, Mr. Uchiri. That's his presentation on taxes. They say there are only two sure things in life, and that's taxes is one of them. The other we want to talk about today. Allow me now to turn to our final panel for the day. This is a high power panel with a lot of punch. And I think we'll be ending off on a very strong note. The panel is titled Industry Roundtable, Exit Options, Policy and Tax Reforms for a Vibrant Private Market. We've seen, especially in the private equity space, research done by the East African Venture Capital Association shows that out of about 400 deals in the last 5 years, we've only had 52 exits. And so the rest of the people that have made these investments are stuck in there. An exit is still a very area we haven't yet mastered well. To moderate this panel is none other than Ali Twaha. Ali Twaha is a senior journalist at the Vision Group. I believe an award-winning senior journalist. I'll invite Ali Twaha to step on board and welcome his panel. A round of applause to Ali.
Good afternoon. Gen Z's good afternoon. Yes, this panel was supposed to start at 3:20 and end at 4:40, but when I look at the clock, it seems we are run out of time. I want to thank the organizers of this event, CFA Society, and to thank them also for inviting me to moderate this session. And like Sanya said, this panel will look at the exit options, policy and tax reforms for a vibrant private market. So without wasting much time, let me invite Mr. Paul Buiso from the USE, is the CEO. You may take your seat. Round of applause, please. I want to invite David. David is the investment director at PCP, which is PAL Capital. David, please. We have Tusabe John, is the director tax advisory at BDO East Africa. Let me also invite Abubakar Mayanja, who is the financial and strategic business services at UIA, please. And finally, let me invite the regulator, Mr. Dixon Sembuya, to the panel. He's the Director, Research and Market Development at the CMA. I feel like it was a sort of a big disservice to give this panel this, to give them this little time on the entire program. But let us proceed. Earlier on, I was speaking to Luetabe, and I was telling him every time I have to meet CFA people, I go through a lot of challenges because of the language they use. Sometimes, as a journalist, I want you to speak to me as Omuntu wa wansi, and I would want to beg the panel to, tone down on the jargon so that you speak to the Muntu wa wansi who you would want to appreciate some of these discussions. So to start us off is, so I just want to assure you that all the panel members have more than 10 years of experience about what they're going to talk about. So if you doubt, you can verify. You can go on the CFO website and just follow, they've put the profiles. You can go and just look at their CVs on the LinkedIn. Very quickly, I want to invite David to speak about the environment that the private market is in currently. When I went on his LinkedIn, he says that, and I quote, "My long-term goal remains to be an expert on deploying and managing capital in the private space for fastest growing businesses." So that comment alone shows the commitment that he has to see this market work. So David, I want you to tell us, over more than the last 12 years that you've been in this market, what are some of those issues that that touch you and you would want Paul and Dixon to really focus on? Just kick off this discussion with that brief background on what's happening. Thank you.
Thank you, Mr. Twa Ali. Going to the topic of the subject, exit policy and tax reforms for the private market. We had a morning session where we discussed where the private market is, and we ably managed to identify or define that. But speaking specifically to this topic about exit and reforms on regulation and policy, the private market in Uganda over the last 11 years has attracted $2.3 billion in private equity investment. That is about 200 million a year. And it has done deals in each year of an average of 30 million, given the deal count. And those deals had a range of about 5 to 70 million. So it gives you the continuum of, or the spectrum of the deals. So deals in energy, manufacturing, financial services, ICT, that gives you the spectrum, health, and that kind of thing, agriculture. Those have been the areas of attraction in Uganda. These deals have largely been financed by development finance institutions in Uganda, and very little has been financed by way of private or local capital, with very insignificant local capital coming into the private market. So it's the DFIs that have actually developed the private market in Uganda. And they have domiciled their funds outside Uganda, which has real implications on domestic capital attraction and capital sitting into this market. The reason being that we have had and still have, maybe until the budget speech is read with the proposals therein, a very inefficient private market for capital to sit here. Inefficient in the way that it is tax inefficient. I won't go through the math, but when you look at the vehicles that deploy capital as funds and as investees and as investors, the tax implication across those three persons, and my colleague Jet will speak to this, from withholding tax, income tax, capital gains tax, etc., represents almost an effective tax rate of 65% on returns to investors. There is no one who's going to invest $1 and earn 35 or 35% of it if it comes back in return and take 35 because of tax, an inefficiency called tax. And that inefficiency is because we are taxing everyone as a separate individual. We are taxing the fund, we're taxing the investment that was made, we're also taxing the investors because the URA wants to collect tax from everyone. And as ably said by the tax director from PKF, That then means we are overtaxing the existing taxpayers by finding all means to destroy value from their earnings, whether it is taxing them at the purchase of the good, taxing them at the income, taxing them at withdrawing the money from the bank. You just find a way to tax and out-tax. So that framework has made that we have not had funds domiciled here, and that has a big implication on private capital formation. Notwithstanding alone, one, we don't have skills in this market because we believe that all these funds should be in Mauritius, where they are administered. And when you meet the Mauritius guys, quite sharp guys, you know, they can articulate anything. One Mauritian guy to me can represent 5 Ugandans. You know, you can do this, that. But that's because they're exposed. It's a very small population, but it manages and does the administration for the entire global private equity market for Africa. You can't believe it. So why are those funds domiciled? So skills. 2, it also means that when capital decides to invest in Uganda, people don't have any traction as to what is happening. They ask for Excel sheets, which is a map, but they don't know the terrain. So by the time they make the decision and they deploy the capital is either lost or not well managed. And then we get a bad reputation as, you know, bad managers. And so it has a very negative long-term impact on our SMEs, our businesses, to attract attractive capital or patient and long-term capital to develop. And what is left is businesses going to loan sharks and commercial banks to attract finance for long-term financing. So this has been the climate. But that climate we have communicated to government brings in 200 million a year. If we have 200 million a year seated here, developing business over the long term, why are you taxing it across all layers? You tax it where it is making money. You tax it when it's going out. You tax it when it's being distributed. You want to tax everything, and then you leave investors with barely any return on their initial investment. So there's been discussion to make that efficient, and the regulators, I think, will speak to that. The policy guys and the tax people will address that, as the panel is, you know, is quite heavy on that. But for me, the economics of domiciling local capital in Uganda has hitherto been uneconomic, viable because of the tax regime. The regulation can change in terms of definition of who a private equity fund is. That is pretty easy. But those inefficiencies from the economic side mean that I am unlikely to bring the capital here. I'm likely to take it to Kigali, where there's the Kigali International Finance Center, which is now domiciling capital that is investing across Africa. There is Mauritius, where capital is domiciled, where there are favorable regimes. There is South Africa, where there are favorable regimes. These are things we can do in Uganda. And I think the policymakers in the room are listening and have listened. And we hope that, you know, we're going into the positive direction on the economics of the private capital business. Thank you.
Thank you, David. Let me bring in Jet when David's point is still hot regarding tax. This has been one of the biggest issues, the tax policy. I mean, you tax the vehicle, you tax the entrepreneur, you want to tax the corporation. It raises a bit of question, where should government focus the tax element when they're dealing with the market?
Thank you very much, Ali. I agree. It has been a huge pain for the sector or for the country. And it is unfortunate that it has gone on for a very long time. And for me, I want to thank the resilience of you guys, the Ugandans. How can you survive in that kind of environment? You're very resilient. So that said, that challenge, fortunately, thanks to the well-articulated propositions by the likes of David and also Dixon, CMA, together with tax advisors like myself, there have been a push to government to reconsider that problem. And Parliament, the President listened, the Minister of Finance listened, and as we speak, Parliament of Uganda passed the Income Tax Amendment Act, which reverses that problem. and also passed the Stamp Duty Amendment Act, which addresses the stamp duty issues around investments by private equity funds and venture capital funds. So, of course, whereas Parliament passed it, the President has to sign it for it to become law. So, members, don't quote me that Jet said the law
Anything
has.
can happen.
So Parliament passed it. It is on the Hansard, and chances are high that the President is going to sign it. When you look at the paperwork the David and team did for him and Parliament, there's no way he can say no. So at the moment, when you look at how the law has been designed to address the problem, it is saying, what has been your challenge? Your challenge has been you're taxing the investee when they make the money, the profits. You tax 30%. When the dividends are going to the investing vehicle, you tax withholding tax. When the funds get to the fund now, you also tax income tax. So that chain has been broken. What is going to happen going forward, effective 1st July 2024, this year, once the President has signed, what's going to happen is, one, when the investee is paying a dividend to the private equity fund or venture capital fund, which is regulated, which has been cleared by Dixon, then there will be no tax on the income streams. What are the income streams? Dividends, interest in case of debt. So meaning that that tax will not apply going forward. The same applies to when, now that's to the fund that has been registered here. Now, to make it more attractive to the investors, either locally or from abroad, to bring funds into the fund, government is saying even the investors will be exempted when they are taking out their cash flows. Shouldn't we clap for government for that, guys? Dixon, well done. So that means that the investors, local investors, will be encouraged to put funds into these PE or venture capital funds, or even foreign investors, because the chain has been broken, but on top of that, you will not be paying, the investor will be able to take out the funds tax-free. And that means that the cost of financing, which is one of the biggest problems, is going to go down. Because if you look at withholding tax on interest, it is 15%. And these debt financiers don't pay the tax actually. They inbuilt it into the pricing such that the investee company is the one that bears the cost of that tax. So meaning that the cost of borrowing increases by 15% on top of the actual interest charge. So that, when the vehicles are investing through PE funds or venture capital funds, that's going to go away. So that's on the cash flows. But there's also at exit. So at exit, government is also saying that going forward, to attract or encourage funds to build locally or from foreign sources, the capital gains tax that is currently imposed at 30% is going to go away. And that for me has been one of the biggest challenges for PE and venture capital funds. And on top of that, they are saying that for you at the stage of entry, you bring funds into an investee company, you're acquiring, for example, you're acquiring equity, an equity stake into the investee, or you're bringing debt and their debt instruments which attract stamp duty, or this company needs to increase share capital so that it can accommodate the new funds from the new investor. That stamp duty is going away. Similarly, at exit, when the fund decides to sell, there is also stamp duty on the transfer of shares in the present law of 1.5%. So that stamp duty is also going away. So in a nutshell, Ali, there's a lot of story around it, but there's good news from government this time round that we have heard your cries and we are doing something about it. Thank you.
Well, thank you. You've preempted everything I wanted to throw at Dixon, but good job there. But let me bring in the regulator on issues around incentives, to the private market. In your speech earlier, you talked of the regulations on real estate trusts, which are coming up. You also mentioned of developing regulations for limited partnerships, but give us a little bit more depth on you could give us timelines on some of these discussions that are going on, because last year we made a bit of similar promises. So just a bit more on your presentation.
Thank you, Ali. Good evening, everyone. Now, maybe before I get into the incentives, what I would like to start by doing is probably just providing a bit of background with respect to the private capital space. Now, if you look at the National Development Plan 3, NDP 3, which is part of the blueprints for transforming Uganda into a high-income, middle-income country. Part of the actions therein is developing streams of alternative sources of financing for business with a focus on private capital markets. And the specifics therein lie, or the specifics with respect to that, around the legal regulatory framework and the taxation regime. And I'm glad to report that after so many meetings and having discussions for almost 5 or 6 years, we're seeing some traction. I think we've had some very good partners in the name of IFAD, PCP. David can attest to the number of times we've actually had to meet His Excellency the President just to explain how this works. And the beauty is that he really appreciated where we were coming from. Now, ideally, a private capital fund should be structured in such a way that it's a transparent vehicle when it comes to taxation. And one of the most suitable structures around that is the limited partnership structure. And if you look at what we're doing around that, we've looked at the Partnership Act, and we've identified a few gaps here and there. And so what we're trying to do is we're trying to plug in those gaps so that we can make domiciliation as attractive as possible. Now on the tax, on the tax discussion, there's good progress. But I think I was actually having a discussion with someone, and I think what I told them was, you see, the passage of those tax exemptions or that favorable tax regime is only the first step. And you actually realize, yes, it's something to celebrate about, but this is just the beginning. Okay, so we probably don't know much about what's going to happen after that. And so that speaks to the entire ecosystem. Okay, so that speaks to the entire ecosystem. Okay, so in terms of knowledge, do entrepreneurs know about these alternative source of funding? Skills, are we skilled enough to basically handle the private capital space. I think David talked about 5 Mauritians, one Mauritian handling the work of 5 Ugandans. I hope, yeah. But basically, there's still work to be done. There's still work to be done with respect to having this take off. Yes, we've had some few wins here and there, but then again, I think we're just at the beginning. Yes, the tax incentives that will work in terms of ensuring that investors are actually able to get a lot more in terms of what they deploy. On the regulatory bit, I think without being really preemptive, the regulatory framework that we envisage will actually have a very light touch. Regulatory approach. You're not likely to have anything prescriptive. You're likely to have principles and a few guidelines here and there, just to ensure that yes, we know these are private markets, and they don't put everything out in the public. Okay, so you need to appreciate that even as you're coming up with something to ensure that they're able to operate. So ensuring that you have a very light regulatory regime is actually part of the ways of being able to attract these funds. I mean, when it comes to regulatory compliance or the regulatory burden, you try as much as possible to lighten it so that you're able to incentivize them to actually deploy capital and get that registration or get that legal recognition. So in terms of incentives, yes, they might be a bit light for now, but I think we're still going to scratch our heads so that we try and get as many incentives as possible thrown towards the direction of the private capital space. I thank you.
Yes, thank you, Dixon. I wanted to report, is it Innocent? In the morning, he was looking for USE and wondering why people are not exiting through the primary market. So I thought but by that time, Paul was not in the room. So I just wanted to put this question to you. We have currently there, capital providers who are stuck in transactions, and exit options are, there are not as many for them. So one of the avenues is through an IPO. I'm just wondering, do you have, incentives around that area that you're working on, to pull these capital providers through the IPO? Just a quick thought around that.
Thank you, Ali. Now, good afternoon or good evening, ladies and gentlemen. So the exchange provides a platform that enables companies exit or raise capital. Now, the challenge I think we faced, especially around private equity companies, is that we have approached quite a number over the years, but usually they prefer to exit to other private equity funds. And our guidance has been that there are quite a number of benefits of the stock market if you exit through an IPO, initial public offer. Capital gains is exempt. Trading on the secondary market is capital gains exempt. So, and there are some allowances in the tax space that one would be able to take advantage of if you're a public company. I think the challenge is, the challenge comes out when a couple of issues. One, to what extent are these companies valued? Are they overvalued, and what are the investors looking for? Usually private equity funds drive a lot of growth, leverage these companies, and are able to change them from the basics to really high operating companies. Now, coming to the market means that you're trying to attract public funds. This is pension fund, retirement money that requires particular returns to the members of those funds, and even the general public. I'll use a specific example, and that will be Umeme, CDC, the British investment arm that invested in Umeme in 2005, but had a long-term plan, or its tenure of that investment was 7 to 9 years. In 2012, they listed on the exchange, but when they started this investment, they deliberately set it up to be run as a public company, and the governance, the management structure was all developed around the exit through the public markets. And even when they came to market in 2012, their valuation was modest, with a further plan to exit along the way, and they exited again in part of the fund in 2014 and finally in 2016. So there was a deliberate aim to work towards an exit through the public markets. Now, most private equity funds or companies we go to that have private equity investors usually come at the tail end when the fund is coming to maturity, needs to exit, and yet we all know that there's a process in which you need to go through to become a public company. The legal structure, the tax structure, the way it's run, getting the governance straight, the disclosures, among others. So that work usually takes time, and we've not gotten the feel of these companies looking to put in that work, because their core objective is to drive growth of the company. And preparing for an IPO can be time consuming. So the conversations have been ongoing. We've continued to encourage companies to come, but I think that's been really the limitation, the timing of when these companies should come to market. Thank you.
Yes, thank you, Paul. The timing is tricky, but let me bring in Abubakar Mayanja from the UIA. I just wanted to know what you are doing as a government agency to ensure that a bigger portion of the private capital comes from the locals here, not from Dubai, not from London, not from UAE. I don't know. Just quick one on that.
Sorry, Mr. Panelist, I'm from a private firm, but I'll go ahead to answer the question.
All right.
So the fundamentals around getting more capital in the market come from the economic fundamentals. I know my panelists here are better practitioners than myself, so they've answered most of the questions. But the fundamentals of the GDP economic equation is that you add up the consumption, the investment, government expenditure, and then export minus export. But there's always another equation that is often ignored, which says that savings are equal to investment. So what that means is that if an economy is not set up to incentivize savings, then lower vehicles of capital, like the one Ivan runs, are set up. And what that means is that when there is an overemphasis on taxation, to put it to an individual perspective, if let's say you are in the high income bracket and you're taxed at 40%, then every time you go to the supermarket, you pay another 18% when you're consuming. And when you drive your car, you pay another 1,500 on each liter of fuel. It means that the amount of money you have left to save is quite limited. And the root cause of that, from a macroeconomic point of view, is the inefficiency around public sector management. So among the things that influence the formation of capital, apart from the tax that has been exhaustively discussed, are the institutional settings. Some of them are as simple as village savings and loan associations, I'll mention them, savings and credit cooperatives. Now, as people learn to put money in these vehicles, the pool of savings in the economy grows. So if you look at the statistics currently, Uganda is at number 67 in terms of the savings ratio, which is hardly ever talked about. Right now it's at 21.7% of GDP, but the average over the last 30 years has been 15%. So the root cause of lack of exit options is partly the lack of the vehicles, which are the VC funds and the PE funds. Now I'm excited to hear what Mr. Tushabe was saying, and that means that there's going to be a tax incentive, a policy incentive to drive capital towards there. But there are some other factors that influence this market. So the supply of funds, I've touched on that. Statutory compliance, Mr. Buiso has touched on that. So if you're going to exit a vehicle, it's good from the beginning to have compliance to NSSF tax. And when you do that, it gets easier for you to raise capital in the market. The tax policy, in terms of the capital gains tax or the tax rates, they communicate to the market the information. So if you're telling people that we'll tax you at 25% corporate tax and we'll tax you at 30% employment, you're telling the market that if you start a corporation that will employ people and pay tax and create more GDP, then we are giving you an incentive. Because, you know, from a policy point of view, you can always signal. So if you signal that if a politician doesn't pay tax, but a doctor pays tax, you're already signaling that you are valuing this person more than the other. In terms of the international factors that influence capital inflow, which eventually influences the exit options, is we are usually ranked in terms of our competitiveness as an economy by the World Economic Forum. So working on those factors like the infrastructure and the markets. So when you take an example of a tax on fuel, you know, the rural economy is connected to the urban economy using transportation. And every time you tax that, you know, that friction that you creates lower economic growth, which makes the economy less attractive to the big PE firms. But some of them just use numbers. They say, okay, if an economy is not the size of $50 billion, then we're not going to go there. So the whole game about tax policy and reform, for those ones that are in the room from the government, it's about creating economic growth. So every time you have a policy around tax, you really need to ask, is it going to stimulate economic activity? And how do you create incentives for savings to form? Because we've created a lot of regulatory agencies, which is very good for our market. It means that we now have retirement benefits, we have insurance funds, we have the exchange. But what are those policies that can allow more savings to form, which would create more options for the funds? And how do we create competitiveness? I don't know if that helps answer your question. Thanks. In the interest of time.
All right, thank you. Just a bit of follow-up on some of the submissions. Earlier on, NSSF said that yes, real estate is an alternative, but not many of the private market players are exposed to that sector. But also US is saying the private market players are preferring to exit, you know, through other equity funds. So I don't know what response, David, you could have regarding those two.
The issue of not exiting through the US is quite complex because most of the capital that is invested in the private funds is dealing with early stage growth businesses, which could go to the alternative investment market segment, which is a smaller segment, but it still requires heavy compliance, which I think a lot of our SMEs are not ready to take on, despite the fact that they are ready to take on capital to continue to grow. So the US is not being avoided for any reason but scale, ability to scale at that level. I think when we start to see private equity deals in the consolidation area, where we are creating monopolies, by the way, monopolies are efficient in capital allocation. When we try to create monopolies by consolidating all these small players into more efficient players in terms of capital utilization and wealth generation, then you will see exits of private equity vehicles through the stock exchange. On the issue of rights, I think my colleague Dixon is best placed to discuss the issue of real estate investment being further made available, accessible through trusts or that kind of thing. I don't know if you can speak to the law around that. I'm not really competent.
Okay. Yeah, maybe just a quick comment. Number one, we all know that real estate can be quite an illiquid asset. And again, if you're to invest in real estate directly, it requires a lot of managerial skills, you name it. So real estate is a complicated asset, and I think one of the ways that you take away that complexity is through the real estate investment trust. And the regulations are there which allow for both development REITs and income REITs, where basically you can transfer your property into this trust and raise capital based on the property that you have in that trust. And just refresh your question specifically on REITs or real estate.
I was saying earlier on, someone mentioned that not many, many people, the pensions, they've invested in real estate, but not as much. But also the likes of David are not so exposed in the real estate sector.
Okay.
Yes.
I think if you look at the bulk of where our pension players are, they're basically in the government treasury space, basically almost 80%. And the thing about the treasuries is that these are very liquid, and to a very large extent they can allow for that liability relative investment, where you basically match your assets to expected liabilities. Now, as to real estate, I think it all boils down to illiquidity. I think the level of illiquidity around real estate is not that encouraging for them to actually get into real estate. But then again, I think with a lot more exposure to real estate investment trusts, which are a lot more liquid, I think then you're likely to see a lot more exposure towards the real estate asset class, but basically indirectly through real estate investment trusts.
One comment on the NSSF. Sorry, one of the tragedies in the monetary system for Uganda, and hear me out on this, is that when we bulk our savings into, let's say, the National Social Security Fund, and then it invests in treasury bonds, I just wanted to explain it a bit for those who are not as technical as you. It means that the NSSF is investing to lend money to the government. Now, when the government pays when it pays the interest due on those bonds, effectively, you, the person who is saving with the NSSF, are being taxed to pay yourself interest. I don't know if I'm making sense. So that's a bit of a tragedy. So one of the reforms should be that we encourage that the portfolio of investments of an SSF, policymakers have to allow it to allocate, say, 3% or 5% to the Ivans of these worlds, the private equity firms and the VC firms, because that would mean effectively that the savings are going back to the actual savers. Because what happens is that every time the expenditure of the government is higher than the tax, then they borrow. So if they are borrowing from the savers in NSSF and then taxing the savers of NSSF to pay them interest, it's inefficient, because the capital savings in the economy are not going back to create more economic growth unless the bulk of that money goes into capital goods. So I think from a policy reform point of view, to directly impact what we're discussing today, is that what should be on the cards, even for the pension funds, is that the actual savers of this money need to have access to this capital when they have ventures which are regulated, like venture capital funds and private equity funds. And this is the biggest tragedy of the Ugandan financial system, in my view. Thank you.
Thank you. You want to chip in?
Just a quick reaction.
All right.
Just sharing an experience. I think I was in Sri Lanka about 8 or 9 years ago. And what struck me as I was looking at the pension system was that the government pension system, or the statutory pension system, if you look at the objectives, I mean, they clearly state that it's been established to basically provide or finance the state. I mean, they don't even dilly-dally. It's there to provide funding for the state. Well, I didn't say much, but I mean, that was the Sri Lankan experience. But I guess with a lot more, education, I think you can see, when people are a lot more educated, then they should be in a better position to, explore other options?
I think that's the point where we need to revive the discussion on the liberalization of the sector.
No,
but anyway,
I didn't want to mention that, but
but anyway, you have something to add?
Yes.
Quickly, then
yes.
I open up some questions from the audience.
Just quickly to bring that question back to the room. The reason why these tax reforms have been debated on a macro level rather than a micro level is because exactly that. NSSF, PSFU, that is forming the catalytic fund, SACCOs and other investors are not able to put their vehicle in venture capital funds because of inefficient tax regimes that have been taxing returns on investment in a double layer by treating the investors, investees, and the fund vehicles as separate individuals, yet the fund is just a pass-through between the investors and the investees. So with those laws coming into place, God willing, once assented, and also implementable, because the laws is just a first thing, and then the implementation has to come live. With those things coming in place, then we have NSSF, we have PSFU form local funds, or can invest now in local funds more efficiently than taking the money to public equities in East Africa or trying to take it to Mauritius, where they are not even allowed to place capital.
So at this point, I would want to invite a few questions from the audience, and also to remind you, it's not every day that you get a chance to speak to Paul and the regulator. You might have to write a letter after a year to get a response. So take advantage of this opportunity and shoot your shot. Do you have any questions? Gen Zs. No questions. All right, I would want to invite the panelists to give us their parting shots. Let me start from Mr. Abu Baker. Parting shots and maybe key takeaways from this event.
So for me, first of all, thank you, moderator, and thank you, CFA Society. It gives me great pleasure to see young people in this room. As you can see, I have a bit of gray hair. That gives me a lot of hope. And my parting shot is that I really, I'm excited about what I've heard about the tax reforms, because it's been a really big constraint over time. And then my parting shot is that the emphasis we put on tax is the same emphasis we should put on savings and how they are generated and how they are incentivized in order to get to where we want to get. Thank you very much.
Thank you. And well, I think I've already thanked the CFA Society and the partner organizations for putting together today's event. I think it's been a wonderful and magnificent event. Now, my parting shot would be, we're taking baby steps towards operationalizing the private capital space and, positioning it to better serve the capital needs of Ugandans. So we're just taking baby steps, but what I believe is that we need to look at the entire ecosystem. I think it should be an ecosystem approach where we don't only look at the taxation bit, but we also look at the legal regulatory framework. We look at the supportive services, from accounting, legal, you name it. So it's important that we have a very broad-based view of the problem at hand and, come up with solutions that address each of those building blocks that are important to fully operationalizing the private capital space in Uganda. I thank you.
Thank you. I also want to take the opportunity to thank the moderator. Thank you for guiding us, and also the audience and the CFA Society for organizing this event. What I learned from the tax policy changes that have come through this year is that it's one of the examples of the challenges that we face as a country, and there are many others that touch on investment. And the people in this room, you're the people that are going to solve these problems. No one is going to fly here to solve them. In other words, if you look at the journey of this conversation around the taxi policy reforms, Dixon, David and other team members have been walking this journey, not giving up. So what I encourage members is, whatever challenge there is, you have the ideas, you have the solutions, you bring them on board to Paul, Dixon, or talk to other professionals like myself. Let's have solutions and let's push the policymakers to bring through these solutions, and don't give up. Thank you very much.
Thank you, Mr. Paul.
So I believe the public markets and the private markets work hand in hand, and there should be direct collaboration between the two. If you'd like to see growth in the private markets, I think aligning with the public markets where there's assets under management in the range of 30 trillion that have a lot of potential. Currently, the 11 companies listed on the exchange, the local companies, have a market capitalization of about 12 trillion. We've raised, the companies have raised about 1.3 trillion initial public offers, about 288 billion in bonds issued. Government has listed over 35 trillion in government bonds and treasuries on the exchange. The different market segments play a different role. As David mentioned, we've got the growth enterprise market segment, and this segment is really, the role it plays is for growth companies. In other words, it's more of hand-holding and working hand in hand with the company and with the pension funds and the investors to align and work in a direction that you will probably list or exit off the main market segment. So there's a lot of potential, and I think recently we introduced the USC specialist market, and this is a private market that has both an incubator but also provides capital to companies in a private setting, and also a private platform to trade off if one wants to exit. The markets have actually worked. The liquidity might not be as much as one would expect in a developed market, but we've seen growth post-COVID. We've seen some counters rise as high as 100% over the last 3 years, some at 58%. And we've seen a positive trend in the companies paying dividends and good dividend yields, some as high as 17%, 27%. And those figures are available through our licensed stockbrokers if you'd like to read a little more into the investment options available. So the pension funds are keen on investments, but they are tied to public markets. So if those synergies can be aligned, we could see growth in both the private markets and the public markets. I would like to thank the CFA Society for organizing this, and we look forward to continue working together in support of this initiative. Thank you.
All right, thank you. David?
In keeping with the theme of the conference today, it is really about encouraging local private capital formation to drive the agenda or set the agenda for investment in Uganda. And the critical element that is lacking in my mind is skills, and therefore building it around the CFA designation is critical, because to us it represents the global standard of an investment professional around other different professions such as legal, tax, as we have witnessed in this room. So we should use our local reforms, our local policies to encourage local capital to galvanize around investment, and then use that critical mass of skills around that capital to leverage and borrow and bring foreign capital, not the other way around. If we try and set the agenda on foreign capital coming in first before we invest, it just begs confusion. Why should somebody be more interested in Uganda than we are interested in Uganda? Why should somebody be more skilled in Mauritius than we are skilled in Uganda, managing affairs of Uganda? These are some of the things that I find quite annoying, but we have to move on and keep moving on and encouraging each other to develop an environment that can think for itself and act for itself and demand its share of the pie. Thank you.
All right. Thank you very much for your insights. A round of applause for our panelists as they take a photo, and then I don't know what's the next program. A photo moment.
Thank you very much. Can I request a standing ovation for this panel, please? Standing ovation. Let's get to our feet and please, 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 please. Standing ovation for this panel. Thank you very much. I think, yes, you may take your seats. Thank you so much. I think that panel really did justice to their topic, and you could all see they were still going. We've come to the close, but before the actual close, allow me share some of the takeaways that I will take from here. We've been speaking about, alpha returns. We began at alpha, and I think we've ended with an alpha panel. And that's very good. We've talked about fleshing out a success process to make this entire process of venturing into alternative investments predictable. So it's an area that we will build on in the future. We've of course heard about how the tax regime is changing to our favor. We've spoken about how so little money is going towards manufacturing, and yet there could be great potential, especially if you're doing impact investing. We've looked at the rates, real estate, and what needs to happen to get more activity over there. We have spoken a lot about Gen Z. The thing that sticks to my mind, these guys want to go to Bali, not Ginger. So they have an interesting way of looking at investments. Social media is very close to their hearts. If you are looking to get Gen Z investors or maybe a Gen Z LP, or have that 30-second video. A friend from ABSA raised that. There was the area of carbon finance, government green bonds. We have the gentleman from 1 Million Ton Nation, MTN, 1MTN, aptly 1MTN, and there seems to be a lot of money. I guess personally this is an area I need to go to, since very few of you seem to follow up, but this is an area that is open for investment, and probably a place that's going to grow in the future. Of course, we've had this final panel of elders who've been speaking to us about the regulation and the tax, and we have been tasked to go out there and be the change we want to be, and to enact some of the ideas that we have just been sharing today. So I want to thank you all for being with us since the morning and being with us. You've been a very good audience. The room is still full, and that's really speaks to the kind of audience that you are. Thank you for your interest in this. I'm not going to give the final comments. We have George Jatto, who works at BDO, very good at valuations, and I'm just trying to preempt the conversations we're going to have after here. Of course, the key thing when we get together is the one-on-one sessions that we have after this. So you have the panels that will open your mind to particular ideas, and then we get to speak one-on-one, and from here we hope that we can get together in our groups and make things happen, such that we grow our books, our returns, and lock in some investments. Without any further ado, George, please. You're welcome. Over to you. Round of applause to George.
Yeah, good afternoon, everyone. I think it's been a very long, fruitful day. My role here is just to thank you all for attending and give a vote of thanks on behalf of the CFA Society, East Africa. This is the second year running where we have held our alternative investment conference, and I think the quality of the discussions keep on improving over time, and as well as the attendance. I saw some familiar faces, colleagues from our neighboring countries. I think I've also participated in this conference, and will keep on encouraging them to come. So I'd like, for starters, to thank our sponsors and partners who have made this event successful. And then I don't think I have to go into giving a summary of the discussions that have been held. I would be doing a disjustice to my colleague Samuel. So without further ado, I would welcome you all to the next event.
Just a moment.
All right, so yeah, I would like to invite Francis. I don't see where he's in the room. Yeah, come and give the closing remarks. Thank you.
Hello everyone. Hello. Are we full sleepy, or there's a Gen Z who told us that we are giving them information overload and they didn't know what to do with the information? True story. So their question is, so what do we do next? So to the people who are here on the panel on Gen Zs, I think what they were asking is, yes, you've given us a whole lot of information, and they had a specific request on how do they individually invest in real estate, for example. As you can imagine, the minimum tickets are significant. So it's actually a good question to ask ourselves. I'm here to do one of, I'd say, not an enviable job, mainly because by the time I'm doing this, either you've gotten a whole lot of information and you are tired, or there is nothing new I'm going to tell you. But I want to start by first thanking you as the participants. Without you, then this conference will not have been successful. So we are grateful for your time. We are grateful for your contribution. We are grateful for you coming and having the humility to listen and to also learn. I also would like to thank the panelists. We had a significant panel in place, and I'll try to make sure that we do not go through all the names and bore you with the names. I hope all of you did the scanning at the door, so you can be able to get the details on the panels. But I want to say thank you to all the panelists, including the last ones who've come here, mainly because of the level of knowledge that they've imparted on us. To the regulators, I think that was a very big win. For most of you know, and when someone said here, it's the only time a regulator will tell you something without having you write a letter. So I'd wish for us to utilize this opportunity, and for the ones who are in the room, to just engage with them so that we can be able to see how do we work to enhance alternative investments into the Ugandan market and into East Africa. I also would like to thank our sponsors, the Bank of Uganda. Thank you so much for the support. CMA Uganda. They've always been great partners with the CFA Society East Africa, and we are very grateful for that. The Deposit Protection Fund, NSSF, PKF, and thanks for showing us a little bit more when it comes to the tax matters. Uganda Securities Exchange and Old Mutual Investment Group. To our partners, Esatal, TDB, ABSA, and Gen Africa. We'd also like to say thank you for the support that you've continued to give us. I want to also pass a great thank you to the board of the CFA Society East Africa, who've actually been very helpful in ensuring that this conference happens. It's the second time this conference is happening. And as you can see, we are building a momentum towards ensuring that we do not just sit back and complain when it comes to lack of investments into the alternative side, but also to take the initiative and be able to have the conversations with government, with practitioners, and all the players in the market. I also would like to thank the members of the society. I know we mentioned about having 300 charter holders in East Africa, 57 of whom are in Uganda. Over this day-to-day, we've added a number of the concentration of charter holders in Uganda. I think once we're done with this, the next session is actually a charter award. I'd like to invite you to stay back and be able to interact with most of these charter holders, so thank you. To the candidates who are in the room, I know that many of you, one came and told me, I'm just starting the journey, don't. But I was telling them it's only one of 3 steps, and you'll actually be able to make it. So we really appreciate you. As I come to a close, sorry, I'm giving you a long list, I know. I'd like to thank our volunteers. I know you've seen people going around giving you microphones. If you are registering there, you've seen a whole lot of being served, I believe, very well. The CFA Society works majorly on volunteer basis. I am a volunteer also. We have very few full-time staff, and we rely on the volunteers to actually be able to push and be able to encourage more uptake of this globally acclaimed program. So I want to thank the volunteers. Thank you so much for taking time out for the good work that you've done. Finally, and not least, and I hope all protocols observed, I've not missed anyone, but finally and not least, I'd like to thank the organizers, whom I'll break into 2. One is the admin of the CFA Society, led by Joyce and Ruth, for doing a very good job. And I'll close by thanking 2 very important gentlemen, whom you've seen in very many of the panels, for having not only conceptualized this, but having been aggressive and resilient in pushing for it. And that's Alan Luetabe and David Wangolo. I'm sure you know of them. I'd encourage you to talk a little bit more to David, especially on gender-focused investing. So that's an important one. And you should actually also talk to Alan on his passion about more funding being channeled towards alternative investments. And he has a very good program he also runs when it comes to angel investing. So I know I don't want to take your role and announce what's next, but this is my heartfelt thank you to all of you. We were talking with Joyce earlier and saying that this is a very engaged audience. But as we continue talking, then it hit us that actually the points and the conversations are very important, that no one wants to miss it. So thank you, everyone. We still have another session oncoming. Looking forward to keep interacting, and looking forward to not only us engaging before the next conference. And David and Alan, I think the next conference should start by what progress have we made from this one. This is just not an information conversation.
There are action points I know you have. You're talking to government. There are some laws that are being pursued. There are some bills that we are hoping they'll be implemented. I think the next conversation should start with what progress have we made. If you are an investor in a company, it always starts with what the value for the money. So for the people who are here, they want to know the value for the money for them being here and spending on coming here. So thank you very much. I look forward to interacting with you. Jace is buying us drinks, I believe. So for those who are shy when having water, you can have some other liquid, and then we can have even more conversations. Thank you very much. I nearly forgot someone. I'd like to thank our I am so sorry. But shouldn't we thank him? I think he's managed to make the conference run seamlessly. We may not have started smack on the dot, but we are finishing very well. So let's give him a round of applause, please. Thank you all. My final word today here is for this session is to invite you all for the cocktail. We're going to have a cocktail. We're going to award our new charter holders at a very good site, which is at the poolside. We are actually ahead of schedule. We will be there at 6, so there's enough time now to engage, interact at exactly 6. We will be at the poolside awarding charters, celebrating. It's not easy to get that charter, so we've got all colors of liquid over there, and we will be sampling some of those and assessing risk and those various liquids. Right now, I'd just like to thank you all for being a very good crowd. Join us at 6 at the poolside, and let's engage, let's keep in touch. Over and out. Thank you.